The foundations of the modern taxation system in the United Kingdom can be traced back to the early medieval period, specifically to the Anglo-Saxon era. The Anglo-Saxon period, stretching from approximately the 7th century to the Norman conquest in 1066, provides a rich and complex picture of the development of fiscal systems based on land ownership, feudal structures, and early administrative practices. These early systems of taxation formed the basis for many later developments in England's financial and legal systems. In the early Anglo-Saxon period, the primary form of taxation was land-based. The concept of land being the most vital resource in the kingdom was central to the formation of the taxation system. This land-based taxation was primarily aimed at ensuring the king's military capacity, the maintenance of his court, and the support of the nobility and church. The most significant form of tax during this time was the geld, a tax levied on landholdings, and it was assessed on the basis of a unit of measurement known as the hide. A hide, in theory, represented enough land to support a household and was the fundamental unit for determining tax liability in Anglo-Saxon England. The size of the hide varied, but it was generally between 60 and 120 acres, depending on the region and fertility of the land. The hide system did not only represent a unit of land for taxation purposes but also represented military and social obligations. In times of need, the king could call upon a certain number of men from the land corresponding to the number of hides that a local community was responsible for. This system connected land, wealth, and military service in a way that was consistent with the feudal structures that were beginning to take root in England. The land tax, or geld, was assessed based on the number of hides held by a person or a household. Under King Athelred the Unready, the Danegeld, a form of geld paid specifically to Vikings to stop their raids, became a regular tax, levied in periods of peace to ensure that the kingdom could maintain its defenses against further Viking invasions. The Danegeld began as a one-off payment but evolved into an annual or biennial tax, becoming a standard feature of Anglo-Saxon fiscal policy. This form of tax was not just a simple financial levy but was often calculated according to the number of hides a person owned, with each hide contributing to the total amount of the tax. This structured approach helped create a consistent, albeit regionally variable, system of tax collection across Anglo-Saxon England. Taxes in the Anglo-Saxon period were not limited to land. The church played a significant role in both the imposition and collection of taxes. The ecclesiastical system was one of the largest landholders in Anglo-Saxon England, and the church's power over landholdings was so substantial that it often gained exemptions from certain taxes. The tithe, a tax paid to the church, was particularly important. It required that 1/10 of agricultural produce be paid to support religious and charitable activities, especially to fund the maintenance of churches and monasteries. These tithes, like other forms of taxation, were paid in kind rather than cash, reflecting the predominantly agrarian nature of Anglo-Saxon society. In addition to these taxes, there were also a variety of extraordinary taxes levied by the king to fund specific needs. For example, the hergeld was a tax used to support military expenses, especially during periods of war or when the king needed to maintain a standing army. The hergeld was often levied on landowners, and like the geld, it was calculated according to the number of hides a person or community controlled. This form of tax was particularly useful in times of military conflict when immediate funds were required to support the kingdom's defenses. The administration of taxes in Anglo-Saxon England was handled through a relatively decentralized system. The king's authority extended over large regions, but the actual collection of taxes was carried out at the local level. Local rulers, known as shire reeves or sheriffs, were responsible for collecting taxes from the various hundreds within their jurisdiction. A hundred was a small administrative unit within a shire, the latter being a larger region akin to a modern county. Hundreds were made up of 10 tithings, which were small communities of approximately 10 households. The sheriff's role was to ensure that the proper amount of tax was collected and delivered to the king, often in the form of silver coins or agricultural produce. At the local level, hundreds played a crucial role in tax administration. The hundred could be seen as a unit of both local governance and taxation. Each hundred was responsible for organizing and collecting taxes from its inhabitants and reporting this to the sheriff. The system of hundreds was designed to ensure that tax collection was efficient and that the king's officials could maintain control over distant regions without the need for direct involvement in every local affair. It also allowed for the collection of taxes to be more localized and tailored to regional needs. The Witenagemot, an assembly of nobles, clergy, and other important figures, also played an essential role in the Anglo-Saxon taxation system. While it did not directly impose taxes, the Witenagemot provided the king with the political support necessary for imposing taxes, especially extraordinary ones. This advisory body acted as a form of early democratic oversight over the king's power. Its support was crucial for any significant financial decision, as it helped ensure that taxes were seen as legitimate by the ruling elite and, by extension, the wider population. In the absence of a comprehensive tax code or centralized bureaucracy, the Anglo-Saxon king relied heavily on local records to keep track of tax obligations. Charters and land books were crucial in documenting who owned what land and how much tax was owed. These documents were often kept by monasteries, which were one of the few institutions capable of maintaining detailed records at the time. Writs and other legal documents were used to formalize tax obligations, and these records helped to ensure that taxes were collected systematically. The Domesday Book, compiled after the Norman Conquest, would later build on this tradition of detailed documentation, but the roots of such record-keeping can be found in the practices of the Anglo-Saxon period. Monetary taxes, such as those collected in silver, were often administered through a system of coins and currency. The Anglo-Saxon silver penny became the primary medium for collecting taxes in cash. It was minted in various quantities across the kingdom, with 1 pound consisting of 20 shillings, and 1 shilling containing 12 pennies. This system of coinage allowed for a more structured financial administration, as taxes could be paid in silver rather than in kind, facilitating trade and ensuring a more reliable and stable economy. As the kingdom grew and developed, taxation became more structured. The need for more funds led to increased taxation rates, and the king's ability to collect taxes was bolstered by the creation of a more formalized administrative apparatus. The rise of the Norman dynasty in 1066 would mark a key turning point in the history of English taxation, but the principles and structures established during the Anglo-Saxon period laid the groundwork for many of the developments that would follow. Throughout the Anglo-Saxon period, the nature of taxation evolved in response to external pressures, especially from Viking invasions, as well as internal economic shifts. The tax system, deeply tied to the land and the agricultural economy, adapted to changing needs and conditions. The role of the church, the reliance on local structures like the hundred, and the creation of administrative units like the shire helped to shape a taxation system that was both pragmatic and flexible, if somewhat rudimentary by modern standards. The Norman conquest of England in 1066 marked a significant transformation in the mechanisms of taxation and fiscal administration. Upon assuming the English throne, William the Conqueror inherited a system of taxation that had been previously rooted in Anglo-Saxon traditions. However, the Normans sought not merely to continue existing practices but to enhance them for the consolidation of royal authority, the efficient extraction of wealth, and the stabilization of feudal governance. The period from 1066 to 1154, encompassing the reigns of William I, William II, and Henry I, along with the brief rule of Stephen, is thus characterized by a more centralized, codified, and systematically documented approach to taxation. One of the earliest and most enduring fiscal actions undertaken by William the Conqueror was the commissioning of a comprehensive land survey in 1085, the result of which was the Domesday Book. This monumental administrative document stands as the most famous record of medieval landholding and taxation in England. Though its primary function was not the direct imposition of taxes, it served as the foundational inventory for taxation purposes, delineating land ownership, tenurial relationships, and productive value. The Domesday Book, completed in 1086, catalogued more than 13,000 place names and documented the ownership of land before and after the conquest. It listed the name of the landholder, the name of the predecessor landholder, the size of the estate measured in hides, the number of plough teams, peasants, slaves, livestock, and the estimated annual value of the land. This detailed compilation allowed the royal administration to assess not only the distribution of land and wealth but also the capacity of the realm to yield revenue. It also enabled the imposition of geld, which continued as a principal tax during the early Norman period. The geld, inherited from Anglo-Saxon practice, was still assessed by the hide and remained an important land tax throughout the reign of William I. However, under the Normans, it was imposed more systematically and uniformly across the realm. The Norman administration's ability to extract geld with regularity stemmed from its development of stronger institutions of governance and enforcement. Shire courts, previously Anglo-Saxon in structure, were now increasingly populated by Norman sheriffs who owed loyalty directly to the king and acted as his fiscal agents. These sheriffs collected geld and other dues and ensured their remittance to the royal treasury. The administration of taxation under the Normans also reflected the increased use of feudal obligations as a form of fiscal exaction. William and his successors granted vast tracts of land to their followers, who became tenants-in-chief holding their land directly from the crown. These tenants-in-chief were obliged to provide a fixed number of knights or their monetary equivalent, known as scutage, in lieu of military service. The feudal system, as instituted by the Normans, was therefore not only a system of governance and landholding but also one of taxation by obligation. Scutage, from the Latin scutum meaning shield, was initially a substitute for military service but later evolved into a general revenue source. Whenever the king required funds but not men, he levied scutage on his tenants, who were then permitted to pay a money tax instead of providing military service. Over time, as military organization became more professional and the use of mercenary troops more prevalent, scutage increasingly supplanted feudal service and became a regularized fiscal mechanism. In addition to geld and scutage, the early Norman kings introduced a number of incidental feudal aids, which were payments due from vassals to the king on specific occasions. These included payments on the knighting of the king's eldest son, the marriage of the king's eldest daughter, and the king's ransom if he were captured. Though originally presented as one-off contributions, these aids became more frequent and significant in royal revenue. Because they were not fixed in rate or frequency, they were subject to negotiation and royal prerogative, making them a flexible if unpredictable source of funds. The forestry laws and the creation of royal forests also provided a fiscal dimension to Norman rule. William I and his successors designated large areas of land as royal forests, which were not necessarily wooded areas but regions where forest law applied. These areas were under direct royal control and used for hunting, but they also represented an opportunity for revenue. Fines for poaching, unauthorized timber cutting, or land encroachment were collected and became a notable source of income. The administration of forest law was independent from common law and was overseen by forest officials such as foresters, verdeers, and agisters, all of whom reported to the crown, the royal domain. Lands held directly by the crown was another critical source of income. The Domesday Book catalogued the extent and value of these holdings, and the revenue from these estates, collected in rents and produce, went directly into the royal treasury. The management of the royal domain was conducted through manorial officials appointed by the king or his agents, and the income was used to support the royal household and court. In an era where cash was scarce, payment in kind, such as grain, livestock, wool, or labor, was as important as payment in coin. Under Henry I, or 1100 to 1135, the administration of royal revenue became more structured and sophisticated. One of the most important innovations of his reign was the establishment of the exchequer, a governmental body responsible for auditing accounts and managing royal income. The exchequer derived its name from the checkered cloth placed on a table used to calculate and reconcile accounts with counters. Twice yearly, sheriffs and other royal officials would appear before the exchequer to account for the money they had collected on behalf of the crown. The exchequer employed tallies, notched wooden sticks that recorded the amount of money paid or owed. One half of the tally was kept by the payer and the other by the exchequer, providing a primitive but effective means of bookkeeping. The audit process also included pipe rolls, large parchment rolls containing detailed records of royal income and expenditures. The first surviving pipe roll dates from 1130, during the reign of Henry I, and provides one of the earliest continuous records of government finance in Western Europe. The reign of King Stephen, 1135 to 1154, was marked by civil war and instability, often referred to as the anarchy. During this period, royal authority weakened, and the fiscal system experienced considerable disruption. Local barons took control of their own revenues, and the ability of the crown to levy taxes uniformly diminished. Nonetheless, many of the institutions established under William and Henry I endured and would later be reasserted under the Plantagenet kings. The period from 1066 to 1154 thus represents a critical phase in the evolution of taxation in England. The transition from Anglo-Saxon to Norman rule brought about greater centralization, the institutionalization of feudal dues, and the first formal systems of fiscal record-keeping. With the creation of the Domesday Book and the establishment of the Exchequer, the foundations of a permanent and administratively coherent tax regime were laid. These developments enabled the Crown to expand its revenue base, assert its authority over a diverse and often fractious nobility, and begin the long process of institutionalizing state finance. The accession of Henry II in 1154, inaugurating the Angevin dynasty, marked a further evolution in English taxation. Building upon the foundations laid by his grandfather Henry I, Henry II sought to restore central authority, regularize royal revenues, and expand the mechanisms of taxation. The period spanning the late 12th and 13th centuries witnessed significant fiscal developments, including the refinement of the exchequer, the introduction of new national levies, the institutionalization of scutage, and the emergence of parliamentary taxation. The interplay between the monarchy, barons, clergy, and emerging towns would also begin to shape the principles of consent and representation in fiscal policy. Henry II, determined to reclaim the strength of royal finances after the civil strife of Stephen's reign, relied on an array of fiscal instruments. One of the most prominent was the scutage tax, which, under his administration, evolved from an occasional feudal substitution to a more regular and monetized tax. Originally introduced as a payment in lieu of military service, scutage was increasingly demanded from tenants-in-chief who were unwilling or unable to fulfill their military obligations. Henry II levied scutage at least 10 times during his reign, with rates varying according to need, often set at 1 or 2 marks per knight's fee. These revenues were vital to funding his continental campaigns in Anjou, Normandy, and Aquitaine. In addition to scutage, Henry revived and intensified the collection of geld, though it would gradually diminish in importance. He also levied aids and reliefs, the latter being payments due from heirs of tenants-in-chief upon succession. These feudal incidents became a significant source of royal income, as they were assessed at the king's discretion. The monarchy also began to impose wardships and marriage rights, wherein the king could control the estates of minor heirs or arrange marriages of heiresses, often extracting payments in exchange for favorable matches or guardianships. The exchequer, continuing its evolution from the late Norman period, became increasingly formalized. The use of pipe rolls expanded, with annual records providing systematic accounts of sheriff's payments and royal revenues. The pipe rolls included revenue from land rents, court fines, wardships, and forest dues. Forest revenues, in particular, were notable under Henry II, who greatly expanded the royal forest. The forest law became a potent fiscal and political tool, used to extract fines and assert royal authority. Offenses such as cutting wood, hunting deer, or grazing animals in the king's forests without license were punishable by fines, many of which were recorded in detail in the pipe rolls. A new development under Henry II was the levy of national taxes not based solely on land. In 1188, he introduced the Saladin tithe, a tax of 1/10 of personal income and movable property to fund the Third Crusade. This marked one of the first instances of a direct tax on wealth rather than on land. It applied to both laypersons and clergy, though certain exemptions were granted. The assessment required individuals to swear under oath regarding their possessions, a procedure that signified increasing royal intrusion into private economic affairs. The Saladin tithe demonstrated the monarchy's growing capacity to assess and collect revenue beyond the traditional feudal framework. Under Richard I, or 1189 to 1199, taxation was driven by the need to fund crusading efforts and to raise his ransom after capture in Germany in 1192. The ransom tax, levied to pay the 150,000 mark ransom, was one of the largest fiscal efforts of the 12th century. The tax applied broadly to landholders, clergy, merchants, and even townspeople, reflecting an increasingly comprehensive approach to revenue collection. Additional levies included duties on Jewish communities, who were classified as servi camerae regis, or servants of the royal chamber, and thus subject to direct taxation by the king. Richard's successor, King John, or 1199 to 1216, faced extensive fiscal pressures, particularly due to his wars in France. His heavy reliance on scutage, arbitrary aids, and fines for minor infractions led to growing baronial resentment. John imposed scutage no fewer than 11 times in 17 years, often at increasing rates, and frequently without consent. He also abused wardships, reliefs, and inheritance dues, extracting high sums through legal pretexts. The Jewish community was again targeted for special talents, and town charters were sold or revoked depending on the crown's financial needs. His arbitrary fiscal policies were a key grievance among the barons, culminating in the Magna Carta of 1215. The Magna Carta is perhaps the most significant constitutional milestone of this period. Among its many clauses, several directly addressed taxation. Notably, Clause 12 stated, "No scutage or aid shall be imposed in our kingdom, unless by common council of our kingdom." This was a direct response to John's unilateral fiscal practices and established the principle that the crown could not levy taxes without baronial consent, a precursor to later parliamentary consent. Though the charter was annulled and reissued multiple times in the ensuing years, the notion that taxation required collective approval would endure. During the minority of Henry III, or 1216 to 1272, the royal administration was cautious in its fiscal actions, relying on agreed subsidies and avoiding arbitrary levies. However, as Henry reached adulthood, his court expenditures and foreign ambitions once again strained the treasury. The concept of parliamentary taxation began to take shape as the king sought grants of revenue from assemblies of nobles and prelates. The parliaments, not yet formalized in structure, served as consultative bodies, particularly in the granting of taxes in return for redress of grievances, one notable fiscal innovation during Henry III's reign was the tallage, a levy imposed on royal boroughs and Jewish communities. Unlike scutage or aids, tallage did not require consent and was used to extract revenue from towns under royal jurisdiction. While towns increasingly negotiated fixed payments or fines in lieu of future tallages, the tax remained a sore point and symbolized arbitrary royal taxation. The Jewish tallages, such as the massive levy of 40,000 marks in 1240, led to the impoverishment and flight of many Jewish families. As England moved into the reign of Edward I, (r. 1272 to 1307), taxation entered a new phase of institutionalization. Edward's wars in Wales and Scotland required extensive funding, prompting regular appeals to Parliament for subsidies. These subsidies took the form of tenths and fifteenths, fractional levies on the value of personal property and income, assessed differently in rural and urban areas. The tenth was typically applied to towns, and the 15th to shires. The development of tax commissions, which traveled the country assessing wealth and collecting these taxes, demonstrated the increasing bureaucratic reach of the crown. Edward I also relied on customs duties, particularly the wool export tax, which became a cornerstone of royal finance. The nova customa, or new custom, introduced in 1275, established duties of half a mark on each exported sack of wool. Merchants, especially the wool-exporting guilds, objected to these impositions, particularly when levied without formal consent. Nevertheless, customs duties grew in importance, particularly as England's wool trade expanded rapidly in the late 13th century. In 1297, amidst political conflict and military failure, Edward issued the Confirmatio Cartarum, reaffirming Magna Carta and accepting that taxation required consent. This reaffirmation was extracted under pressure from Parliament and barons frustrated by excessive levies, including customs and forced loans. The Confirmatio Cartarum underscored the growing power of the representative assembly in fiscal matters and served as a critical step toward modern parliamentary governance. By the end of Edward I's reign, England had a complex and evolving tax system comprising feudal dues, such as scutage, aids, reliefs, and wardships, tallages, levied without consent on boroughs and Jews, direct taxes, such as tenths and fifteenths on movable property, customs duties, particularly on wool and wine, exports, judicial fines, rents from the royal domain, and forest penalties. These mechanisms were increasingly subject to negotiation and consent, particularly as the crown came to depend more heavily on taxation rather than fixed income. The monarchy's growing reliance on Parliament for subsidies marked a fundamental shift in English political and fiscal life, laying the groundwork for future constitutional developments. The period from 1307 to 1399, encompassing the reigns of Edward II, Edward III, and Richard II, witnessed significant developments in English taxation. As the fiscal needs of the crown expanded due to military campaigns, administrative growth, and domestic unrest, the monarchy increasingly turned to Parliament for consent and resources. This era saw the consolidation of parliamentary taxation, the entrenchment of lay and clerical subsidies, and the introduction of the controversial poll taxes. The complexities of wartime finance, particularly during the 100 Years' War, placed immense pressure on the fiscal apparatus of the realm. Moreover, the political relationship between the monarchy and Parliament deepened. As taxation became a central point of negotiation, conflict, and ultimately reform, upon the accession of Edward II in 1307, the financial burdens inherited from Edward I's wars and expansive policies created a difficult fiscal environment. Edward II's reign was characterized by weak governance, factional conflict, and military failure, most notably the defeat at Bannockburn in 1314. Though Edward II continued to levy tenths and fifteenths, his ability to extract revenue was hampered by political instability. The subsidies granted by Parliament, still largely dependent on the goodwill of the commons and the lords, were sporadic and insufficient for sustained military campaigns. Additionally, revenues from customs duties, particularly the wool export tax, declined due to disruptions in trade and merchant discontent. The Great Charter, Magna Carta, and its confirmations played a continued role in restraining royal authority. Edward II was compelled to reaffirm these charters multiple times in exchange for taxation. Parliament, increasingly assertive, tied grants of subsidies to demands for reform or the dismissal of unpopular advisers. For example, in the ordinances of 1311, Parliament attempted to curtail royal prerogative, including fiscal powers, by limiting the king's ability to levy customs without consent. The alienation of crown lands, the manipulation of wardships, and the imposition of purveyance, the royal right to requisition goods at fixed prices, all became contentious fiscal practices. Generating resistance from local communities, the deposition of Edward II in 1327 and the accession of Edward III marked a new phase in royal finance. The young king's early reign was dominated by his mother, Isabella, and her consort, Roger Mortimer. In this transitional period, Parliament continued to assert itself as a necessary body for legitimizing taxes. After Edward III assumed full control in 1330, his ambitions on the continent would initiate a protracted period of military engagement, commonly referred to as the Hundred Years' War, beginning in 1337. The war, marked by intermittent conflict with France, drove a significant expansion in taxation and the evolution of fiscal practices. A key development during Edward III's reign was the regularization of parliamentary subsidies. The lay subsidy, typically in the form of tenths and fifteenths, became institutionalized. These taxes were granted with increasing frequency, often tied to specific military objectives. The 15th was levied on rural counties, and the 10th on urban boroughs. Assessments were typically based on earlier valuations, creating disparities between actual wealth and taxed amounts. Over time, certain communities negotiated fixed quotas or commutations, leading to a system of standardized assessments that remained in use for decades. This static basis of taxation, though administratively convenient, led to regional inequities. In addition to subsidies, Edward III made significant use of customs duties, especially on the burgeoning wool trade. The nova customa, introduced under Edward I, was expanded and enforced with increasing rigor. In the 1330s and 1340s, Edward negotiated with groups of merchants, granting them monopolistic privileges in exchange for fixed annual customs payments. These arrangements, known as Malatolt agreements, generated substantial revenue but were deeply unpopular among rival merchant groups and prompted parliamentary opposition. The Commons in particular opposed the king's attempts to levy customs without consent, leading to a series of confirmations of the charters reaffirming that no tax could be levied without parliamentary approval. The exigencies of war necessitated more ambitious fiscal innovations. In 1334, a nationwide reassessment of property was undertaken to create a more regular and equitable basis for taxation. Though the effort fell short of comprehensive reform, it represented a growing recognition of the limitations of the existing system. The burden of taxation was unevenly distributed, with wealthier landowners often escaping proportional liability. Despite these inefficiencies, the subsidy system remained the primary means of funding royal military expenditures. The growing complexity of government finance also led to developments in record-keeping and administration. The Exchequer and the Chancery became increasingly involved in documenting subsidies, customs, and loans. Tax commissions, appointed by the Crown, were dispatched to counties to oversee assessments and collections. These commissions often relied on local gentry and officials, fostering a degree of cooperation and tension between the central government and provincial society. One of the most significant fiscal experiments of Edward III's reign was the introduction of poll taxes. First levied in 1377, the poll tax was a per capita tax levied on all individuals over the age of 14, regardless of income or status, with minor exceptions. The 1377 tax was moderate in rate, but subsequent versions in 1379 and 1381 introduced higher and more complex scales based on social rank. The 1381 version imposed graded payments according to occupation and rank, though it attempted to preserve a minimum liability. The administration of the tax required extensive household surveys and rolls, leading to widespread resentment, evasion, and fraud. The poll tax of 1381 became the immediate catalyst for the peasants' revolt. The rebellion, which began in Essex and Kent, quickly spread to London and other parts of the country. Protesters demanded the abolition of serfdom, reductions in taxation, and punishment of corrupt officials. Though the revolt was suppressed, it marked a turning point in popular attitudes toward taxation and governance. The poll tax was never levied again in its original form. Following the revolt, Richard II's government faced increasing pressure to moderate fiscal policies. Though the Crown continued to seek subsidies, the Parliament, particularly the Commons, became more vocal in scrutinizing royal expenditure. Subsidies were often granted conditionally, with stipulations regarding their use and the requirement of audits or treasurers appointed by Parliament. The Parliament of 1386, for example, forced Richard to accept a commission of government, a group of nobles and bishops tasked with overseeing royal administration, including finances. Richard II's reign also saw the increasing use of forced loans and benevolences, non-repayable gifts requested by the Crown. These were technically voluntary but often backed by coercion. Though such measures had been employed sporadically in earlier reigns, their frequency under Richard II contributed to growing disaffection. The king's extravagant court and the perception of fiscal mismanagement further eroded support among both the nobility and the commons. The final years of Richard II's reign were marked by political crisis. His efforts to centralize power, suppress dissent, and bypass parliamentary oversight alienated key constituencies. In 1399, he was deposed by Henry Bolingbroke, who ascended as Henry IV. The deposition, while ostensibly political, was rooted in broader concerns about royal governance, taxation, and the balance of authority between Crown and Parliament. By the end of the 14th century, several critical features of English taxation had become firmly established. Parliamentary consent was essential for the grant of subsidies, both for legitimacy and administrative efficiency. The 10th and 15th became institutionalized as regular lay subsidies, though their static nature created long-term inequities. Clerical taxation, administered through convocations of the clergy, paralleled lay subsidies and required papal as well as royal consent. Customs duties, particularly on wool, wine, and cloth, were crucial to royal revenue, though subject to intense political negotiation. Poll taxes, while innovative, proved politically disastrous and were abandoned after 1381. The relationship between monarchy and parliament deepened, with taxation serving as the principal medium through which constitutional principles were debated and defined. The taxation system of late Plantagenet England reflected the tensions of a society grappling with military demands, economic transformation, and political change. As the 15th century began, the fiscal legacy of Edward III and Richard II would shape the policies of the Lancastrian kings and influence the evolving nature of English constitutionalism. The fiscal policies pursued during the Lancastrian and Yorkist periods, spanning the reigns of Henry IV, Henry V, Henry VI, Edward IV, Edward V, and Richard III, illustrate both continuity and gradual change in the administration and structure of taxation in late medieval England. Although the basic framework of parliamentary consent for taxation remained in place, this period was marked by varying degrees of royal financial independence, shifts in administrative practices, reliance on customs revenues, periodic resort to forced loans and benevolences, and the continuation of lay and clerical subsidies. The period was also characterized by extensive political instability, including civil conflict during the Wars of the Roses, which affected the regularity, nature, and enforcement of taxation. The interplay between war finance, dynastic politics, and constitutional development underpinned the fiscal environment of this era. When Henry IV ascended to the throne in 1399 following the deposition of Richard II, he inherited not only the crown but also a significant set of financial problems. His usurpation meant that securing legitimacy was paramount, and he was thus heavily dependent on Parliament for support. As a result, he convened frequent parliaments, more than a dozen during his reign, where subsidies were discussed and granted. However, the political nature of his accession meant that the Commons took the opportunity to assert greater oversight over royal finances. They demanded that subsidies be used specifically for defense and that audits be conducted to ensure proper expenditure. This marked a continued shift in the balance of fiscal authority toward Parliament. Henry IV relied on the familiar tenths and fifteenths, and Parliament often tied grants to pressing military needs, especially in the face of threats from Scotland and Wales. The rebellion led by Owain Glyndyr in Wales, beginning in 1400, necessitated repeated calls for taxation to fund suppression efforts. Nevertheless, due to the king's tenuous legitimacy, there was reluctance to grant large or frequent subsidies. This led to underfunded campaigns and further erosion of royal authority. Henry's reign illustrates the difficulties faced by a king who lacked the prestige of conquest or inheritance and was therefore more vulnerable to parliamentary constraint in matters of taxation. The accession of Henry V in 1413 marked a turning point. A militarily successful and personally respected monarch, Henry V pursued aggressive campaigns in France, culminating in the celebrated Battle of Agincourt in 1415. The renewed conflict with France necessitated extensive funding. Parliament proved more cooperative under Henry V, granting substantial subsidies on multiple occasions. The king also revived the practice of taking loans from wealthy subjects and corporations, though these were generally repaid, preserving goodwill. Notably, he restored the practice of pledging specific customs or revenues as security for such loans, a sign of increasing sophistication in royal finance. Under Henry V, customs revenues once again became a cornerstone of royal income. The continued taxation of wool exports, through tonnage and poundage, brought in significant funds. These were occasionally granted to the king for life, as in the 1414 grant, reflecting Parliament's greater confidence in his leadership. However, the overall customs base remained vulnerable to fluctuations in trade, especially in periods of continental instability. Henry V also extracted funds from the church. The clergy, taxed separately via convocations of Canterbury and York, continued to provide subsidies in the form of tenths and portions of annual incomes, usually negotiated between ecclesiastical authorities and royal agents. These grants were frequently motivated by appeals to national defense and the preservation of Christian lands in France. The war provided a moral justification for ecclesiastical taxation, easing resistance among the clergy. The death of Henry V in 1422 and the minority of Henry VI introduced a period of regency and fiscal uncertainty. During the king's minority, governance fell to a council that had to balance the costs of war in France with domestic pressures for restraint. Parliamentary scrutiny intensified, and the Commons became more insistent on auditing royal accounts. The decline in English fortunes in France, culminating in the loss of territories during the 1440s and 1450s, led to war weariness and reduced willingness to grant subsidies. By the mid-15th century, Parliament was far less inclined to fund military adventures, particularly as the utility of such efforts diminished. Meanwhile, the government's reliance on forced loans and benevolences increased. These non-parliamentary levies were often presented as voluntary contributions but in practice involved considerable pressure. While such methods could raise short-term funds, they eroded public trust and contributed to perceptions of fiscal mismanagement. The famous Jack Cade's Rebellion in 1450, which included strong grievances against taxation and corruption, underscored the political dangers of unpopular fiscal practices. Throughout Henry VI's reign, administrative inefficiency plagued the collection of taxes. Local tax commissioners, drawn from county gentry, were increasingly viewed with suspicion by the populace. Allegations of favoritism, fraud, and excessive assessments were common. The tax base remained narrow, and evasion was widespread. Attempts to conduct new assessments, such as the valuation projects in the 1430s and 1440s, proved largely ineffective, and collection often fell short of parliamentary grants. The outbreak of the Wars of the Roses, beginning in 1455, further complicated the fiscal situation. As factions within the nobility vied for control of the crown, taxation became irregular and contingent on the prevailing political power. Both Yorkist and Lancastrian regimes sought funds, but the uncertainty of legitimacy made parliamentary grants more difficult to secure. Military leaders resorted to forced contributions, seizures of goods, and exploitation of royal estates to fund their efforts. When Edward IV came to power in 1461, he inherited a fragmented financial system. Recognizing the limitations of relying solely on parliamentary taxation, Edward pursued a strategy of financial independence, aiming to live of his own, that is, to support royal expenditures primarily through the crown's own revenues. To achieve this, he initiated several reforms, revival and reorganization of the royal household to ensure more efficient management of income and expenditure. Emphasis on the land revenues of the crown, including improved leasing of domain lands and better enforcement of feudal dues, enhanced exploitation of the customs system, particularly through stricter enforcement of tonnage and poundage, as well as negotiation of preferential arrangements with merchants, renewed use of benevolences, particularly in 1475 to fund his projected campaign in France, which ended with the Treaty of Picquigny and a substantial French pension. Despite his desire for fiscal autonomy, Edward IV still required Parliament to grant occasional subsidies, particularly when war was contemplated. His skillful use of diplomacy and marriage alliances, as well as his success in reducing foreign entanglements, helped reduce overall fiscal pressure. Nevertheless, Edward IV's methods laid the groundwork for later constitutional conflicts by demonstrating how a monarch might attempt to govern without frequent parliamentary consultation. The brief reign of Edward V in 1483 saw no notable developments in taxation due to its short duration. His uncle and successor, Richard III, however, did attempt some fiscal reforms. Richard III Parliament passed measures aimed at curbing financial abuses, including restrictions on the abuse of benevolences and a reaffirmation of the principle that taxation must be granted by Parliament. These initiatives reflected an awareness of public resentment toward arbitrary levies. Richard III also undertook efforts to reform the administration of royal estates and improve the crown's income from land. However, his reign was too short to implement substantial changes. His defeat at the Battle of Bosworth Field in 1485 ended Yorkist rule and brought Henry Tudor to power, ushering in the early Tudor fiscal regime. Throughout the Lancastrian and Yorkist periods, certain structural characteristics of the English tax system remained consistent. Tenths and fifteenths continued as standard forms of lay subsidy, though increasingly outdated in terms of reflecting actual wealth. clerical taxation remained separate and was generally negotiated through ecclesiastical convocations, with coordination between crown agents and archbishops. Customs duties, especially tonnage and poundage, were critical to royal finances and increasingly sought for life at the beginning of a reign. Forced loans and benevolences, while extra-parliamentary, played an important supplementary role, particularly under fiscal pressure. Parliamentary grants, though essential, were increasingly tied to conditions of accountability and specific purposes. The century between 1399 and 1485 thus demonstrates the ongoing evolution of taxation as both a financial and political instrument. The tension between the Crown's fiscal needs and the constitutional role of Parliament remained unresolved, setting the stage for further developments in the Tudor era. The accession of Henry VII in 1485, following the defeat of Richard III at the Battle of Bosworth Field, marked the beginning of the Tudor dynasty and ushered in a period of increasing centralization and institutional development in the fiscal sphere. Henry VII's reign and that of his son, Henry VIII, were pivotal in reshaping the financial administration of the English monarchy. This period witnessed the consolidation of royal authority over revenue systems, the professionalization of financial offices, the exploitation of both traditional and novel sources of income, and the expansion of state capacity for taxation. While continuity remained in the forms of lay and clerical subsidies and customs duties, the methods of collection, enforcement, and administrative structure evolved significantly. Upon assuming the throne, Henry VII faced the dual challenges of securing dynastic legitimacy and restoring fiscal stability after the upheavals of the Wars of the Roses. One of his primary concerns was to establish a sound financial base that could underpin his rule without over-reliance on Parliament. He revived and expanded traditional sources of income, particularly emphasizing the efficient exploitation of crown lands, feudal dues, and customs revenues. Additionally, he sought to reassert royal rights that had lapsed or been neglected during prior decades of instability. Crown lands formed the bedrock of the royal income under Henry VII. To maximize their yield, the king reorganized their management. Rather than relying exclusively on the exchequer, he increasingly administered these revenues through the chamber finance system, which allowed for more direct royal oversight and swifter accounting. The chamber, as opposed to the more cumbersome exchequer, offered greater flexibility and control. This shift, already observed under Edward IV, was now fully institutionalized. Revenues from crown lands increased through improved leasing arrangements, stricter enforcement of arrears, and the resumption of alienated estates. Feudal rights provided another avenue for revenue enhancement. Henry VII rigorously enforced rights such as wardship, marriage dues, reliefs, and escheats. The Court of Wards and Liveries, though not formally established until 1540 under Henry VIII, had its conceptual and procedural foundations laid during this period. Royal agents actively pursued the identification of feudal incidents, often drawing complaints from affected gentry and nobility. The king's officials scrutinized land tenure arrangements to identify cases where land should revert to the crown upon the death of a tenant-in-chief. These practices not only raised funds but also reinforced royal authority over the landed classes. Another notable feature of Henry VII's fiscal policy was the use of bonds and recognizances. Legal instruments requiring subjects to pledge large sums as guarantees for good behavior or the fulfillment of obligations. While technically not taxes, these mechanisms were financially coercive and yielded considerable income. They were especially targeted at the nobility and served both political and fiscal purposes. The council learned in the law, a specialized body led by Empson and Dudley, oversaw these financial instruments. Although controversial and resented, they contributed significantly to the king's treasury. Henry VII also revived the practice of benevolences, securing voluntary gifts from subjects under the pretense of loyalty. The 1491 benevolence to fund the French campaign exemplifies this tactic. Although ostensibly a contribution to national defense, it was a thinly veiled form of forced taxation. The king's use of such extra-parliamentary levies generated criticism, and Parliament occasionally sought to restrain them, though with limited success. Traditional parliamentary subsidies continued under Henry VII, particularly the 10ths and 15ths, but these were granted infrequently. He was granted 3 full 15ths and 10ths in 1489 and again in 1497, both in response to military threats from France and Scotland. The subsidy of 1489, for example, was meant to fund a military expedition in Brittany. Notably, the tax sparked a rebellion in Yorkshire, where opposition was grounded in perceived inequities and financial exhaustion. Similarly, the Cornish Rebellion of 1497 was prompted by another parliamentary subsidy, highlighting the growing sensitivity of the populace to tax impositions. Henry VII also continued the practice of clerical taxation via convocation. The church remained a separate tax base, and grants were negotiated with ecclesiastical authorities. As with lay subsidies, these were levied in tenths of clerical income and were granted with some regularity, especially in times of war. Despite occasional resistance, the clergy remained a reliable source of royal revenue. Under Henry VIII, who came to the throne in 1509, the financial demands of governance increased substantially, driven by an aggressive foreign policy, conspicuous court expenditure, and a series of costly military campaigns. In response, the Crown both expanded existing revenue streams and introduced new fiscal mechanisms. One of the most significant developments was the creation of the subsidy tax of 1513, a new form of assessment-based taxation that would eventually replace the older 15ths and 10ths system. The subsidy of 1513, conceived during the campaign against France, marked a departure from the fixed-rate levies of earlier centuries. Rather than applying flat rates based on outdated population and wealth assessments, the new subsidy aimed to tax individuals based on more accurate valuations of their income and goods. Commissioners were appointed to assess wealth within localities, and tax rates varied depending on social status and income brackets. This allowed the Crown to extract higher sums, especially from wealthier individuals. Between 1513 and the 1540s, numerous subsidies were granted by Parliament, often in response to Henry's wars in France and Scotland. The 1523 subsidy, for instance, required several annual installments and was among the most burdensome ever imposed. Opposition in the Commons was fierce, and Sir Thomas More, then Speaker of the House, had to mediate between royal demands and parliamentary resistance. Despite these challenges, the subsidy system endured, largely because it was seen as more equitable than older forms. The reign of Henry VIII also witnessed significant increases in customs duties, particularly as trade expanded and the port infrastructure improved. The Book of Rates, which standardized customs tariffs, was periodically updated, and the administration of customs became more centralized. Revenues from tonnage and poundage remained essential, and Parliament continued to grant them at the outset of each reign, typically for life. Smuggling and underreporting, however, remained persistent problems, and the Crown devoted increasing resources to enforcement. A dramatic fiscal transformation occurred in the 1530s with the dissolution of the monasteries, part of Henry VIII's break with Rome and the creation of the Church of England. Between 1536 and 1541, the Crown seized the assets of monastic institutions, resulting in an enormous transfer of wealth and property to the royal treasury. The newly created Court of Augmentations was tasked with managing these lands and revenues. In the short term, the dissolution provided a massive fiscal windfall, but in the long term, much of the monastic land was sold to fund wars, thereby limiting its lasting impact on royal solvency. The dissolution also altered the landscape of clerical taxation, as the traditional system of ecclesiastical tenths and firstfruits was replaced by royal appropriation of these revenues. The Court of First Fruits and Tenths, established in 1540, collected revenues formerly paid to the papacy. Bishops and other clerics now paid their dues directly to the crown, further embedding the monarchy at the heart of financial and religious structures. By the 1540s, Henry VIII's financial situation had become precarious. Despite earlier windfalls, the costs of war against France and Scotland, particularly the 1544 to 1546 campaign, exhausted royal funds. To meet expenses, the king resorted to debasement of the coinage, reducing the silver content in coins to produce more money. This policy generated short-term liquidity but led to inflation and currency instability. The fiscal strain also led to increased sales of crown lands, particularly former monastic estates, which further weakened the crown's long-term revenue base. In administrative terms, Henry VIII's reign was marked by the creation of specialized financial courts, including the Court of Augmentations, to handle monastic property, the Court of First Fruits and Tenths, to collect clerical revenues, the Court of Wards and Liveries, formally established in 1540, to manage feudal revenues, especially wardships. These courts operated alongside the Chamber and the Exchequer, creating a complex and overlapping system of financial administration. While this proliferation of institutions increased fiscal capacity, it also introduced bureaucratic redundancy and occasional confusion. Nevertheless, the early Tudor period laid the foundations for a more modern fiscal state by increasing the reach and precision of royal financial machinery. In summary, the period between 1485 and 1547 saw a transition from fixed, archaic assessments to more targeted and income-sensitive subsidies, a revival and expansion of feudal revenues, enforced more systematically and legally, the integration of formerly ecclesiastical revenues into the crown's income, an increased reliance on customs, with tighter regulation and enforcement, the proliferation of financial institutions, each with specific revenue mandates, the use of extraordinary financial measures, such as debasement and benevolences, to meet exceptional expenses. These developments reflected broader trends in state formation, including the strengthening of central authority, expansion of administrative capacity, and subordination of traditional privileges to royal prerogative. The period spanning the reigns of Edward VI, Mary I, and Elizabeth I represents a critical juncture in the fiscal evolution of England. While the Tudor state had by the early 16th century established several revenue mechanisms and developed a rudimentary fiscal administration, the subsequent decades revealed both the capacity and limitations of these structures. The late Tudor monarchs, especially Elizabeth I, faced persistent financial constraints, frequent military engagements, and domestic pressures that necessitated the continued refinement, and sometimes overextension, of the existing taxation system. However, despite administrative innovations and the intensification of existing fiscal instruments, the late Tudor state consistently struggled to meet its expenditures through ordinary revenue, often resorting to extraordinary measures such as loans, forced contributions, and sale of crown lands. This part surveys the taxation policies and fiscal developments between 1547 and 1603, with particular attention to the administrative mechanisms, revenue sources, and socio-political implications of the Tudor taxation regime during this period. Edward VI, who succeeded his father Henry VIII in 1547 at the age of 9, reigned under a series of regencies. The financial legacy left by Henry VIII's late reign, marked by coinage debasement, expensive wars, and alienation of monastic lands, had already placed the crown in a precarious financial position. Edward's regents, particularly Edward Seymour, Duke of Somerset, and later John Dudley, Duke of Northumberland, inherited a deeply strained fiscal structure. Despite efforts to stabilize revenue, including continued debasement of the coinage and selling more monastic and crown lands, the government failed to restore long-term fiscal balance. The lack of systematic reform in taxation during Edward's reign reflected both political instability and the short-term orientation of his regent's policies. Coinage debasement reached unprecedented levels under Edward VI. Between 1547 and 1551, the silver content of coins was significantly reduced. This policy temporarily increased the nominal money supply and financed ongoing military activities in Scotland and on the continent. However, the economic consequences were severe. Inflation accelerated, real wages declined, and economic discontent grew. No substantial innovations in direct taxation occurred during Edward's reign, and reliance on parliamentary subsidies, clerical tenths and fifteenths, and customs revenues continued much as before. Mary I, who reigned from 1553 to 1558, inherited a kingdom burdened by inflation, an inefficient tax structure, and public dissatisfaction. Although her reign is often associated primarily with religious restoration and her marriage to Philip II of Spain, it also featured modest but important fiscal reforms. Mary's government attempted to restore financial order by reducing dependence on extraordinary revenues and debasement. In 1556, the debasement was effectively ended, and efforts were made to recoin the currency to a more stable standard, though this would not be fully realized until the early years of Elizabeth I's reign. Perhaps the most significant fiscal development under Mary I was the revaluation of customs duties, particularly through the revision of the Book of Rates in 1558. The earlier Book of Rates had become outdated due to inflation and shifts in trade patterns. By updating the valuation of imported and exported goods and adjusting the rates accordingly, the Crown sought to increase customs revenue without enacting new taxes. The 1558 revision expanded the number of goods listed and raised rates, contributing to a substantial increase in customs income over subsequent decades. This reform would become one of the enduring legacies of Marian fiscal policy. Mary's administration also maintained the practice of requesting parliamentary subsidies and levying clerical tenths and fifteenths, though grants were generally modest. The war with France, culminating in the loss of Calais in 1558, placed further strain on the treasury, but fiscal responses remained constrained. The Marian government avoided excessive recourse to forced loans or benevolences, reflecting a more cautious approach to taxation and royal revenue. The accession of Elizabeth I in 1558 marked the beginning of a 45-year reign during which the English fiscal system would be tested repeatedly. Elizabeth's government confronted a financial system that had become increasingly inadequate in the face of growing expenditures. Inflation, rooted in earlier debasement and exacerbated by population growth and rising prices, eroded the real value of fixed revenues. Meanwhile, the political imperative to avoid unpopular taxes or overreach in fiscal demands limited the Crown's options. The Elizabethan fiscal regime was therefore characterized by careful management, administrative efficiency, and gradual innovation rather than wholesale reform. One of Elizabeth I's earliest fiscal accomplishments was the successful recoinage of English currency in 1560–61. This process, overseen by Sir Thomas Gresham, aimed to remove debased coins from circulation and replace them with higher standard issues. The reform stabilized the currency, restored some public confidence, and laid a foundation for longer-term economic growth. Though not a tax per se, the recoinage had significant fiscal implications by restoring purchasing power to the Crown's revenues and improving the efficiency of monetary transactions. Parliamentary subsidies remained a core component of royal finance. Throughout Elizabeth's reign, the Crown regularly requested and received subsidies from Parliament, usually justified by foreign threats or domestic emergencies. Subsidies continued to be based on the 1523 model, using local assessments of income and movable goods. However, over time, the effectiveness of these assessments declined. Local commissioners increasingly colluded with taxpayers to understate wealth, and rates were often applied inconsistently. By the late 1570s and 1580s, the average subsidy yielded significantly less than in earlier decades, both in real and nominal terms. To compensate, the Elizabethan government occasionally requested double or even triple subsidies, multiple grants within a single parliamentary session or closely spaced sessions. This practice became more frequent in the later decades of the reign, especially during the war with Spain. Notable examples include the 1589 double subsidy, granted in the aftermath of the Spanish Armada, and the 1593 triple subsidy, reflecting the ongoing conflict and domestic exigencies. Although Parliament generally complied, debates in the Commons over the frequency and burden of subsidies grew more intense, indicating emerging tensions in the fiscal compact between Crown and subject. The Elizabethan state also continued to rely on customs duties, which grew in importance relative to direct taxation. Thanks to the revised Book of Rates and expanding trade, customs revenues increased throughout the reign. The grant of tonnage and poundage, routinely given to monarchs at the beginning of their reigns, remained in place. However, Elizabeth also utilized impositions, additional duties levied by prerogative without parliamentary approval, on select goods. While limited in scope, these impositions foreshadowed later constitutional conflicts over royal taxation in the Stuart period. Another significant source of revenue was the Court of Wards and Liveries, which managed feudal incidents such as wardships, marriages, and reliefs. Although feudal revenue declined in relative importance, the Elizabethan government made efforts to increase its efficiency. The court generated funds by auctioning wardships to courtiers and speculators, leading to widespread complaints about exploitation and abuse. Critics argued that the practice disrupted noble families and encouraged corrupt administration. Nevertheless, the court remained a fixture of crown finance until its eventual abolition in the 17th century. The crown also exploited clerical taxation, particularly through control over the court of first fruits and tenths. Though the revenues from this source were modest, they symbolized the crown's authority over the church and provided a regular, if limited, stream of income. In combination with parliamentary subsidies and customs, these ecclesiastical revenues helped maintain royal solvency, especially in years of peace. Despite these income streams, Elizabeth I's government frequently faced budgetary shortfalls, particularly during wartime. To bridge the gap, the Crown employed several extraordinary fiscal strategies, including forced loans, although less frequent than under earlier monarchs. Elizabeth occasionally compelled wealthy subjects to lend money to the Crown, particularly in times of military need. These loans were often nominally voluntary but carried strong expectations of compliance. Benevolences, revived during periods of crisis, benevolences sought voluntary contributions from subjects, especially urban elites. These were politically sensitive and used sparingly. Monopoly grants. In the 1590s, the Crown increasingly turned to selling monopolies, exclusive rights to produce or trade certain goods, as a means of raising funds without new taxation. This practice provoked growing opposition, culminating in the 1597 and 1601 parliamentary protests, during which MPs vocally criticized the abuses and economic distortions caused by monopolies. Elizabeth ultimately promised to reform the system, but the episode highlighted the limits of fiscal innovation within the political constraints of the period. Sale of crown lands. As had occurred under her predecessors, Elizabeth sold off large tracts of crown land to raise immediate funds. This practice eroded the long-term fiscal base of the monarchy and was criticized by some advisors, but it remained a necessary expedient given the constraints on increasing taxation. By the end of Elizabeth I's reign, the structure of taxation in England had evolved considerably in terms of administrative capacity and revenue diversity. However, its fundamental limitations remained apparent. Direct taxes yielded insufficient returns due to outdated assessment practices and widespread evasion. Customs revenue, while more productive, was constrained by the slow growth of trade relative to rising expenditures. Feudal and ecclesiastical revenues were static or declining. The state had to increasingly rely on ad hoc measures, loans, and asset sales to meet the demands of governance, diplomacy, and warfare. The accession of James VI of Scotland to the English throne in 1603. Becoming James I of England, marked the beginning of the Stuart dynasty and inaugurated a new phase in the evolution of taxation in England. This period, extending from 1603 to the outbreak of the English Civil War in 1642, was characterized by a protracted conflict between the Crown and Parliament over the scope, nature, and legitimacy of fiscal authority. The early Stuart period witnessed the continued reliance on traditional revenue sources, customs duties, parliamentary subsidies, and prerogative taxation, amid rising royal expenditures and shifting political conditions. The inability of the Crown to adequately finance its activities through ordinary revenue alone led to increasing recourse to extra-parliamentary measures, which, over time, generated substantial constitutional controversy and culminated in civil conflict. The early years of James I's reign were marked by optimism and the hope of a peaceful and financially stable rule. However, James inherited a crown already burdened by debt, much of which had accumulated during the long reign of Elizabeth I, particularly due to military expenditures and the sale of crown lands. The revenue base was static, while royal spending, especially on court patronage and foreign policy, remained high. James, accustomed to the relatively modest governance of Scotland, quickly encountered the more robust English political culture in which Parliament expected to exercise control over taxation. One of James's first fiscal objectives was to increase royal revenue through customs duties, especially by expanding the use of impositions, or prerogative levies on imports and exports. The foundation for this policy was laid by the precedent of Elizabethan impositions, but it was under James that the practice was significantly enlarged. In 1606, James issued new impositions on a wide range of goods, including currants, silks, and tobacco, without parliamentary approval. The justification rested on royal prerogative and the Crown's control over foreign trade policy. This action provoked legal challenge, most notably in the case of Bates's case, 1606. John Bates, a merchant, refused to pay the imposition on currants, arguing it was an illegal tax. The Court of the Exchequer ruled in favor of the Crown, asserting that the king possessed the authority to regulate trade and impose duties without Parliament. This decision emboldened the Crown, and in 1608, James issued a new, greatly expanded Book of Rates, revising duties on over 1,400 items and significantly increasing revenue. The result was a considerable expansion of customs revenue, which grew to nearly £200,000 per annum by the 1610s. However, the political cost was considerable. Parliament viewed the impositions as an unlawful extension of royal power, infringing upon its traditional right to control taxation. This tension would persist throughout the Stuart period and contribute materially to later conflicts. James's government also continued to request parliamentary subsidies, but with increasing difficulty. The king summoned Parliament in 1604, 1610, and 1614, seeking grants to finance his administration and diplomatic efforts, including the Union of England and Scotland. However, relations between the Crown and Parliament were frequently acrimonious. The 1604 Parliament granted limited subsidies, while the 1610 Parliament became embroiled in the abortive Great Contract, a proposal by Robert Cecil, Earl of Salisbury, to exchange certain feudal rights for a regular parliamentary grant of £200,000 per year. The plan would have abolished wardship, purveyance, and other fiscal relics in exchange for guaranteed income, but mutual distrust and political resistance led to its collapse. The addled Parliament of 1614 failed to pass any legislation or grant any subsidies, hence its nickname. The breakdown of dialogue with Parliament compelled James to rely more heavily on extraordinary fiscal expedients, such as forced loans, loans requested from wealthy subjects. With an implicit threat of punishment for refusal, sale of honors and titles, James greatly expanded the sale of baronetcies and knighthoods, monetizing social aspiration as a source of revenue, monopolies, exclusive rights granted to individuals or companies for trade or production, often in return for a fee or share of profits. These practices provided short-term relief but fueled growing resentment among parliamentarians and the wider population. By the later years of James's reign, his reputation for fiscal irresponsibility and extravagance was well established. Upon James's death in 1625, his son Charles I ascended the throne. Charles inherited not only a chronically underfunded crown but also a deepening political rift between the monarchy and Parliament. His marriage to Henrietta Maria of France, a Catholic, exacerbated existing religious tensions, while his desire for an active foreign policy, including support for Protestant causes in the 30 Years' War, required substantial financial outlays. The first Parliament of Charles's reign granted only 2 subsidies, totaling around £140,000, and limited his grant of tonnage and poundage, normally awarded for life, to a single year. Charles, however, continued to collect these duties without parliamentary sanction, a move widely viewed as illegal. Parliament's growing suspicion of royal fiscal overreach was further inflamed by the king's sponsorship of unpopular military expeditions, such as the failed Cadiz expedition in 1625 and the La Rochelle campaign in 1627. With parliamentary cooperation in decline, Charles revived and expanded the use of forced loans in 1626–27, raising over £260,000. This measure was deeply resented and led to widespread resistance, including the arrest of several prominent gentry who refused to comply. The ensuing legal confrontation, notably the Five Knights case, underscored the constitutional stakes of fiscal conflict. In response to growing tensions, Parliament in 1628 presented the Petition of Right, demanding that the king cease extra-parliamentary taxation, unlawful imprisonment, and billeting of soldiers. Charles assented but continued to collect tonnage and poundage, prompting further parliamentary opposition. When the 1629 Parliament began debating the legality of these collections, Charles dissolved it and commenced what became known as the Personal Rule or the 11 Years' Tyranny, 1629–1640. During the Personal Rule, Charles governed without Parliament, relying on fiscal innovations and prerogative revenue to finance his administration. Chief among these were ship money, originally a levy on coastal counties to fund naval defense. Ship money was extended to inland counties beginning in 1635 and made an annual nationwide tax. It was imposed without parliamentary consent and framed as a national security measure. The tax proved lucrative, yielding over £200,000 per year at its peak, but provoked widespread opposition, revival of obsolete fines and forest laws. The government revived long-dormant fiscal rights, such as fines for encroachment on royal forests or non-compliance with outdated building codes. These actions were often perceived as arbitrary and unjust. Distraint of knighthood, individuals with incomes above a certain threshold were fined for failing to present themselves at the king's coronation to receive knighthood. A feudal obligation not enforced since medieval times, these measures, though financially effective in the short term, deepened popular and elite resentment of what was seen as fiscal absolutism. Legal challenges were mounted against ship money, most famously by John Hampden in 1637. Though the Court of Exchequer upheld the Crown's right to levy ship money, the case galvanized opposition and further delegitimized Charles's financial policy. Despite these revenue efforts, the fiscal situation remained precarious. In 1639, Charles launched the Bishops' Wars against Scotland in response to resistance to his attempts to impose Anglican liturgy on the Scottish Church. The military campaigns required additional funding, but without Parliament, Charles was constrained in his options. The failure of the 1639 campaign and continued Scottish resistance forced him to recall Parliament in April 1640, initiating the Short Parliament, which refused to grant funds and was dissolved after 3 weeks. Mounting pressure, including the Scottish occupation of northern England, compelled Charles to summon the Long Parliament in November 1640. This parliament swiftly moved to curtail royal fiscal powers. It passed legislation to abolish ship money, monopolies, and the Court of Star Chamber, which had been used to enforce fiscal policy. Parliament also asserted its control over the raising of funds and the governance of the military. By 1642, disputes over fiscal sovereignty had become inseparable from broader political and religious tensions. The Crown's repeated use of extra-parliamentary taxation, perceived violations of property rights, and failure to heed parliamentary consent had undermined the traditional constitutional balance. The refusal of Parliament to fund the king without major concessions, combined with Charles's attempts to arrest parliamentary leaders, led to armed conflict. Thus, the English Civil War emerged not merely from religious or ideological causes, but also from a long-standing and intensifying conflict over taxation and the control of state finance. The fiscal system under the early Stuarts had proven inadequate to meet the needs of a modernizing state, and efforts to circumvent parliamentary control created a political crisis that fiscal improvisation could no longer avert. The period from 1642 to 1660 marks a significant and complex chapter in the evolution of British taxation, spanning the English Civil War, the Interregnum, and the brief but transformative era of the Commonwealth and Protectorate. The collapse of royal authority and the emergence of rival political powers necessitated profound shifts in fiscal policy, including the development of new taxation mechanisms, the institutionalization of emergency levies, and the centralization of financial administration under Parliament. During this time, fiscal policy was inextricably tied to military exigency, ideological transformation, and the radical restructuring of governance. The Civil War and subsequent regimes created conditions for experimentation, coercive revenue extraction, and eventually, the professionalization of tax collection practices that laid groundwork for future fiscal systems. At the outbreak of hostilities in 1642, the issue of fiscal sovereignty was central. The Long Parliament, having repudiated extra-parliamentary taxation and asserting control over national revenues, found itself in need of substantial financial resources to maintain an army and civil administration. Similarly, King Charles I, now removed from the traditional apparatus of state finance in London, had to develop alternative revenue streams to support his cause. Thus, both royalist and parliamentarian factions embarked on improvised and often parallel tax regimes to fund their respective war efforts. One of the earliest and most important fiscal innovations on the parliamentarian side was the weekly assessment, first introduced in 1643. Modeled in part on earlier subsidies, the weekly assessment was designed as a regular and predictable means of raising revenue from property owners, including landowners, merchants, and wealthier artisans. The assessments were set at varying rates across counties, often reflecting local wealth and strategic importance. Originally intended as a temporary wartime measure, the assessments were periodically renewed and became the backbone of Parliament's war finances. Unlike traditional subsidies, which required elaborate parliamentary negotiation and were infrequent, Assessments were imposed by ordinance and collected through local commissioners, enabling more rapid and reliable revenue generation. Alongside the weekly assessment, Parliament employed a range of supplementary fiscal tools, including sequestration of royalist estates. Parliament passed ordinances authorizing the confiscation of property belonging to known royalist supporters. Committees for sequestrations were established to identify, seize, and manage lands, rents, and goods, with proceeds directed to the war effort. Delinquency fines: those who supported or aided the king, designated as delinquents, were fined, often heavily. These fines could be compounded, meaning the offender paid a negotiated sum in lieu of further penalty, thereby generating considerable income while offering a pathway to reintegration. Excise duties, first introduced in 1643, excise duties represented a significant departure from prior English fiscal tradition. Modeled on Dutch practices, these levies were imposed on the manufacture and sale of goods such as beer, spirits, meat, and salt. Although initially highly unpopular, the excise proved both efficient and profitable, quickly surpassing traditional customs in importance. Customs duties: Parliament controlled the Port of London and other key trading centres, enabling it to continue the collection of customs revenue. In contrast, royalist forces were largely cut off from maritime trade and thus heavily disadvantaged in this area. On the royalist side, revenue collection was more fragmented and improvised, relying heavily on traditional royal rights, personal contributions from supporters, and loans. Key sources included compositions and forced loans. Royalist commissioners raised funds by compelling contributions from local populations, often under threat of confiscation or imprisonment. Monetization of crown assets: where feasible, Charles's agents attempted to raise money by pledging or selling crown lands and valuables. Although opportunities were limited, local taxation: in royalist-controlled regions, local gentry were frequently tasked with organizing ad hoc tax collections, requisitions, and levies, many of which suffered from inconsistent enforcement and corruption. The increasing superiority of parliamentarian fiscal mechanisms, especially the excise and assessments, played a significant role in sustaining their war machine and ultimately securing military victory. By 1646, when Charles surrendered to Scottish forces, Parliament controlled the vast majority of national territory and revenues. With the war concluded, attention turned to the consolidation of power and financial reform. The Second Civil War in 1648 and the subsequent trial and execution of Charles I in 1649 further accelerated the transformation of fiscal governance. The monarchy and House of Lords were formally abolished, and a Commonwealth of England was declared. The new Republican regime faced the dual challenge of legitimizing its authority and funding a standing army, naval expansion, and colonial ambitions. During the Commonwealth period, 1649 to 1653, taxation remained under the control of Parliament and its appointed committees. Fiscal policy emphasized continuity with wartime methods but also introduced refinements. The monthly assessment. The weekly assessment was replaced in 1649 by the monthly assessment, which maintained the structure but increased the scale. Assessments were calculated based on property values and raised substantial income, averaging over £60,000 per month at their peak. Excise system expansion. Excise coverage was extended to a broader range of goods and services, including leather, soap, and textiles. To administer these duties, a centralized excise office was developed, staffed with salaried commissioners and inspectors. The system demonstrated increasing professionalization and efficiency. Continuation of sequestrations and compositions. Royalist estates continued to be targeted for revenue, with renewed efforts to identify hidden assets and extract fines. Committees operated across counties to enforce these measures. Sale of crown and church lands. The abolition of the monarchy and episcopacy allowed for the large-scale sale of royal parks, palaces, and episcopal estates. These sales provided windfall revenues and altered the landscape of property ownership in England, especially benefiting commercial and political elites aligned with the regime. Decimation tax, 1655, under Oliver Cromwell's later protectorate government, a specific 10% income tax was levied on former royalists to fund the military occupation of the provinces by major generals. Though unpopular, it reflected the regime's reliance on coercive fiscal instruments to maintain control. The Protectorate, established in 1653 under the instrument of government, saw the formal centralization of state power in Cromwell as Lord Protector. Although nominally constitutional, the regime governed through ordinances and military support. Under Cromwell, fiscal administration became more rationalized. Treasury organization, the office of Treasurer of the Army became crucial, overseeing the bulk of national expenditure. Revenues were increasingly directed toward maintaining the standing army and navy, taxation without parliament. While the Protectorate convened parliaments, they were frequently dissolved for resistance to fiscal policies. This continued the trend of taxation by executive decree, which had first emerged under Charles I and had contributed to the civil conflict. Despite the increasing sophistication of revenue collection, the regime faced persistent fiscal shortfalls. Military expenditure remained high, exceeding £1 million annually in some years, necessitating continued reliance on assessments and excise. Attempts to create a more stable and less coercive tax base met with limited success. Constrained by political instability and popular resistance, the death of Cromwell in 1658 and the succession of his son Richard Cromwell led to a rapid deterioration of central authority. Richard lacked the political support and military leadership to maintain control. And by 1659, the Protectorate had effectively collapsed. Financial administration fell into confusion, with competing authorities and arrears in military pay. By 1660, the financial and political exhaustion of the Commonwealth experiment led to the restoration of Charles II. The returning monarchy faced the immediate challenge of reconstructing the fiscal system. However, many of the innovations developed during the Civil War and interregnum, particularly the excise, assessments, and bureaucratic administration, had demonstrated their utility and would be retained, albeit under different political auspices. Thus, the period from 1642 to 1660 represents a watershed in the history of English taxation. In the crucible of war and revolution, traditional sources of royal revenue collapsed, and new, more extractive and centralized fiscal mechanisms emerged. While the legitimacy of taxation without parliamentary consent remained contested, the practical achievements of excise systems, regular assessments, and bureaucratic infrastructure profoundly influenced the later fiscal state. The era also demonstrated the extent to which taxation could serve as both an instrument of governance and a source of political instability when disconnected from broader consensus and institutional checks. The restoration of Charles II in 1660 marked the revival of the monarchy after the tumultuous period of the English Civil War and the interregnum. This era brought about a return to many traditional royal prerogatives, but it also laid the foundations for significant changes in fiscal policy and the development of state finance. The restoration of the monarchy, however, did not result in an immediate return to the pre-Civil War system of taxation. Rather, the fiscal landscape of the monarchy evolved to meet the demands of a more complex and financially pressing environment. The period from 1660 to 1688 is characterized by the gradual consolidation of fiscal authority, the expansion of taxation systems, and the establishment of new revenue sources to fund the growing administrative and military costs of the state. The Restoration saw the continued importance of excise taxes, customs duties, and assessments, but also the creation of new fiscal mechanisms to support the military, particularly during periods of war. Upon his return, Charles II inherited a kingdom deeply in debt, with the remnants of the Commonwealth government's fiscal structure still in place. The kingdom faced substantial financial challenges, including an enormous national debt that had accrued during the Civil War and the interregnum. Much of this debt had been incurred by the parliamentary government to fund military campaigns. And it was a significant burden on the new king's treasury. The most immediate task for the Restoration monarchy was to stabilize the nation's finances while simultaneously asserting royal control over the financial system, which had become more decentralized during the Commonwealth period. One of the first measures that Charles II and his advisors implemented was a substantial reorganization of taxation and revenue collection. The Exchequer, which had been sidelined during the Commonwealth period, was re-established as the primary institution for managing the nation's finances. The government continued to rely heavily on traditional forms of taxation, such as land taxes and customs duties, but there was also a shift towards newer forms of revenue generation. One of the most important of these was the excise duty, which had been a significant source of income during the Commonwealth period. The excise was continued under Charles II and expanded to cover a broader range of goods, including tobacco, salt, and beer. The excise proved to be an efficient and relatively stable source of revenue, and it would become one of the cornerstones of English fiscal policy for centuries to come. Alongside the excise, the monarchy continued to rely on customs duties to generate income. Customs duties had been a staple of royal revenue for centuries, but their importance increased after the Restoration as the government sought to expand trade and increase revenue from maritime commerce. The Customs Office became one of the most important institutions of fiscal governance, overseeing the collection of duties on imports and exports. The Navigation Acts of 1651 and 1660, which sought to regulate trade and ensure that it was carried out by English ships, also played a role in bolstering customs revenue. The acts were designed to strengthen the English merchant fleet, and they provided a significant source of income for the crown. Despite these revenue measures, Charles II government faced significant financial difficulties. The Royal Navy, which was essential for defending the kingdom and maintaining Britain's global influence, was in need of modernization and expansion. The costs of maintaining and expanding the Navy were staggering, and the government was forced to turn to new and more innovative sources of revenue. One of the most notable of these innovations was the land tax, which was first introduced in the late 17th century. The land tax was based on the value of land and property, and it was designed to provide a more stable and predictable source of income for the government. While the land tax was not a new concept, its implementation on a national scale marked a significant shift in the fiscal landscape. One of the most important developments during the Restoration period was the emergence of public debt as a significant feature of the British fiscal system. In order to finance the wars that were a constant feature of the period, the monarchy increasingly turned to borrowing. This borrowing was initially done through the sale of government bonds, which were issued to raise funds for military and administrative expenses. Over time, this system of borrowing became more institutionalized, and the government began to issue bonds that were traded on the open market. The rise of public debt was a major shift in the British fiscal system, as it marked the beginning of the state's dependence on credit and borrowing to finance its activities. The government's increasing reliance on borrowing led to the creation of the Bank of England in 1694, which became a crucial institution in the financing of the state. The Bank of England was established as a private bank, but it quickly became the government's primary source of credit. The bank's creation was a direct response to the financial pressures facing the government, particularly the need to finance the war with France. The establishment of the Bank of England marked a key moment in the development of the British financial system, as it allowed the government to borrow more easily and manage its debt more effectively. The fiscal policies of the Restoration period were also shaped by the growing power of Parliament. While Charles II was able to assert royal control over the financial system, he was often forced to rely on parliamentary support to secure funding for his government. This was particularly true during times of war, when the government needed large sums of money to finance military campaigns. The revenue bills that were passed by Parliament during the Restoration period often contained detailed provisions for taxation, and the king was required to submit to parliamentary approval in order to raise money. This period thus saw the increasing role of Parliament in the fiscal decision-making process, particularly in relation to taxes and public spending. Throughout the Restoration, the government was also forced to contend with economic pressures such as inflation, fluctuations in commodity prices, and the need to maintain a stable currency. The Great Recoinage of 1696, which was aimed at addressing the problem of debased currency, was one of the most significant fiscal reforms of the period. The recoinage involved the recall and reminting of coins that had been devalued due to the debasement of the currency during the Civil War and the interregnum. The recoinage was a complex and costly process, but it helped to restore confidence in the currency and stabilize the economy. The fiscal reforms and innovations of the Restoration period laid the groundwork for the financial revolution that would take place in the early 18th century. The growing reliance on excise duties, customs duties, and public debt, combined with the creation of the Bank of England, transformed the British fiscal system into one that was more centralized, more professional, and more reliant on credit and borrowing. These changes would have far-reaching consequences for the development of the British state and its ability to fund wars, maintain a standing army, and manage the complexities of an increasingly global economy. However, the fiscal policies of the Restoration period were not without their challenges and limitations. The government's reliance on borrowing led to concerns about debt accumulation, and there were ongoing debates about the long-term sustainability of the fiscal system. Moreover, the financial pressures facing the monarchy were exacerbated by the ongoing military conflicts in Europe, particularly the wars with France. These wars, combined with domestic political instability, would eventually lead to further transformations in the fiscal system under the reign of James II. In conclusion, the Restoration period was a time of significant fiscal consolidation and innovation in England. The government's reliance on traditional forms of taxation, such as excise and customs duties, was complemented by the introduction of new fiscal instruments, such as the land tax and public borrowing. The establishment of the Bank of England and the increasing importance of Parliament in the financial decision-making process marked a pivotal moment in the development of the British fiscal system. Despite the challenges faced by the monarchy, the fiscal reforms of the Restoration period laid the foundations for the financial revolution that would follow and set the stage for the development of the modern British state. The period between 1688 and 1702 marks a fundamental transformation in the nature of fiscal governance in England, brought about by the constitutional and political changes following the Glorious Revolution. The deposition of James II and the accession of William III and Mary II inaugurated a new era in which the relationship between the Crown and Parliament was substantially redefined, particularly in matters of taxation, public finance, and fiscal accountability. This era witnessed the acceleration of trends that had begun during the Civil War and the interregnum, including the centralization of revenue collection, the increasing institutionalization of borrowing and debt finance, and the embedding of parliamentary control over the purse strings of the state. It is during this period that many historians locate the beginning of the so-called fiscal military state, wherein the government of England developed a sophisticated financial apparatus capable of sustaining large-scale warfare through taxation and long-term credit. The Bill of Rights of 1689 was central to this transformation. One of its key provisions established that the monarch could not levy taxes or maintain a standing army in peacetime without the consent of Parliament. This provision effectively eliminated the possibility of royal taxation without parliamentary approval and established Parliament as the primary authority over national finance. The result was a sharp increase in the frequency and regularity of parliamentary sessions, which became the routine arena for the negotiation, authorization, and supervision of taxation. Fiscal policy became increasingly tied to legislative procedure, and the annual grant of supply by Parliament was institutionalized as a constitutional norm. The broader geopolitical context of this period also played a decisive role in shaping fiscal policy. The 9 Years' War, 1688–1697, against France, waged by the Grand Alliance led by William III, necessitated unprecedented levels of public expenditure. This conflict marked the first major European war in which England was financially and militarily engaged on a continental scale for nearly a decade. The costs associated with outfitting and maintaining large armies, expanding the Royal Navy, and supporting continental allies placed extraordinary demands on the state's financial resources and spurred new forms of revenue generation. One of the most significant developments was the evolution of direct taxation, particularly through the use of land taxes. First introduced in 1692 as a temporary measure to support the war effort, the land tax rapidly became a fixture of English public finance. The tax was levied on the rental value of land, calculated based on assessments dating from 1692. It was notable for its broad geographic reach and its relatively stable yield. Although its incidence was uneven and collection often difficult, the land tax consistently raised substantial sums, becoming the backbone of wartime revenue throughout the late 17th and early 18th centuries. The land tax also represented a shift from the older system of subsidies and assessments. Reflecting a more rationalized and standardized approach to direct taxation, in addition to direct taxes, the government expanded its use of indirect taxes, particularly through the excise system and customs duties. The excise was extended to a growing number of commodities, including salt, paper, candles, and glass. These duties were typically levied at multiple stages of production and distribution, and their collection required a growing bureaucratic infrastructure. The excise office became one of the most important organs of the state, staffed by a large and increasingly professional corps of commissioners, surveyors, and collectors. The customs system likewise experienced institutional growth. With the establishment of customs commissioners and tighter regulation of ports and trade, the combination of excise and customs duties formed a dual system of indirect taxation that yielded consistent revenue, although not without popular resentment and periodic evasion. The most momentous fiscal development of the 1690s, however, was the institutionalization of public credit. The government's reliance on borrowing to finance the war effort led to the creation of a national debt, formalized through the issuance of government securities backed by parliamentary authority. A wide range of financial instruments were employed, including annuities, lotteries, life-term loans, and bills of exchange. Credit was extended by merchants, bankers, and individual investors in exchange for the promise of future repayment with interest. The political stability following the Glorious Revolution, combined with the regularity of parliamentary supply, encouraged confidence among creditors and facilitated access to capital on increasingly favorable terms. The establishment of the Bank of England in 1694 was the linchpin of this new credit regime. Chartered by an Act of Parliament, the bank was founded by a group of private investors who subscribed £1.2 million to the government in return for incorporation and the right to issue banknotes. The funds were used to support the war effort, and in return, the bank became the government's primary fiscal agent. The Bank of England acted as a depository for public funds, a manager of state borrowing, and a stabilizing force in the financial system. Its ability to issue notes redeemable in coin made it a crucial institution for liquidity and fiscal reliability, to support the repayment of loans and interest. Parliament created specific tax revenues, known as funds, which were earmarked to service particular debts. This system of hypothecation helped reassure investors by ensuring that their returns were directly linked to predictable revenue streams. One of the earliest examples was the Tonnage Act of 1694, which allocated duties on wine and tobacco imports to service the Bank of England's loan. Over time, the linkage between taxes and debt servicing became a defining feature of the English fiscal system. The administration of debt required new bureaucratic mechanisms. The auditors of imprest, the commissioners of public accounts, and various treasury officials were tasked with overseeing expenditure, auditing balances, and reporting to Parliament. These institutions introduced a level of fiscal oversight and transparency previously unknown in English governance. Reports were often published, scrutinized, and debated in Parliament, leading to a growing public awareness of state finance. The creation of sinking funds, which aimed to reduce the principal of outstanding debt over time, signaled a shift toward long-term debt management. Although not always successful in reducing overall liabilities, these mechanisms reflected the maturation of fiscal thought and practice. A permanent funded debt became an accepted element of the financial landscape, reshaping the relationship between government, taxpayers, and creditors. As the state expanded its borrowing and taxation, it also became more involved in economic regulation. The Treasury and associated offices exercised increasing influence over trade policy, coinage, and commodity markets. The state's fiscal reach now extended into the everyday economic lives of its subjects. Taxation touched a growing proportion of goods and activities, and evasion or resistance could bring severe penalties. The criminalization of smuggling, counterfeiting, and fraud became more extensive, with specialized courts and enforcement mechanisms. The increasing burden of taxation and the centralization of fiscal authority did provoke criticism and occasional unrest. Pamphlets, tracts, and sermons decried the moral and economic consequences of excessive taxation. Some critics warned of the dangers of a moneyed interest gaining undue influence over national policy. Others feared that the reliance on debt would enslave future generations. Nevertheless, the fiscal system proved resilient, and it underpinned England's ability to sustain prolonged warfare, expand its empire, and compete with rival European powers. The death of Queen Mary in 1694 and the continued reign of William III until 1702 saw the further entrenchment of this fiscal architecture. By the end of his reign, the state was collecting over £5 million annually in taxes, servicing a growing national debt, and employing thousands of officials across a wide array of revenue departments. The king's government had become increasingly reliant on the support of Parliament, city financiers, and tax-paying elites. In return, those constituencies gained influence over policy, appointments, and the administration of public finance. The Glorious Revolution thus marks the institutional birth of modern fiscal governance in Britain. The supremacy of Parliament in taxation, the development of a professional revenue bureaucracy, the rise of public credit, and the emergence of financial institutions like the Bank of England laid the structural foundations for the fiscal military state. These developments were not merely technical but had far-reaching constitutional and social implications. They redefined the nature of political authority, the obligations of citizenship, and the relationship between economic power and public policy. The reign of Queen Anne, spanning from 1702 to 1714, was marked by substantial developments in the fiscal structure of England, particularly in relation to war finance, national debt management, and the maturation of a centralized revenue system. The dominant external factor shaping fiscal policy during this period was the War of the Spanish Succession, 1701 to 1714, which required sustained military expenditure on an unprecedented scale. The financial demands of this prolonged conflict accelerated the evolution of what has come to be termed the fiscal military state, wherein taxation and borrowing mechanisms were systematically organized to fund continuous warfare. This period witnessed not only the expansion of existing revenue sources, such as land taxes and customs duties, but also the introduction of more structured debt instruments, the professionalization of the financial bureaucracy, and an increasingly integrated relationship between the state and emerging financial institutions. At the beginning of Queen Anne's reign, the national debt stood at approximately £12 million, a result of borrowing to support earlier military engagements, especially the 9 Years' War. By the end of her reign in 1714, the debt had expanded to roughly £36 million, a threefold increase reflective of the intensification of military conflict and the increasingly entrenched reliance on public credit. This expansion was made feasible by the growing confidence of lenders, the efficiency of the fiscal bureaucracy, and the political stability following the Glorious Revolution, which had established Parliament's supremacy in fiscal matters. The War of the Spanish Succession placed immediate demands on the treasury. The need to support Allied armies in Europe, maintain naval superiority, and fund domestic military preparations led to enormous expenditure. Annual military spending during the war often exceeded £6 million, a substantial figure in relation to the overall size of the economy. The state responded by mobilizing both taxation and credit in increasingly sophisticated ways. The land tax remained a primary source of direct revenue. Although originally intended as a temporary wartime levy introduced in 1692, it had by Anne's reign become effectively permanent. Parliament voted the land tax annually, and the standard rate of 4 shillings in the pound, equivalent to 20% of assessed rental value, became customary during wartime. The yield of the land tax was subject to regional variation and administrative difficulty, but it remained the most significant direct tax throughout the early 18th century. The tax was assessed and collected locally by unpaid commissioners drawn from the landed gentry, reinforcing the political alignment of the landed classes with the fiscal demands of the state. Customs duties formed another pillar of government finance. The growing importance of maritime trade, especially with the American colonies, the West Indies, and Asia, ensured that import and export duties provided a reliable stream of income. Commodities such as sugar, tobacco, tea, and textiles were heavily taxed. The Customs Administration continued to expand, with increased regulation, more systematic accounting, and tighter enforcement to reduce smuggling and fraud. Revenue from customs was enhanced by the imposition of new duties and the increase of existing ones in wartime, often ratified by Parliament in response to specific military needs. Excise taxes were also broadened in scope. These taxes, levied on domestic consumption and production, had long been unpopular due to their visibility and intrusive enforcement, but they proved to be stable and predictable sources of revenue. During Anne's reign, excises were extended to additional goods, including malt, soap, and candles. These taxes were collected by a centralized bureaucracy that employed a large number of officers, supervisors, and auditors. The system of excise collection became more standardized, with detailed instructions for measuring, assessing, and recording taxable goods. Despite persistent complaints and sporadic resistance, excise revenue formed a vital part of the state's wartime income. To support borrowing, the state developed increasingly elaborate mechanisms for managing the national debt. The issuance of government annuities, first introduced in the 1690s, became more widespread. Investors were invited to lend money to the state in exchange for a guaranteed annual return, often tied to specific revenue streams. These annuities were structured either for a fixed term or for the life of the subscriber. While the rates offered varied, they generally ranged between 5 and 8%, depending on market conditions and perceived risk. The popularity of these instruments was reinforced by the state's commitment to regular interest payments, backed by parliamentary taxation. An important innovation during this period was the creation of the so-called funded debt. In contrast to earlier, short-term borrowing, funded debt referred to loans that were tied to permanent taxes and managed through structured financial instruments. The interest on such debt was funded, meaning that it was serviced from predictable revenue sources, often those granted by Parliament for the purpose. For example, duties on coal, wine, or paper might be earmarked to pay interest on a specific loan. This system provided security to creditors and allowed the government to borrow at lower interest rates. The Bank of England, chartered in 1694, assumed an increasingly central role in this process. During Anne's reign, the bank acted as the government's principal financial intermediary. It managed the issue of government bonds, processed interest payments, and coordinated with the Treasury to ensure liquidity. The bank also extended short-term advances to the government during periods of revenue shortfall, allowing the state to smooth its cash flow and avoid default. The close relationship between the Bank of England and the Treasury exemplified the growing institutionalization of public finance. In addition to the bank, a number of joint stock companies played a role in government finance. The East India Company, the South Sea Company, and others were granted charters and trading privileges in return for substantial loans to the government. These companies also purchased portions of the national debt and received interest payments in the form of trading monopolies or other privileges. This entanglement of commercial and governmental finance led to the emergence of what some contemporaries called the moneyed interest, a class of investors and financiers whose fortunes were tied to the fiscal and political stability of the state. The administrative machinery of taxation and finance also grew significantly. The Treasury, the Exchequer, the Commissioners of Customs and Excise, and the Auditors of Imprest all expanded their personnel, routines, and documentation practices. Financial management became more centralized and accountable. Regular audits were conducted, receipts were tallied, and reports were submitted to Parliament. The Commission for Public Accounts, first created in 1690, continued its work during Anne's reign, examining expenditures and recommending reforms. Although corruption and inefficiency persisted, the trend was toward greater transparency and professionalization. The fiscal burden was not evenly distributed. The land tax disproportionately affected landowners, though many of them wielded the political power to control assessments. Excise taxes fell most heavily on the urban and lower-income population, who consumed the taxed goods. Customs duties affected merchants and consumers of imported goods. Nevertheless, the overall system was tolerated, if not universally welcomed, due in large part to its parliamentary foundation. The annual budget process, public debates, and printed fiscal reports ensured a measure of public engagement and legitimacy. Contemporaries were aware of the novelty and scale of the emerging fiscal state. Political writers such as Jonathan Swift, Daniel Defoe, and various pamphleteers commented frequently on the expansion of government finance. Some celebrated the efficiency and patriotic utility of the fiscal system, others decried the moral hazards of debt, speculation, and financial dependence. The South Sea bubble was still a decade away, but anxieties about speculative finance were already taking root. By the end of Queen Anne's reign, the English state had become a permanent debtor, with a revenue system robust enough to support continuous warfare. Annual tax revenue exceeded £6 million, while interest payments on the debt consumed roughly half of all government expenditure. The scale and complexity of the fiscal system were unprecedented in English history. The state had forged a new relationship with its subjects, one grounded not only in sovereignty and law, but in revenue and credit. The Treaty of Utrecht in 1713 brought the War of the Spanish Succession to an end, and with it a temporary easing of fiscal pressures. However, the underlying structures built during Anne's reign remained intact. The tax system was not dismantled, the debt was not repaid, and the financial institutions continued to operate. The fiscal military state, born of war and honed through necessity, had become the permanent foundation of British government. The period following the accession of George I in 1714 inaugurated a phase of relative fiscal stability for the British state. Having emerged from the costly War of the Spanish Succession under Queen Anne, the government's primary objective during the early Georgian era was to consolidate the financial and administrative structures that had been developed over the previous decades. This involved the regularization of revenue collection, the management of the growing national debt, the stabilization of public credit, and the mitigation of fiscal shocks. The political ascendancy of the Whigs, the expansion of financial institutions, and the sustained peace during much of this period allowed the government to pursue a policy of fiscal prudence, debt servicing, and bureaucratic rationalization. However, the apparent calm of the 1720s was dramatically interrupted by the South Sea Bubble in 1720, a major financial crisis that exposed the speculative underpinnings of government finance and led to substantial institutional reforms. Nevertheless, the state continued to rely heavily on the taxation-credit nexus, with a strong emphasis on parliamentary oversight, creditor confidence, and administrative professionalism. By 1714, the national debt had risen to around £36 million, a consequence of the long-standing reliance on borrowing to finance warfare. The priority under George I and later George II was to service this debt reliably without significantly increasing its overall burden. To this end, a variety of mechanisms were employed, including debt consolidation, refinancing at lower interest rates, and the introduction of sinking funds designed to retire debt over time. The Sinking Fund Act of 1716, introduced under the guidance of Robert Walpole, then First Lord of the Treasury and de facto Prime Minister, marked an important step in formalizing the process of debt reduction. The fund was to be maintained by surpluses in the budget and used to purchase government securities on the open market, thereby reducing the supply of outstanding debt instruments. The reliability of tax revenues was central to this debt management strategy. The land tax continued to be voted annually by Parliament, though often at reduced rates compared to the war years. From 1717 to 1733, the standard rate was reduced to 2 shillings in the pound, or 10% of assessed rental value, reflecting the government's commitment to fiscal moderation. Nonetheless, the land tax remained a critical source of income, consistently generating between £1.5 and £2 million per annum. As before, the tax was collected by unpaid local commissioners, primarily drawn from the landed gentry, reinforcing the socio-political bond between the landowning classes and the financial machinery of the state. Customs duties and excise taxes remained the most significant components of indirect taxation. The volume of maritime trade expanded during this period, and customs revenues increased accordingly. Duties on sugar, tobacco, coffee, textiles, and a variety of manufactured goods produced a stable and predictable flow of income. The government made efforts to simplify the tariff structure, reduce smuggling, and improve the efficiency of customs collection. The Board of Customs, operating under a centralized hierarchy of commissioners and inspectors, oversaw the application of tariffs at ports throughout the kingdom. Smuggling remained a persistent problem, particularly along the southern and eastern coasts. But the use of customs cutters, legal prosecutions, and financial incentives for informants formed part of an ongoing enforcement strategy. The excise system also saw expansion and administrative reform. Taxes on domestically consumed goods, most notably beer, spirits, salt, soap, candles, and leather, were levied through a complex web of assessments, inspections, and collections. Excise officers, often the target of public disdain, were authorized to enter premises, inspect storage, and measure production quantities. The centralization of excise collection led to increased standardization of record-keeping, greater accountability, and more consistent yields. The excise office in London became a model of bureaucratic order, complete with training manuals, audit procedures, and hierarchical supervision. By the 1730s, the excise was generating more than £3 million annually, representing over a third of total government revenue. Despite the administrative progress and relative fiscal calm of the 1710s, the speculative mania surrounding the South Sea Company would soon destabilize the financial landscape. The South Sea Company, founded in 1711, had been granted a monopoly on British trade in Spanish South America. In exchange for its charter and privileges, the company assumed portions of the national debt and was promised annual interest payments funded by taxes. The company's role in debt conversion expanded in 1720, when a major debt-for-equity swap was arranged. Holders of government annuities were encouraged to convert their holdings into shares of South Sea stock. The expectation of lucrative trade profits, combined with government backing, sparked a frenzy of speculation. In the first half of 1720, the price of South Sea Company stock soared from £100 to over £1,000 per share. The speculative boom spread throughout London and beyond, drawing in investors from all social classes. Financial derivatives, joint stock enterprises, and various speculative schemes proliferated. However, by the autumn of 1720, confidence collapsed and stock prices plummeted. Thousands of investors suffered severe losses. The South Sea Bubble, as it came to be known, represented the first large-scale financial crisis in British history. The government responded with a series of inquiries, prosecutions, and legislative reforms. A parliamentary committee uncovered widespread corruption, including bribery of officials and manipulation of stock prices. Several directors of the company were stripped of their assets. The crisis severely damaged public trust in financial institutions and led to demands for stricter oversight of government debt operations. Despite the turmoil, the core structures of public finance remained intact. The Bank of England, which had avoided direct involvement in the South Sea scheme, emerged with its credibility enhanced. It played a stabilizing role during the crisis, providing liquidity and helping to restore investor confidence. The national debt, though affected by the bubble's aftermath, continued to be serviced. Annual interest payments were maintained, and tax revenues proved sufficient to support ongoing obligations. In the aftermath of the crisis, Walpole instituted a number of fiscal and administrative reforms. He consolidated government borrowing, refinanced high-interest debt at lower rates, and strengthened the oversight of chartered companies involved in debt holding. The Bubble Act of 1720, passed in the wake of the crisis, prohibited the formation of joint stock companies without a royal charter. Though often criticized for stifling innovation, the act reflected the government's intent to prevent future speculative excesses. Throughout the 1720s and 1730s, the sinking fund remained a central element of debt policy. Though its effectiveness in reducing overall indebtedness was mixed, often funds were diverted to other uses. It symbolized the government's rhetorical and political commitment to fiscal responsibility. The interest rate on government securities gradually declined, reflecting renewed confidence in public credit. By 1739, the total national debt stood at approximately £46 million. A modest increase over 1714 levels, especially when considered in light of expanding trade and national income. The administrative machinery of revenue collection continued to expand. The Treasury operated as the central coordinating body, while specialized boards managed customs, excise, and stamp duties. The commissioners for public accounts periodically reviewed expenditures, audited receipts, and recommended reforms. A growing class of clerks, accountants, inspectors, and field agents formed a permanent fiscal bureaucracy, increasingly insulated from partisan interference. During this time, the government also expanded its use of stamp duties, first introduced in the late 17th century. These taxes were levied on legal documents, newspapers, pamphlets, playing cards, and a wide variety of paper goods. Stamp duties offered a relatively non-intrusive method of raising revenue, and they were administered by a specialized office with clear documentation and centralized oversight. The absence of large-scale military conflict during much of George I and George II early reigns allowed for the stabilization of fiscal policy. However, the outbreak of the War of Jenkins' Ear in 1739, and its eventual merging with the War of the Austrian Succession, marked a return to the fiscal pressures of wartime. Parliament responded by raising the land tax rate to 4 shillings in the pound and authorizing new loans. Excise and customs revenues also increased as a result of expanded military provisioning and trade regulation. By 1742, at the end of the period under consideration, the British state had solidified the institutional features of its fiscal regime: a diversified tax base, a functioning public debt system, a centralized administrative apparatus, and a growing financial sector closely linked to government needs. The political and economic elite were deeply invested in the stability of the system, as landowners, merchants, and financiers all benefited from the regularity of tax collection and the dependability of interest payments. The events of this period, especially the South Sea Bubble and its aftermath, illustrated both the vulnerabilities and the resilience of Britain's fiscal architecture. While speculation and corruption could undermine confidence, the underlying framework of taxation, debt servicing, and administrative professionalism remained firm. These structures would be tested again in the decades to come, but by the mid-18th century, the British fiscal military state was a robust and adaptable entity, capable of sustaining both peacetime governance and large-scale warfare through integrated systems of taxation and credit. The period between 1742 and 1763 witnessed a marked expansion in the scale and complexity of British fiscal policy. Primarily driven by renewed military conflict and the administrative challenges of imperial governance. The War of the Austrian Succession, 1740 to 1748, and the 7 Years' War, 1756 to 1763, placed unprecedented demands on the state's capacity to mobilize revenue, manage debt, and maintain the confidence of creditors. In response, the government implemented a broad array of fiscal measures, including increased direct and indirect taxation, extensive borrowing, and reforms aimed at improving the efficiency and reach of fiscal administration. Moreover, this period marked the emergence of a more assertive fiscal relationship between the British government and its colonial possessions. Particularly in North America, where new forms of taxation and customs regulation were introduced as part of a broader strategy to integrate colonial resources into the metropolitan revenue system. The fiscal developments of this period not only reflected the expanding demands of imperial warfare but also laid the groundwork for the political tensions that would culminate in the American Revolution. By 1742, the national debt had risen to over £46 million, and the renewed conflict in Europe necessitated additional borrowing on a large scale. The land tax, which had been reduced to 2 shillings in the pound during peacetime, was promptly increased to 4 shillings in the pound at the outbreak of hostilities, effectively doubling the yield from landowners. This tax remained a principal source of wartime revenue, though its regressive nature and dependence on static assessments continued to be a source of contention. Parliament, comprised largely of landed interests, nevertheless approved the increases without sustained resistance, in recognition of the necessity of military expenditure and the broader political consensus supporting the war effort. In addition to the land tax, customs and excise duties were further expanded. Excise taxes were levied on an increasingly wide array of goods, including printed textiles, beer, soap, candles, and leather. Special wartime excise measures were introduced, targeting commodities associated with luxury consumption or foreign importation. The malt tax, first introduced in 1697, was adjusted periodically to reflect changes in grain prices and consumption patterns. The salt duty, another long-standing excise, remained in effect despite periodic calls for its abolition due to its burden on the poor and its interference with food preservation. Customs duties continued to serve as a critical component of the revenue system, benefiting from the continued expansion of Atlantic trade. The collection of customs was overseen by a centralized bureaucracy, the Board of Customs, with regional offices located at major ports. The increasing volume of imports and exports led to growing revenue, though smuggling remained a persistent problem. The government responded with stricter enforcement measures, including the deployment of revenue cutters, expanded powers of search and seizure, and harsher penalties for violations. The administrative apparatus of revenue collection was further professionalized during this period. The Excise Office and the Customs House implemented more detailed reporting systems, standardized forms, and improved audit procedures. Training for revenue officers was formalized, and performance reviews were instituted to monitor effectiveness. Advances in bureaucratic methods, including the use of double-entry bookkeeping and centralized ledgers, enhanced fiscal transparency and allowed for more accurate forecasting of revenue streams. The scale of borrowing during the War of the Austrian Succession was substantial. The government issued consols, consolidated annuities, and other long-term debt instruments to raise funds, often at favorable interest rates due to continued creditor confidence. By the end of the war in 1748, the national debt had grown to approximately £78 million. The sinking fund, originally established in 1716, was nominally maintained, though in practice its revenues were often diverted to cover immediate expenses. The reliability of tax receipts, particularly from excise and customs, underpinned the government's ability to service the debt and avoid default. Peace in 1748 offered a brief respite, during which limited reductions in tax rates were introduced and modest reforms were pursued. However, this interlude was short-lived. Rising tensions with France and its allies, competition for colonial markets, and disputes over territorial claims led to the outbreak of the 7 Years' War in 1756. This conflict, global in scope, placed the British fiscal system under extreme strain and required unprecedented levels of revenue mobilization. During the 7 Years' War, the British government engaged in a massive expansion of borrowing, increasing the national debt from approximately £78 million to over £130 million by 1763. Annual interest payments on the debt rose commensurately, consuming a growing share of government expenditure. To support this borrowing, the government expanded its base of taxable commodities, increased existing duties, and implemented more rigorous enforcement measures. The land tax was maintained at its wartime level of 4 shillings in the pound, and Parliament authorized the imposition of temporary taxes on windows, horses, coaches, and other luxury goods. The Stamp Act of 1756, applied within Britain, extended stamp duties to new categories of documents and commercial transactions. The administration of stamp duties was increasingly centralized, and stamp distributors were given explicit instructions for collection, enforcement, and remittance. One of the most significant developments of this period was the attempt to extract greater fiscal contributions from the American colonies. Until the mid-18th century, colonial revenues had been largely managed at the local level, with minimal direct taxation by the British Parliament. However, the escalating costs of imperial defense and administration prompted a reassessment of this arrangement. British policymakers argued that the colonies, which benefited from the protection of the Royal Navy and British garrisons, should contribute to the costs of empire. the initial efforts to impose taxes on the colonies focused on customs duties and trade regulations. The Navigation Acts, which had long governed the terms of colonial trade, were more rigorously enforced. New customs officials were appointed, and colonial merchants faced increased scrutiny. Revenue from these measures, however, remained limited. Consequently, Parliament began to consider more direct forms of taxation. Though the more famous Stamp Act would not be passed until 1765, the discussions surrounding its implementation began during the war. British officials debated the scope and structure of potential colonial taxes, the appropriate level of administrative oversight, and the political implications of direct taxation without colonial representation. These deliberations underscored the growing tension between metropolitan fiscal needs and colonial political autonomy, tensions that would soon erupt into open conflict. Within Britain, wartime fiscal pressures also led to innovations in public finance. The government increased the issuance of exchequer bills, short-term debt instruments that served as a flexible means of bridging revenue shortfalls. These instruments were backed by future tax receipts and often carried low interest rates, making them attractive to investors. The widespread circulation of exchequer bills contributed to the development of a secondary market for government debt, further embedding public credit within the financial system. The Bank of England played a crucial role during this period, acting as the government's primary agent in issuing and managing debt. It facilitated the sale of bonds, provided advances against anticipated tax revenues, and ensured liquidity in the credit markets. The bank's close relationship with the Treasury allowed for a coordinated approach to wartime finance, and its institutional stability helped maintain investor confidence even during periods of heavy borrowing. The end of the 7 Years' War in 1763 marked the zenith of Britain's 18th-century fiscal expansion. The national debt had nearly doubled in less than a decade, and the burden of servicing this debt shaped the contours of post-war fiscal policy. Although wartime taxes were not immediately repealed, efforts were made to reduce rates and restore peacetime norms. However, the experience of wartime finance reinforced the centrality of indirect taxation, public debt, and administrative professionalism in the functioning of the British state. The increased integration of the colonies into the British fiscal system, though only partially realized by 1763, represented a significant shift in imperial governance. The wartime measures had demonstrated both the possibilities and the limitations of colonial taxation. While customs and trade duties provided a modest source of revenue, the broader goal of aligning colonial fiscal contributions with metropolitan expectations remained elusive. The introduction of new taxes, including the Sugar Act, 1764, and the Stamp Act, 1765, would soon provoke widespread resistance and spark a constitutional crisis over the nature of representation, sovereignty, and fiscal authority. In summary, the mid-Georgian period was characterized by the rapid growth of Britain's fiscal military capacity. The government's ability to mobilize vast sums through taxation and borrowing. Supported by a professionalized bureaucracy and a resilient financial sector, enabled it to wage global war and expand imperial influence. However, this very success sowed the seeds of future discord, particularly in the American colonies, where the imposition of taxes by a distant parliament came to be seen as an infringement on local autonomy. The fiscal legacy of the 7 Years' War would reverberate throughout the empire, shaping debates over governance, representation, and the limits of metropolitan authority in the decades that followed. The period from 1763 to 1776 was marked by a deepening fiscal and constitutional crisis within the British Empire, particularly as it pertained to the American colonies. The financial burdens incurred during the 7 Years' War had left the British government with a massive national debt, the servicing of which required a reliable and expanding stream of revenue. British ministers, notably George Grenville, sought to secure greater contributions from the North American colonies, whose protection during the war had entailed significant metropolitan expenditure. The attempt to reform and expand colonial taxation, however, revealed a profound divergence between imperial expectations and colonial interpretations of constitutional liberty. Central to the ensuing conflict was the question of whether Parliament possessed the authority to impose taxes on British subjects in the colonies without their consent through local representation. This period witnessed the introduction of a series of revenue measures, the proliferation of colonial resistance, and the eventual breakdown of fiscal governance within much of North America. At the outset of this period, the British national debt stood at approximately £130 million, nearly double its pre-war figure. Annual interest payments approached £5 million, representing a substantial portion of total government expenditure. The wartime land tax of 4 shillings in the pound remained in place, and excise duties continued to be levied on a wide array of goods consumed domestically. Customs duties at British ports generated significant revenue, augmented by continued growth in Atlantic trade. However, the Metropolitan Treasury faced a structural problem. Expenditure on defense and administration in the American colonies far outstripped the revenue collected from those colonies. Ministers estimated that peacetime military expenditures in North America, primarily for garrisons, fortifications, and naval patrols, required an annual sum in excess of £200,000, while colonial customs duties typically yielded less than a quarter of that amount. In response to this imbalance, the government undertook a series of fiscal measures designed to reform colonial revenue collection and assert metropolitan fiscal authority. The first of these was the Revenue Act of 1764, more commonly referred to as the Sugar Act. Building upon the earlier Molasses Act of 1733, which had imposed a duty of 6d per gallon on foreign molasses imported into the colonies but had been widely evaded. The Sugar Act reduced the duty to 3d per gallon but provided for far more rigorous enforcement. The Act also expanded the list of taxable commodities to include sugar, wine, coffee, pimento, and textiles. It established new procedures for customs collection, mandated that violations be tried in vice-admiralty courts without juries, and directed revenue toward the support of imperial administration in America. The Sugar Act represented a fundamental shift in colonial taxation policy. Whereas earlier duties had been primarily regulatory in nature, aimed at controlling trade patterns rather than raising revenue, the new act was explicitly fiscal. Colonial reaction was immediate and hostile. Merchants, particularly in New England, argued that the act threatened economic viability, while political commentators charged that taxation without local legislative consent violated the principles of English liberty. Pamphlets, petitions, and town meetings proliferated, articulating a conception of constitutional rights grounded in the tradition of no taxation without representation, despite mounting opposition. The British government proceeded with additional revenue measures. The most controversial of these was the Stamp Act of 1765, which required that many printed materials in the colonies, including newspapers, legal documents, licenses, and commercial papers, bear an official revenue stamp. The act applied across the American colonies and was to be enforced through a network of stamp distributors appointed by the Crown. Its revenue was likewise intended to defray the costs of imperial defense. The Stamp Act marked the first direct internal tax imposed by Parliament on the colonies and was met with a storm of protest. Colonial legislatures passed resolutions denouncing the act as unconstitutional. The Virginia Resolves, introduced by Patrick Henry, asserted that only the colonial assemblies had the right to levy taxes upon their inhabitants. The Stamp Act Congress, held in New York in October 1765, brought together delegates from 9 colonies who collectively petitioned the King and Parliament for redress. Popular resistance took the form of riots, intimidation of stamp distributors, non-importation agreements, and widespread refusal to use stamped paper. The resistance proved effective. By early 1766, stamp distributors in most colonies had resigned under pressure, and the act was rendered unenforceable. Faced with commercial disruptions and growing unrest, Parliament repealed the Stamp Act in March 1766. However, it simultaneously passed the Declaratory Act, asserting Parliament's full authority to legislate for the colonies in all cases whatsoever, including taxation. This ambiguous formula allowed Parliament to retreat on the immediate fiscal issue while preserving the principle of parliamentary sovereignty. In the wake of the Stamp Act crisis, British ministers adopted a more cautious approach. However, fiscal needs persisted, and alternative revenue measures were soon introduced. The most notable of these were the Townshend duties, named after Chancellor of the Exchequer Charles Townshend, and enacted in 1767. These duties imposed customs charges on the importation of glass, lead, paint, paper, and tea into the colonies. Unlike the Stamp Act, the Townshend duties were external taxes, structured as tariffs rather than direct levies. The revenue was earmarked for paying the salaries of colonial governors and judges, thereby weakening the influence of colonial assemblies. To enforce the new duties, the government established the American Board of Customs Commissioners, headquartered in Boston. The board oversaw a more systematic collection of duties, issued writs of assistance for the search of suspected smuggling operations, and prosecuted violators in vice-admiralty courts. The increased presence of customs officials, backed by military support, heightened tensions in major ports. Colonial resistance resumed, taking both ideological and economic forms. The theory of virtual representation, advanced by British commentators to justify parliamentary taxation, was rejected by most colonists, who argued for direct representation or local legislative control over taxation. Intellectual defenses of colonial rights were articulated by figures such as John Dickinson, whose letters from a farmer in Pennsylvania argued that Parliament had no right to levy taxes for revenue purposes on unrepresented colonies. Economic resistance took the form of renewed non-importation agreements, especially in Boston, Philadelphia, and New York, which placed pressure on British merchants and manufacturers to advocate for repeal. The British response was marked by both conciliation and repression. In 1770, under Prime Minister Lord North, most of the Townshend duties were repealed, except for the tax on tea, retained as a symbolic assertion of Parliament's right to tax the colonies. Tensions remained high, however, and the continued presence of British troops in colonial cities, intended to support customs enforcement, fueled further resentment. The Boston Massacre in March 1770, during which British soldiers killed 5 colonists during a confrontation, became a galvanizing event in colonial opposition. For several years thereafter, relative calm prevailed, though underlying conflicts remained unresolved. The fiscal needs of the British state did not abate, and ministers continued to seek mechanisms for raising colonial revenue. The most consequential of these was the Tea Act of 1773, which aimed to support the struggling East India Company by allowing it to export tea directly to the colonies, bypassing intermediary merchants, and retaining the Townshend duty. Although the act reduced the effective price of tea, it was seen as a means of enforcing Parliament's taxation authority and undercutting colonial merchants. The colonial response culminated in the Boston Tea Party, during which colonists, disguised as Mohawk Indians, boarded East India Company ships and destroyed 342 chests of tea. In response, Parliament passed the Coercive Acts, also known as the Intolerable Acts, which closed the port of Boston, altered the Massachusetts Charter, and allowed royal officials accused of crimes to be tried in Britain. These acts further centralized imperial control and provoked solidarity among the colonies. In 1774, the First Continental Congress convened in Philadelphia, bringing together representatives from 12 colonies. The Congress condemned the Coercive Acts, endorsed a continental association to enforce non-importation, and issued a Declaration of Rights and Grievances, affirming colonial loyalty to the Crown but denying parliamentary authority in matters of taxation. By 1775, fiscal administration in much of colonial America had effectively collapsed. Royal customs officers faced threats, taxes went uncollected, and colonial assemblies asserted de facto independence over financial matters. Skirmishes at Lexington and Concord in April 1775 marked the beginning of armed conflict. The Second Continental Congress, convened shortly thereafter, assumed powers of taxation and finance, authorized the issuance of continental currency, and coordinated military resistance. The British government, for its part, responded with escalating military measures and rejected calls for compromise. By early 1776, the imperial fiscal system in North America had disintegrated, replaced by a patchwork of revolutionary governments asserting independent financial authority. The publication of Thomas Paine's Common Sense and the subsequent Declaration of Independence in July 1776 formalized the political and constitutional rupture. The period from 1776 to 1789 was marked by a complex reorientation of fiscal administration within Great Britain, precipitated by the ongoing conflict with the American colonies and the broader geopolitical entanglements that emerged during the American Revolutionary War. The British government, facing a protracted military engagement across the Atlantic and growing international hostility, most notably from France, Spain, and the Dutch Republic, was compelled to increase expenditures on both land and naval forces. This escalation in military outlay led to a corresponding expansion of public borrowing and taxation, which placed the administrative capacities of the British fiscal state under considerable strain. The challenges of this period reveal the continued evolution of revenue collection, debt management, and financial policy, while also exposing tensions between metropolitan fiscal needs and public tolerance for taxation. At the outset of the American Revolutionary War, the British national debt already stood at a substantial level due to the cumulative effects of prior conflicts, particularly the 7 Years' War. In 1775, total funded and unfunded debt approached £135 million, with annual interest payments of approximately £4.75 million. The cost of military operations in North America quickly mounted. Estimates suggest that the war effort added more than £80 million to the national debt by the time hostilities ceased in 1783. This placed extraordinary pressure on both existing revenue mechanisms and the capacity of the government to secure new sources of income. To meet the growing fiscal demands, successive ministries, beginning with that of Lord North, pursued a range of measures. One of the most significant was the reliance on the long-established system of funded debt, in which the government raised money by issuing long-term annuities and bonds. These instruments were typically underwritten by prominent financiers and managed through the Bank of England, which played a central role in both arranging loans and servicing debt. Subscriptions to public loans were opened periodically, with interest rates adjusted to attract investors. The 3% and 4% annuities remained the most common instruments, though other variations, including life annuities and lottery-based borrowing, were also employed to diversify sources of credit. Alongside borrowing, the government increased taxation in several key areas. The land tax, long a staple of English fiscal policy, was maintained at or near the wartime rate of 4 shillings in the pound throughout the conflict. Though fixed in nominal terms, the tax remained a regressive burden on landed incomes and had limited elasticity as a revenue source. Consequently, attention turned to the more dynamic field of indirect taxation. The excise system, which taxed goods such as beer, spirits, salt, leather, soap, candles, and tobacco, was further expanded. Rates were raised on several articles, and administrative procedures were tightened to reduce evasion. In 1779, new excises were introduced on items such as bricks and coals. The excise was also extended to cover certain processes and ingredients used in manufacturing, such as starch and glue. These levies were often unpopular due to the intrusive nature of inspection and enforcement, which involved officials entering premises and measuring production output. Customs duties also rose significantly. The war disrupted transatlantic trade and altered patterns of importation, but tariffs were nonetheless increased on a wide range of goods, including wine, tea, coffee, and textiles. Smuggling remained a persistent problem, particularly along the southern coast and in port towns such as Bristol, Hull, and Liverpool. The Board of Customs attempted to mitigate losses through increased patrols and stricter enforcement, though success remained limited. A particularly noteworthy development was the increased taxation of luxury consumption, justified on grounds of both revenue generation and patriotic sacrifice. The tax on servants, originally imposed in 1777, levied charges on households employing male domestic servants, with rates increasing in proportion to the number of servants maintained. A tax on carriages and tax on hair powder followed, both targeting elite lifestyles. In 1780, a tax was placed on horses used for riding, again reflecting the emphasis on taxing conspicuous consumption. Though not major revenue sources in absolute terms, such taxes served a symbolic function and were expanded in subsequent years. Administrative capacity was tested by the need to collect and manage this growing portfolio of taxes. The Excise Office, based in London with regional branches, oversaw a sprawling network of supervisors, gaugers, and surveyors tasked with enforcing excise duties. Officials were required to maintain detailed ledgers, issue permits, and conduct inspections. Their conduct was subject to periodic review, and cases of corruption or negligence were investigated. Similarly, the Customs Service operated an elaborate system of ports, warehouses, and enforcement mechanisms, including customs houses, tide waiters, and riding officers. Despite efforts at reform, inefficiencies and local resistance remained endemic. The Audit Office, which reviewed public accounts, and the Treasury, which directed overall fiscal policy, both expanded their bureaucratic reach. Treasury lords issued detailed instructions to tax commissioners and oversaw the allocation of revenue to various government departments. The Pay Office, Ordnance Office, and Navy Board required large sums for provisioning the military and maintaining warships. These demands were channeled through the Exchequer, which processed warrants, issued payments, and monitored balances. Debt service emerged as a dominant component of expenditure. By the early 1780s, interest payments consumed nearly half of annual revenue, underscoring the structural implications of prolonged borrowing. Efforts to reduce the cost of debt, such as converting high-interest loans into lower-rate instruments, were constrained by market conditions and the continued need to attract lenders. The sinking fund, originally intended to reduce debt through systematic repurchases of government securities, remained underutilized during wartime. Politically, the expansion of taxation and debt provoked criticism. Opposition Whigs, particularly those aligned with Charles James Fox, condemned the financial burdens imposed on the public and questioned the legitimacy of policies that had led to war. Pamphleteers and public commentators decried the growing influence of financiers, the burdens on the poor, and the opacity of government accounts. John Cartwright and other reformers called for greater transparency and parliamentary accountability in fiscal matters. Nonetheless, the Crown retained substantial control over taxation policy, and Parliament generally approved revenue measures as necessary for national defense. The conclusion of hostilities in 1783 with the Treaty of Paris did not immediately relieve fiscal pressure. The British government faced a post-war economy marked by inflation, trade disruption, and fiscal exhaustion. The immediate challenge was to transition from wartime finance to peacetime sustainability. Interest on the enlarged national debt now exceeded £9 million annually, and overall government expenditure remained high due to residual military costs and administrative commitments. The ministry of William Pitt the Younger, who became Prime Minister and Chancellor of the Exchequer in 1783, embarked on a program of fiscal reform aimed at stabilizing government finances and restoring public confidence. One of his earliest initiatives was the re-establishment of the Sinking Fund in 1786, which dedicated £1 million per year to the gradual repayment of the national debt. The fund was administered by a board of commissioners and invested in the purchase of government securities. Though its long-term effectiveness remains debated, it was widely regarded as a prudent measure. Pitt also introduced new taxes, including duties on shops, inhabited houses, and various licenses. An innovative tax on male servants was graduated according to the number employed, reflecting a continuing emphasis on luxury taxation. The Commutation Act of 1784 significantly reduced the duty on tea, previously a major driver of smuggling, from 119% to 12.5%, while replacing lost revenue with an increased window tax. The measure succeeded in curbing illicit trade and stabilizing customs revenue. Efforts were also made to streamline tax collection and reduce administrative costs. Pitt sought to rationalize customs tariffs, abolish redundant duties, and improve enforcement mechanisms. He authorized inquiries into corruption, simplified bureaucratic procedures, and promoted merit-based appointments within revenue departments. These administrative reforms marked a modest but significant step toward greater efficiency. Despite these efforts, the fundamental challenge remained: a high and growing national debt, sustained by a narrow base of taxation and an uneven burden across social classes. Indirect taxes, which made up the bulk of revenue, fell disproportionately on the working population. The landowning elite continued to dominate Parliament and resisted any move toward progressive direct taxation. Political radicals, inspired by events in France after 1789, began to challenge the structure of British fiscal governance and called for broader representation. In sum, the years 1776 to 1789 represent a critical period in the development of Britain's fiscal state. War-induced borrowing and taxation exposed the limitations of existing institutions, while post-war reforms under Pitt the Younger attempted to restore order and credibility. Though the system survived its immediate trials, it remained dependent on a fragile equilibrium of borrowing, regressive taxation, and administrative vigilance, conditions that would be tested anew in the coming age of revolutionary warfare and global conflict. The outbreak of the French Revolution in 1789 and the ensuing wars between Britain and revolutionary France from 1793 to 1802 ushered in a prolonged period of exceptional fiscal strain, marked by an unprecedented expansion in public debt, taxation, and state expenditure. The British fiscal state, which had already undergone significant transformation during the preceding century, entered a new phase of militarized finance in which the exigencies of war determined the structure and function of government revenue. Under the leadership of William Pitt the Younger, who continued as both Prime Minister and Chancellor of the Exchequer for most of this period, the British state adopted a range of fiscal innovations to sustain the vast financial burdens of nearly continuous warfare. The wars with revolutionary France began in February 1793 and would continue, albeit with intermittent truces, until the Peace of Amiens in 1802. British involvement in the First Coalition against France led to an immediate surge in military expenditure, as the government mobilized both the Army and the Royal Navy on a scale not seen since the 7 Years' War. War expenditure, which had stood at roughly £13 million in 1792, rose to over £28 million by 1795, and surpassed £50 million annually by the turn of the century. These outlays necessitated radical adjustments in both revenue generation and debt management, One of the most salient features of British fiscal policy during this period was the dramatic increase in public borrowing. Government loans were issued annually or semi-annually, typically with the assistance of major financial houses in the City of London. The long-standing reliance on 3% and 4% consols, consolidated annuities, was continued, though with increasing volumes and at terms adjusted to attract investors. Subscription lists for loans were often oversubscribed, indicating continued confidence in the government's creditworthiness, even as total debt soared. The national debt, which had stood at approximately £240 million in 1792, grew to over £500 million by 1801. Servicing this debt consumed an ever larger portion of the state's annual budget. Interest payments alone absorbed between £15 million and £20 million annually in the closing years of the century. This debt burden was managed through the operations of the Sinking Fund, re-established in 1786 and given renewed prominence by Pitt, although it struggled to keep pace with the growth of new borrowing. To reduce reliance on borrowing, the government aggressively expanded taxation. This was initially achieved through the extension and intensification of indirect taxes. The excise duties were raised on a wide range of domestic goods, including beer, spirits, soap, candles, paper, starch, bricks, and glass. The scope of excise taxation was also broadened to encompass additional stages of production and distribution. The customs system was likewise extended, with new duties placed on imports such as sugar, wine, tobacco, and textiles. Measures were taken to improve enforcement, including increased penalties for smuggling and the establishment of new customs houses and patrols along the coasts. Indirect taxation, while lucrative, was also regressive and increasingly insufficient. Therefore, Pitt introduced a number of direct taxes designed to extract greater revenue from wealth and property. These included an expanded tax on inhabited houses, a revived window tax, and new duties on male servants, horses, carriages, and armorial bearings. Taxation was used not only as a fiscal instrument but also as a political one, signaling the patriotic duty of the wealthy to contribute to the national cause. The most significant innovation of this period was the introduction of the first modern income tax in 1799. Pitt's Income Tax Act imposed a graduated tax on incomes over £60 per year, with a top rate of 10% on incomes exceeding £200. The tax was divided into schedules, with Schedule A covering income from land, Schedule B from agriculture, Schedule C from interest on public funds, Schedule D from trades and professions, and Schedule E from salaries and offices. This tax marked a fundamental shift in the British fiscal system, as it moved toward the systematic taxation of earnings and capital. Although the income tax initially raised less than projected, it set an important precedent for modern direct taxation. The administration of the income tax was undertaken by local commissioners in each county, supported by a central bureaucracy. Taxpayers were required to submit returns detailing their income, which were subject to audit. While the tax was nominally based on voluntary declaration, it included provisions for investigation and fines for evasion. This created tensions between the public and tax authorities, especially among those unaccustomed to revealing financial details. Administrative expansion was essential to support these new tax mechanisms. The Excise Office, Customs Board, and Stamp Office were all enlarged, and the number of tax officers, supervisors, inspectors, and clerks increased significantly. Treasury oversight was also enhanced, with improved record-keeping, regular audits, and more direct communication between central and local authorities. The General Post Office was occasionally used to assist in communication and enforcement. The growth of the fiscal bureaucracy mirrored the growth of the state as a whole during wartime. The Bank of England's role in public finance deepened throughout this period. In addition to managing government borrowing and facilitating interest payments on the national debt, the bank became increasingly involved in short-term advances and liquidity provision. The suspension of cash payments in 1797, prompted by a run on gold reserves, meant that the bank operated under a fiduciary system in which paper currency circulated without immediate convertibility. This marked the beginning of a period of inconvertible paper money, which would last until 1821. The bank's collaboration with the Treasury was essential in maintaining confidence in the government's fiscal and monetary policies. Revenue from taxation increased substantially over the course of the war. Annual tax receipts, which had stood at roughly £18 million in 1792, rose to nearly £36 million by 1802. While indirect taxes continued to account for the majority of revenue, direct taxes, including the income tax, contributed a growing share. Nevertheless, the scale of wartime expenditure meant that taxation could only cover about two-thirds of public spending, with the remainder funded through borrowing. Public opinion regarding the fiscal policies of the period was mixed. While many accepted the necessity of high taxes during wartime, resentment was common, particularly among those disproportionately burdened by indirect levies. Opposition politicians criticized the expansion of government power and the intrusive nature of new tax regimes. Radical reformers, some influenced by the French Revolution, denounced the inequality of the tax system and called for broader representation in fiscal decision-making. Despite criticism, Pitt's financial policies were generally regarded as effective in sustaining the war effort. The capacity of the British state to borrow, tax, and administer its finances on an unprecedented scale allowed it to maintain military operations and support foreign allies. Subsidies to Austria, Prussia, and other members of the anti-French coalitions were regularly dispersed, adding to the fiscal burden but serving strategic objectives. The conclusion of the war with the Treaty of Amiens in 1802 offered a temporary respite, but the fiscal legacy of the conflict was profound. The national debt had more than doubled, the tax system had been fundamentally altered, and the administrative machinery of the fiscal state had expanded to levels that would have been inconceivable a generation earlier. The income tax, although suspended shortly after the peace, had demonstrated the viability of systematic direct taxation and would later be revived in even more extensive form. The wars also left a long-term imprint on British political economy. The reliance on credit markets, the integration of financial institutions with government policy, and the increasing centralization of fiscal administration all pointed toward a new model of statecraft. The period from 1789 to 1802 thus stands not only as a time of fiscal crisis but also as a foundational era in the development of the modern British state. Following the temporary peace established by the Treaty of Amiens in 1802, Britain enjoyed a brief respite from the burdens of war, but it did not last long. By 1803, hostilities with France resumed, and Britain found itself once again embroiled in what would become the Napoleonic Wars, a conflict that would persist until 1815. The fiscal challenges faced by the British government during this period were even more severe than those encountered in the previous French Revolutionary Wars, and the solutions found during these years further cemented the development of the modern British fiscal state. The period from 1802 to 1815 saw a dramatic escalation in military expenditure. By 1805, annual military spending had soared to approximately £60 million, and by 1815 it would exceed £90 million. The scale of the war effort was such that taxation, while vital, was no longer sufficient to cover the costs of the conflict. This era marked a new phase in the evolution of British finance, as the government became increasingly reliant on borrowing to fund its operations. Public debt and borrowing, the national debt, which had reached approximately £500 million by 1802, skyrocketed over the next decade. By 1815, the national debt had surpassed £850 million, a staggering sum that reflected the scale of the war effort and the continued reliance on loans to fund military operations. To service this debt, the government had to pay substantial interest, which consumed an ever larger portion of the annual budget. Interest payments on the debt were the largest single expenditure in the government's finances, and they would remain so for much of the 19th century. The borrowing mechanisms used by the British government during this period were similar to those employed during the previous wars with France, but on a larger scale. The Bank of England continued to act as the primary intermediary for government borrowing, and financial institutions in the City of London played an increasingly important role in facilitating the government's access to credit. The system of government bonds, particularly the 3% and 4% consols, remained central to the funding strategy, with new issues of bonds being sold to investors to meet the rising costs of war. The market for government bonds grew during this period, and the British government became a key player in the global financial system. However, this reliance on borrowing also raised concerns about the sustainability of Britain's fiscal policies. The national debt was seen as a necessary evil, but there were persistent fears that the burden of interest payments would eventually lead to fiscal collapse, taxation, and revenue. In the face of escalating military expenditure, the British government once again turned to taxation to supplement its revenue. While indirect taxes on goods like tea, tobacco, and alcohol remained an important source of income, they were not enough to cover the expanding costs of the war. Therefore, the government introduced a range of new taxes, and existing taxes were increased in order to raise additional revenue. One of the most significant tax reforms of this period was the expansion of the income tax, which had been initially introduced in 1799 as a temporary measure. The income tax was reintroduced in 1803 and increased in scope. It was applied more broadly across different income brackets, and the rates were raised to provide a greater contribution to the war effort. The income tax would continue to play a crucial role in British fiscal policy for the remainder of the Napoleonic Wars, though its application remained somewhat contentious, particularly among those who viewed it as an infringement on personal liberty. In addition to the income tax, the government also expanded its system of excise duties and customs duties. Taxes on luxury goods, including carriages, horses, and windows, were raised, while new duties were imposed on commodities such as salt, paper, and candles. The customs duties on imported goods were also increased, making it more expensive for Britons to buy foreign products. While these taxes were effective in raising revenue, they were also highly unpopular, particularly among the middle classes, who were often the primary consumers of luxury goods. The government also introduced a number of taxes aimed at the wealthy. These included taxes on property, land, and other forms of wealth. The land tax, which had been a key source of revenue since the 18th century, continued to be levied during this period. Although its impact was diminished by a series of exemptions and reforms that reduced its effectiveness. Nevertheless, the wealthier classes were expected to bear a larger share of the fiscal burden, and these taxes were often met with resistance and evasion. The role of the Bank of England in currency management. The Bank of England continued to play a central role in Britain's wartime finance. In addition to managing government borrowing and the issuance of new bonds, the bank was responsible for ensuring the stability of the currency. During the Napoleonic Wars, the bank was granted a monopoly on the issuance of banknotes, and it was expected to manage the money supply to meet the government's fiscal needs. In 1797, the Bank of England had suspended cash payments, meaning that it no longer exchanged banknotes for gold on demand. This policy, which was initially implemented in response to the threat of invasion by Napoleon, was extended for the duration of the war. The suspension of convertibility marked the beginning of an era of inconvertible paper currency, with banknotes circulating as a form of fiat money. The value of these notes was subject to fluctuations in public confidence and the stability of the Bank of England, and inflation became a growing concern as the war progressed. Despite these challenges, the Bank of England managed to maintain the stability of the currency and played a key role in supporting the government's borrowing efforts. The suspension of cash payments allowed the government to continue borrowing without the immediate constraint of having to maintain a gold reserve. However, the suspension of convertibility also had long-term consequences for the British economy, as it eroded trust in the value of paper currency and contributed to rising prices and inflation. The social and economic impact. The fiscal policies implemented during the Napoleonic Wars had far-reaching consequences for British society and the economy. On one hand, the government's ability to mobilize vast resources for the war effort was a testament to the growing power of the British state. The ability to tax citizens and borrow from financial markets on an unprecedented scale demonstrated the centralization of fiscal authority and the growing sophistication of the state's financial apparatus. On the other hand, the burdens of war were keenly felt by many sectors of society. The widespread imposition of taxes, the rising cost of living, and the increasing burden of national debt led to widespread dissatisfaction, particularly among the working and middle classes. While the wealthiest members of society were often able to avoid the worst effects of wartime taxation through exemptions and tax avoidance strategies, the general population bore the brunt of the economic strain. The war also exacerbated economic inequality. The costs of the war effort were often passed on to the poor and middle classes, while the wealthiest individuals and institutions were able to accumulate greater wealth through government contracts, the purchase of government bonds, and the exploitation of wartime trade opportunities. The growing divide between rich and poor would have significant political implications in the years following the war. Conclusion: the period from 1802 to 1815 marked a defining moment in the history of British fiscal policy. The challenges of financing the Napoleonic Wars prompted the government to adopt new forms of taxation, expand its system of borrowing, and consolidate its control over the economy. The fiscal innovations of this period, particularly the reintroduction and expansion of the income tax, would lay the groundwork for the development of the modern British tax system. However, the immense public debt accumulated during this time would have lasting effects on the British economy and the relationship between the state and its citizens. The legacy of the Napoleonic Wars would shape British fiscal policy for much of the 19th century. And the expansion of the fiscal state would continue to evolve in the years to come. The conclusion of the Napoleonic Wars in 1815 marked the beginning of a new and complex era in British fiscal history. The peace that followed the Battle of Waterloo brought with it not only relief but also significant economic and financial challenges. The cessation of wartime expenditure, combined with a vast accumulated public debt and widespread economic dislocation, compelled the British government to undertake a series of financial adjustments aimed at stabilizing the national economy and transitioning from a wartime to a peacetime fiscal regime. This period, extending from 1815 to 1830, was characterized by retrenchment, taxation reform, debt management, and the early stirrings of industrial and social transformation. At the end of the war, the British national debt stood at approximately £850 million, an amount nearly 10 times greater than the total annual revenue. Servicing this debt became the central fiscal concern of successive post-war administrations. The government allocated around £30 million annually, nearly half of all state expenditures, solely for interest payments. This financial burden exerted considerable pressure on the Treasury and left limited fiscal flexibility for other priorities. In response, the British state adopted a policy of fiscal austerity, commonly referred to as retrenchment. This approach aimed to reduce government spending, eliminate wartime fiscal distortions, and restore confidence in the national finances. The guiding principle of retrenchment was the reduction of the annual budget deficit without undermining the integrity of the debt repayment structure. As part of this strategy, military expenditures were slashed, with the peacetime army and navy reduced in size. Government departments were consolidated, and numerous temporary wartime offices and boards were abolished. One of the most notable decisions in this era was the repeal of the income tax in 1816. First introduced by William Pitt the Younger in 1799 and used extensively during the Napoleonic Wars, the income tax had become both a critical revenue stream and a controversial political instrument. Following the end of hostilities, a broad coalition of political voices, ranging from aristocrats wary of state intrusion into private wealth to radicals opposed to regressive taxation, pressured Parliament to eliminate this temporary war tax. In March 1816, after vigorous debate, the government conceded and allowed the income tax to lapse. Despite the substantial revenue it had provided, some £14 million annually, its unpopularity among influential social groups proved decisive. With the loss of income tax revenue, the government was compelled to re-emphasize indirect taxation, particularly through excise duties and customs levies. These taxes, while easier to administer and less politically contentious, disproportionately affected the working and lower middle classes. Taxes on everyday goods such as soap, candles, beer, and salt remained in place, and in some cases were increased. The continuation of these taxes, despite the cessation of war, contributed to a growing sense of economic grievance, especially among urban populations experiencing wage stagnation and high prices. In tandem with excise taxes, customs duties were used not only to generate revenue but also to protect domestic industries from foreign competition. This protective system, which favored established landowning and industrial interests, was epitomized by the Corn Laws of 1815. These laws imposed tariffs on imported grain to maintain high domestic prices, thereby benefiting British agricultural producers. However, they also raised the cost of bread and other staple foods, contributing to working-class discontent and fueling social unrest throughout the 1810s and 1820s. In the realm of debt management, the post-war period saw renewed efforts to establish long-term fiscal sustainability. The principal instrument for this purpose was the sinking fund, originally devised by Pitt in the 1780s and revived with new vigor after 1815. The sinking fund was intended to reduce the national debt gradually by setting aside fixed annual amounts from the budget to purchase government securities on the open market. These purchases would, in theory, reduce the outstanding debt while supporting bond prices. However, the practical impact of the sinking fund was limited. Critics pointed out that the fund's effectiveness was compromised by the fact that the government was simultaneously borrowing and redeeming debt, often at unfavorable rates. Moreover, the large sums allocated to the fund reduced the Treasury's flexibility to respond to economic downturns. Eventually, the sinking fund came under increasing scrutiny, and by the 1820s, its role had diminished considerably. During this period, the Treasury operated under the leadership of a succession of Chancellors of the Exchequer, including Nicholas Van Sittert, later Lord Bexley, who served from 1812 to 1823, and Frederick Robinson, later Viscount Goderich, who succeeded him. These men presided over a conservative fiscal policy that emphasized balanced budgets, the maintenance of public credit, and the minimization of new taxation. Their policies, while fiscally prudent, often failed to address the social and economic disruptions caused by post-war deflation and unemployment. The deflationary pressures that accompanied retrenchment had far-reaching consequences. As the government reduced spending and withdrew war-related stimulus, prices across the economy fell. This decline, while welcomed by some consumers, proved devastating for many producers, especially in agriculture and small-scale manufacturing. Falling prices meant falling profits. leading to wage reductions and widespread job losses. The resulting economic distress was particularly acute in rural areas, where poor harvests exacerbated the effects of declining grain prices. These conditions contributed to growing unrest, including the so-called Captain Swing riots, Luddite machine breaking, and various demonstrations demanding parliamentary reform and economic relief. The government's response to such disturbances was often repressive, employing military force and suspending civil liberties to maintain order. At the same time, the growing demands for change began to influence debates within Parliament, setting the stage for future fiscal and political reforms. Monetary policy also played a central role in the economic climate of the period. Following the suspension of gold convertibility in 1797, the British currency had operated under an inconvertible paper regime, with banknotes issued by the Bank of England circulating as legal tender. However, by the end of the Napoleonic Wars, there was increasing pressure to return to the gold standard to restore monetary stability and international confidence. This led to the passage of the 1819 Act for the Resumption of Cash Payments, commonly known as the Peel Act, after its sponsor, Sir Robert Peel. The act mandated that the Bank of England resume specie payments by 1821, thus re-establishing the gold standard. The resumption was achieved through a combination of monetary contraction, deflation, and increased gold reserves. While the move was successful in restoring international confidence, it also intensified the domestic deflationary spiral, exacerbating economic hardship for debtors and workers. The Bank of England, throughout this period, remained a central pillar of the financial system. As the government's banker and debt manager, it continued to oversee the issuance of bonds and the stabilization of public credit. Its actions during the return to the gold standard and its collaboration with the Treasury in debt management confirmed its emerging role as a quasi-central bank. Yet its independence remained limited, and its primary responsibility remained the maintenance of government solvency and the facilitation of state finance. In parallel with these developments, there were early indications of structural change within the British economy. The gradual shift from agrarian production to industrial manufacturing, already underway during the late 18th century, continued to accelerate. The post-war period saw the expansion of textile mills, the growth of ironworks, and the increasing use of coal as a primary energy source. These changes, though unevenly distributed, laid the foundations for what would become the Industrial Revolution. This nascent industrialization brought with it new fiscal implications. The emergence of a wage-earning urban working class posed challenges for taxation policy, particularly as many traditional taxes, such as those on land, luxury goods, and imports, did not capture the growing wealth and activity of the industrial sector. Although direct taxation had been abandoned in 1816, the fiscal structure was increasingly out of step with the economic realities of a changing society. By 1830, the limitations of the post-war fiscal framework were becoming increasingly evident. The rigid adherence to retrenchment, the reliance on regressive indirect taxation, and the failure to accommodate industrial and social change had generated mounting pressures for reform. The fiscal state, though remarkably resilient in its management of debt and public credit, was increasingly seen as unresponsive to the needs of a modernizing economy and an increasingly vocal population. The close of this period would usher in a new era of fiscal experimentation and reform, as the demands of industrial society, political reformers, and economic theorists converged to reshape the tax system. But in the years between 1815 and 1830, Britain remained a nation in fiscal transition, firmly rooted in the practices of war finance and yet slowly awakening to the imperatives of peacetime modernization. The period from 1830 to 1846 marked a critical transitional phase in the evolution of British fiscal policy. It was a time when old assumptions about taxation, expenditure, and economic management began to yield, cautiously and incrementally, to the pressures of political reform, economic liberalism, and administrative modernization. The emergence of a new political consensus around fiscal responsibility, commercial openness, and the moral imperative of equitable taxation would, over the course of this 16-year span, lay the groundwork for the Victorian fiscal system. These developments occurred against a backdrop of broader social change, including the rise of the middle class, the continuing spread of industrialization, and the gradual expansion of the electorate. At the beginning of this period, the fiscal system remained heavily reliant on indirect taxation. Customs and excise duties provided the vast majority of government revenue. These taxes, though efficient to collect and largely invisible to those who paid them, were increasingly recognized as regressive. Their burden fell disproportionately on the poor and working classes, who spent a greater portion of their income on taxed consumables such as salt, sugar, beer, and tobacco. Yet despite their inequity, indirect taxes remain the cornerstone of public finance, having replaced the wartime income tax that was abolished in 1816 and had not been reintroduced. The political climate began to shift in the early 1830s. Beginning with the accession of King William IV and the growing momentum for political reform. The passage of the Reform Act of 1832, which extended the franchise to a broader segment of the male middle class and eliminated many of the so-called rotten boroughs, had indirect fiscal implications. The newly enfranchised commercial and industrial classes brought with them a different set of expectations about taxation and government spending. They favored a more efficient state, lower tariffs, and a shift away from taxes that impeded business or unfairly targeted productive enterprise. This political transformation was reflected in the evolving composition of Parliament, which saw a decline in landed aristocratic dominance and a corresponding rise in representatives aligned with urban and commercial interests. Among the most influential of these was Henry Parnell, who served as Secretary at War and later as Paymaster of the Forces. In 1830, Parnell published On Financial Reform, a tract which argued for reduced government expenditure, lower customs duties, and a more transparent and equitable tax system. His recommendations, while moderate, were emblematic of the emerging reformist consensus. The Whig governments of the early 1830s, particularly under Prime Ministers Charles Grey and later Lord Melbourne, cautiously embraced aspects of financial reform. They appointed committees to review the tariff structure, examined administrative inefficiencies, and sought to reduce expenditures without compromising public services. While these efforts were limited in scope, they reflected a growing awareness of the need for fiscal modernization in an era of economic transformation. Throughout the 1830s, efforts to simplify the customs system gained momentum. At the time, the British Customs Code consisted of over 1,200 separate duties, many of which were overlapping, contradictory, or economically irrational. These duties not only raised revenue but also served protective purposes, shielding domestic industries from foreign competition. However, the growing body of economic opinion, influenced by classical economists such as Adam Smith, David Ricardo, and later J.R. McCulloch, increasingly emphasized the distortive effects of protectionism and the benefits of free trade. In 1832, the Import Duties Committee began a comprehensive review of the tariff system. Over the next several years, it recommended and Parliament implemented numerous changes, reducing the number of distinct customs duties and eliminating or consolidating redundant levies. The goal was to replace complex and inefficient protective tariffs with a simpler structure based primarily on revenue-generating import duties. While these reforms were far from comprehensive, they marked an important departure from the protectionist policies that had prevailed since the Napoleonic Wars. Excise duties remained a vital source of revenue during this period. Levied on domestically produced goods such as spirits, malt, soap, and glass, these taxes were deeply entrenched and carefully administered. The excise office, which had evolved into a professional and hierarchical bureaucracy, employed thousands of inspectors, supervisors, and gaugers to monitor production and enforce compliance. Despite frequent complaints about intrusive inspections and burdensome paperwork, excise taxes continued to account for a substantial portion of national income, as they were relatively predictable and difficult to evade. In the realm of direct taxation, the 1830s and early 1840s were notable not for innovation, but for sustained debate. The idea of reviving the income tax, long dormant since its abolition in 1816, resurfaced intermittently, especially during fiscal crises. Critics continued to decry its invasive nature and potential for abuse, while proponents argued for its fairness, flexibility, and potential to alleviate reliance on regressive indirect taxes. Although no action was taken during this time, the intellectual groundwork for the eventual revival of the income tax was laid in these years. Debt management remained a key concern throughout the period. The national debt, while no longer growing rapidly, remained at historically high levels. Annual debt service, primarily interest payments, absorbed a significant share of the budget. The sinking fund, which had lost much of its credibility in the 1810s and 1820s, was quietly sidelined, though the notion of gradual debt reduction through budget surpluses remained popular in theory. Chancellors of the Exchequer, constrained by political and economic considerations, sought to maintain confidence in public credit by avoiding new borrowing and maintaining fiscal discipline. Administrative reform was another hallmark of this era. The various departments responsible for tax collection, most notably the Board of Excise and the Board of Stamps and Taxes, underwent modest but meaningful reforms aimed at increasing efficiency and reducing corruption. The integration of record-keeping systems, the standardization of forms, and the introduction of internal audits were all steps taken to modernize the fiscal bureaucracy. These reforms, while technical and unglamorous, played a crucial role in preparing the machinery of government for the more ambitious changes to come. The economic environment of the 1830s and early 1840s was characterized by intermittent instability. The decade witnessed multiple economic downturns, including the financial panic of 1837 and subsequent recession. These episodes, often triggered by fluctuations in global commodity prices and disruptions in international trade, had direct implications for public revenue and expenditure. Falling customs receipts, rising unemployment, and increased demand for poor relief strained the government's finances and heightened calls for fiscal reform. It was against this background that Sir Robert Peel, leader of the Conservative Party and a man known for his administrative acumen, returned to office as Prime Minister in 1841. Peel's government inherited a significant budget deficit, a sluggish economy, and growing public dissatisfaction with the existing tax regime. He responded with a bold and controversial move, the reintroduction of the income tax. In his budget speech of 1842, Peel justified the revival of the income tax as a temporary measure, designed to close the fiscal gap and provide space for reductions in customs and excise duties. The new income tax, set at 7 pence in the pound, roughly 3%, applied to incomes over £150 per annum and included both earned and unearned income. The administrative apparatus for its collection was modeled on the earlier wartime system, with a network of assessors, commissioners, and surveyors appointed to enforce compliance. While controversial, the reintroduced income tax succeeded in stabilizing public finances and allowed Peel to proceed with a far-reaching program of tariff reform. Between 1842 and 1846, his government reduced or eliminated duties on hundreds of imported goods, shifting the basis of taxation away from trade and consumption and toward income. These changes reflected a profound shift in fiscal philosophy, away from protectionism and toward a more liberal and neutral tax system. Peel's fiscal reforms, though sometimes overshadowed by the political battles over the Corn Laws, were pivotal in shaping the structure of Victorian taxation. The new income tax established a precedent for the use of direct taxation in peacetime, a development previously considered politically untenable. At the same time, the reduction of customs duties helped to liberalize trade and improve economic efficiency. Laying the foundation for Britain's emergence as the preeminent free-trading nation of the 19th century, the conclusion of this period, marked by the repeal of the Corn Laws in 1846, further exemplified the growing dominance of liberal economic ideas in both trade and taxation. With the end of agricultural protection, the fiscal system was increasingly oriented toward principles of neutrality, efficiency, and equity, rather than the defense of sectional interests or the accumulation of state power. By 1846, Britain stood on the threshold of a new fiscal era. The tax system, though still imperfect and subject to political contention, had undergone significant transformation. The income tax had returned, albeit with promises of temporariness. Tariff schedules had been rationalized. Administrative structures had been modernized. These changes did not occur in isolation but were part of a broader shift toward economic liberalism, social reform, and administrative competence, hallmarks of the Victorian state to come. The period from 1846 to 1860 marked a decisive phase in the stabilization and institutional embedding of British fiscal structures, often referred to by historians and public finance scholars as the consolidation of the Victorian fiscal state. Following the reformist measures of Sir Robert Peel in the early 1840s, which included the reimposition of the income tax and a substantial reduction in customs duties, the British government entered a period characterized not by dramatic overhaul, but by incremental refinement, administrative standardization, and policy continuity. It was during these years that the foundational elements of the modern British tax system matured into a more coherent and integrated framework. The repeal of the Corn Laws in 1846, though primarily an agricultural and commercial matter, had far-reaching implications for fiscal policy. By eliminating protectionist tariffs on imported grain, the government renounced a significant source of customs revenue. This necessitated a more permanent reliance on the newly reinstated income tax, which Peel had initially introduced in 1842 as a temporary expedient. The commitment to free trade and fiscal neutrality, rather than reverting to indirect taxes with protectionist overtones, was a defining hallmark of this period. The income tax, originally imposed for 3 years, was repeatedly renewed by Parliament. Despite its unpopularity among some social classes, particularly landowners and higher earners, the tax proved to be a reliable and elastic source of revenue. As incomes rose in a slowly growing industrial economy, tax yields increased correspondingly. The tax's graduated structure and various exemptions provided a degree of equity, though not without contention. In 1848, 1851, and again in 1853, parliamentary debates revisited the justifications and implications of continuing the tax, leading to minor revisions but no fundamental reversals. Administrative improvements accompanied the continuation of the income tax. The Inland Revenue Office, which by 1849 had assumed oversight of both the income tax and a growing range of stamp and duties-related taxes, expanded its clerical and supervisory staff. Tax collection mechanisms were progressively rationalized. Local tax commissioners continued to operate as a hybrid between lay oversight and bureaucratic enforcement. Their role in determining taxable income, adjudicating claims, and enforcing penalties remained essential to the structure of direct taxation. A significant development occurred in 1849 when the boards of excise and stamps and taxes were merged into a single administrative body, the Board of Inland Revenue. This reform, formalized through the Inland Revenue Act, was aimed at improving efficiency, reducing duplication, and enhancing centralized oversight. The Board of Inland Revenue came under the supervision of the Treasury and was tasked with managing nearly all sources of internal revenue. This institutional consolidation not only streamlined administration but also fostered the development of a professionalized civil service apparatus devoted to tax policy, assessment, and collection. The customs system continued its gradual evolution. Following Peel's reduction of hundreds of tariffs, the government under Lord John Russell and later Lord Aberdeen and Lord Palmerston continued the process of simplification. Between 1846 and 1854, the number of customs duties was reduced from approximately 1,200 to fewer than 100. Duties remained primarily on luxury items and a small set of essential goods that yielded high revenue with limited economic distortion. This rationalized customs schedule significantly reduced opportunities for smuggling and corruption and made administration simpler and less costly. Excise duties remained a major component of government income throughout the period. Taxed goods included alcoholic beverages, tobacco, soap, and playing cards, among others. Although often regarded as regressive, excise duties had the advantage of being difficult to evade and relatively simple to collect at the point of manufacture. The expansion of excise inspectors' responsibilities and the introduction of standardized measurement tools, such as gauging rods and calibrated tanks, further improved accuracy and compliance. By the mid-1850s, the excise system had become a well-oiled bureaucratic machine, though one still resented by many small producers. Throughout the 1850s, the fiscal state was characterized by prudent management and relative balance. Annual budgets, presented by successive chancellors of the Exchequer, were generally conservative in scope. They prioritized debt service, maintenance of public credit, and avoidance of deficits. The national debt, although not reduced dramatically, was kept stable relative to GDP. Interest payments continued to consume a significant portion of expenditure, but were considered a necessary burden to maintain Britain's reputation for financial reliability. A key figure in this era of consolidation was William Ewart Gladstone, who served as Chancellor of the Exchequer under Lord Aberdeen's coalition government beginning in 1852. Gladstone brought to fiscal policy a firm commitment to economy, transparency, and low taxation, principles he viewed as morally and economically imperative. His budgets of 1853 and 1854 were notable for their clarity, comprehensiveness, and attempt to articulate a philosophy of taxation grounded in equity and efficiency. Gladstone's advocacy of free trade and his cautious embrace of income tax reform contributed to a broader redefinition of the relationship between citizen and state in fiscal terms. Gladstone's 1853 budget in particular stands as a landmark in the history of British taxation. It extended the income tax for 7 years and proposed a gradual reduction of rates over time, contingent on economic conditions and expenditure needs. The budget also expanded the application of income tax to Ireland, although with considerable opposition and careful exemptions. In addition, Gladstone reduced duties on over 100 import items, continuing the trajectory of tariff liberalization initiated under Peel. The clarity and logic of his fiscal policy earned widespread praise and set a new standard for budgetary communication. The onset of the Crimean War in 1854 briefly disrupted the trend of fiscal conservatism. War expenditures necessitated increased borrowing, additional taxation, and temporary suspension of tariff reductions. Gladstone, though a fiscal purist, accepted the need for war finance and introduced a special war income tax increase, as well as modest increases in excise duties. Despite these wartime exigencies, he sought to ensure that temporary taxes remained temporary and that public borrowing was not excessive. In the realm of stamp duties, the 1846 to 1860 period saw only incremental reform. Stamp duties on legal documents, insurance policies, bills of exchange, and various licenses remained in place. These duties, while often complex and unpopular, generated substantial revenue and were viewed as less distortionary than consumption taxes. Over time, pressure would mount for their simplification and rationalization, particularly from legal and financial professionals. Another notable feature of this era was the increased use of statistical methods in fiscal administration. The Board of Inland Revenue and the Treasury both began collecting more detailed data on tax yields, compliance rates, and regional disparities. This information was used to refine policy, detect anomalies, and evaluate the efficiency of collection practices. The publication of fiscal data in parliamentary papers and blue books contributed to a culture of transparency and accountability in public finance. Public engagement with tax policy also increased. Newspapers began publishing annual budget summaries and critiques, bringing fiscal issues to a broader audience. Debates in Parliament about taxation were followed by middle-class readers, particularly those with property or professional incomes who were directly affected by the income tax. Pamphlets, periodicals, and economic tracts flourished, with writers both defending and criticizing existing tax policies. This growing public discourse reflected the democratization of fiscal policy and the increasingly participatory nature of the Victorian state. The question of tax incidence, who paid and who benefited, was an enduring concern. Although the income tax was progressive in theory, critics noted that wealthy landowners often underreported income or received preferential treatment from local commissioners. Meanwhile, excise and customs duties continued to burden the poor disproportionately. Debates over whether to shift the tax burden further toward direct taxation were ongoing, with limited consensus. Gladstone, among others, advocated for a mixed system that balanced fairness with administrative feasibility. By the close of this period in 1860, the British tax system had taken on many features that would remain in place for decades. The income tax was no longer viewed solely as a wartime emergency measure but had become a flexible and adjustable tool of fiscal policy. The customs system had been streamlined into a narrow-band revenue apparatus. Excise duties, while persistent, were increasingly justified as necessary components of a balanced budget rather than instruments of social control. The institutional apparatus of taxation had also matured. The Board of Inland Revenue, the Treasury, and local commissioners operated in a more coordinated and professional fashion. The civil service responsible for fiscal matters had expanded in size and competence. Fiscal data collection and publication had improved, enabling more informed decision-making and public scrutiny. In sum, the years 1846 to 1860 saw the Victorian fiscal state reach a new level of administrative capability, ideological coherence, and political acceptance. The system remained imperfect, inequities persisted, and popular discontent with taxation was never absent, but the foundations for a durable and adaptable tax regime had been solidified. These developments would shape the trajectory of British taxation for the remainder of the 19th century, influencing debates on public finance, social welfare, and the responsibilities of the state in an industrial society. The period from 1860 to 1874 represents a further evolution in the British fiscal system, marked by incremental change, increased bureaucratic capacity, and growing reliance on stable streams of public revenue. This mid-Victorian era, following the reforms of William Ewart Gladstone and his tenure as Chancellor of the Exchequer, is especially notable for the expansion of the administrative apparatus of taxation, continued refinements to indirect and direct tax structures, and an emerging discourse on fiscal responsibility, equity, and state functions within a modern industrial society. In this context, the British tax system became more technocratic, data-driven, and embedded in the machinery of state governance. One of the most important developments of the period was the 1860 budget, delivered by Gladstone during his second year as Chancellor under Lord Palmerston's Liberal government. This budget represented a culmination of mid-century liberal fiscal principles, particularly the idea of revenue generation through a limited number of broadly applied taxes that were low in rate but high in yield. Gladstone proposed and enacted a number of sweeping tariff reductions, most notably the elimination of the remaining duties on paper. This move led to what became known as the taxes on knowledge controversy, given that paper duties were seen as an impediment to cheap newspaper and book production. Their repeal marked an important symbolic moment in the Liberal campaign against indirect taxation on necessities and information. The revenue implications of these reductions were significant. To compensate for the loss of customs and excise revenue from items such as paper, tea, and other commodities, Gladstone proposed not only retaining but extending the income tax. Although it had once been regarded as a temporary war measure, the income tax had by now become a normalized, if still politically sensitive, component of state finance. In 1860, the income tax rate was reduced from 10d to 9d in the pound, but its base was expanded and administrative enforcement intensified. The continued operation of the tax and Parliament's repeated renewal of its provisions underscored the state's growing confidence in direct taxation. Simultaneously, administrative reforms were pursued to increase efficiency and compliance. The Board of Inland Revenue continued to standardize tax collection procedures, invest in record-keeping, and professionalize its personnel. Clerks, inspectors, and assessors were subjected to greater oversight, and their work was subject to regular audits. An important innovation was the increased use of printed tax forms and schedules, replacing many older systems based on handwritten assessments and locally variable formats. This shift toward uniform documentation facilitated improved consistency and reduced the opportunity for fraud or evasion. During this period, the scope of stamp duties was also reconsidered. Stamp duties, which had long formed a portion of the government's internal revenues, covered a wide array of legal and financial documents. These included conveyances, leases, insurance policies, share transfers, and other instruments. Between 1860 and 1874, several acts were passed to simplify, consolidate, and in some cases reduce the rates of stamp duties. The objective was to maintain revenue without unduly burdening commercial transactions or the legal process. A notable example is the Stamp Act of 1870, which restructured various outdated provisions and repealed certain archaic levies, streamlining the process and making it more comprehensible for practitioners. In the customs sphere, continued liberalization of trade policy reduced the importance of tariffs as a revenue source. By 1860, Britain had concluded a landmark commercial treaty with France, the Cobden-Chevalier Treaty, which significantly lowered duties on numerous goods, including wine, brandy, silk, and other luxury imports. This agreement had both diplomatic and fiscal dimensions. On one hand, it strengthened Anglo-French economic ties and promoted free trade ideology. On the other, it required adjustments in the structure of customs administration, which now had to manage a smaller and more concentrated set of duties. Despite concerns from protectionist interests, the government remained committed to minimal interference in trade and preferred to raise necessary revenue through domestic taxation. Excise duties remained a stable, though controversial, component of taxation. Duties on spirits, beer, and tobacco generated substantial income and were widely viewed as difficult to evade. However, concerns persisted regarding the regressive nature of such levies. The working classes bore a disproportionate share of the burden, particularly since these goods constituted a relatively larger portion of their consumption. Some members of Parliament advocated for reforms to mitigate this inequity, including differentiated rates, exemptions, or shifts toward other tax sources. Nevertheless, no major structural reforms to excise were enacted in this period. Instead, small technical changes, such as the standardization of measurement practices and the refinement of warehouse procedures, were introduced to increase collection efficiency. The debate over the relative merits of direct and indirect taxation remained prominent in political discourse. Liberals, led by Gladstone, generally favored direct taxation as more equitable and transparent. Conservatives, on the other hand, often emphasized the social and political risks of over-reliance on income taxation. They feared that visible taxation on income would encourage demands for greater representation and redistribution. Thus, much of the debate about tax policy during this period was not merely about revenue, but about the broader structure and role of the state. Taxation, in effect, became a proxy for wider ideological contests over the relationship between government, economy, and society. Another significant feature of the mid-Victorian fiscal regime was the regularity and structure of the national budget. The annual budget statement became a ceremonial and substantive feature of parliamentary life. Chancellors of the Exchequer prepared increasingly detailed statements of revenue and expenditure, accompanied by forecasts, estimates, and justifications. These documents were scrutinized by committees, debated in the Commons, and reported in the press. As a result, the British public became more familiar with fiscal terminology, principles, and controversies. The publication of comparative tables, historical data, and performance indicators allowed for year-over-year analysis and laid the groundwork for future developments in fiscal transparency. During this time, the national debt remained stable in absolute terms, though it declined modestly as a proportion of gross domestic product due to economic growth. Debt service continued to absorb a substantial portion of expenditure, often between 25% and 30%, but was not seen as a pressing fiscal crisis. Debt reduction, while desirable, was subordinated to goals of fiscal neutrality and administrative stability. No major changes were made to debt structure, though some old issues were converted into new bonds with slightly more favorable terms. The growing complexity of public finance necessitated further professionalization within the Treasury, which expanded its analytical staff and adopted more rigorous accounting protocols. In Ireland, tax policy continued to be a sensitive issue. Although income tax was nominally extended to Ireland in 1853, resistance persisted throughout the following decades. Irish landowners and clergy frequently protested what they saw as unfair treatment, particularly in comparison to the application of excise duties on Irish-produced spirits and tobacco. The cost of tax collection in Ireland remained higher than in England or Scotland, due in part to local opposition and the difficulty of penetrating rural economies with limited record-keeping. Repeated calls for tax equalization or regional exemptions were generally rejected by the central government, which maintained that a uniform tax system was essential for administrative coherence and national unity. Administrative capacity also expanded at the local level. Though direct taxation remained a central responsibility of the inland revenue, local authorities played an increasingly important role in collecting and enforcing taxes associated with property, licensing, and public services. The passage of the Local Government Act of 1858, and related legislation, led to a gradual standardization of local tax assessments, including property rates. Local boards, while still subject to significant variation, became more integrated into the general fiscal framework. They were required to submit reports, maintain standardized accounts, and coordinate with central authorities in matters of compliance and enforcement. Public attitudes toward taxation also evolved. While tax resistance and evasion persisted, especially in rural and working-class communities, there was a growing sense that taxation, particularly if fairly administered, was a necessary and even legitimate function of government. Middle-class professionals, merchants, and industrialists increasingly engaged with debates over budget priorities, tax fairness, and state spending. The emergence of professional organizations, such as the Institute of Chartered Accountants, established later in 1880 but with origins in earlier practices, reflected a growing professionalization of financial expertise and its influence on public discourse. Among the significant though often overlooked developments of this period was the growing use of actuarial and statistical methods in tax policy. The Inland Revenue and Treasury collaborated with statisticians to model tax yield forecasts, analyze compliance patterns, and identify anomalies. The Royal Statistical Society and similar institutions contributed to the development of techniques for evaluating fiscal efficiency and policy impacts. These developments foreshadowed the more intensive data-driven governance of the late 19th and early 20th centuries. Throughout this era, tax reform was incremental rather than revolutionary. Successive chancellors, Gladstone foremost among them, adopted a philosophy of fiscal prudence, administrative rationalization, and incrementalism. Major upheavals were avoided, and political stability ensured continuity of policy. This predictability was valued by markets, investors, and the public, who viewed erratic fiscal measures as signs of instability. The British fiscal state, therefore, emerged from this period not dramatically altered, but significantly strengthened in its administrative coherence, institutional maturity, and public credibility. The period between 1874 and 1885 in British fiscal history is characterized by a renewed emphasis on economy, retrenchment, and the consolidation of existing tax mechanisms rather than innovation or expansion. This era coincides with the ascendancy of conservative governance under Benjamin Disraeli and, subsequently, the return of liberal leadership under William Ewart Gladstone. Both administrations, despite ideological differences, adhered to a shared commitment to fiscal prudence, balanced budgets, and administrative restraint. The legacy of earlier reforms, especially those enacted during Gladstone's earlier tenure as Chancellor of the Exchequer, defined the parameters of permissible fiscal action. As such, tax policy during this time is marked by technical refinement, cost-cutting, and intensified oversight rather than any radical departure from mid-Victorian norms. Benjamin Disraeli's government, which came to power in 1874, emphasized retrenchment as one of its governing principles. While not as ideologically committed to free trade and direct taxation as the Liberals, Disraeli's administration nevertheless recognized the necessity of maintaining fiscal discipline to preserve political legitimacy and economic confidence. The 1874 budget, presented by Sir Stafford Northcote, Chancellor of the Exchequer, maintained existing income tax rates at a modest level, 2d in the pound, while offering slight reductions in certain indirect taxes. Northcote, a cautious administrator, prioritized debt reduction and expenditure restraint. His approach reflected a conservative fiscal orthodoxy that emphasized minimal state intervention and strong aversion to deficit financing. Throughout Northcote's tenure, there was a concerted effort to limit the expansion of public spending. Though imperial commitments and domestic social pressures presented recurring demands for increased expenditure, particularly in defense, education, and public health, the Treasury exercised firm control over departmental estimates. Northcote instituted regular reviews of expenditure and strengthened the role of Treasury officials in scrutinizing departmental requests. This centralization of fiscal oversight helped prevent the proliferation of new programs and limited the financial autonomy of individual ministries. In doing so, the Treasury further cemented its role as the principal organ of fiscal discipline within the administrative state. A noteworthy administrative development during this period was the establishment of the sinking fund system for national debt repayment. In 1875, Northcote reintroduced a formal mechanism for the scheduled reduction of the national debt, based on fixed annual payments rather than ad hoc repayments. The scheme involved setting aside £27 million per year for the purpose of redeeming debt securities, a figure which could be adjusted depending on economic conditions. This approach aimed to impose fiscal discipline through automatic mechanisms, reinforcing investor confidence and constraining discretionary spending. While the fund's long-term efficacy was debated, it reflected a prevailing belief in the moral and economic imperative of debt reduction. Indirect taxation during this period remained largely stable. Customs and excise duties on alcoholic beverages, tobacco, and sugar continued to generate the majority of indirect revenue. Minor adjustments were made to excise schedules to address issues of classification, leakage, and regional variation. The government introduced improved measurement techniques and consolidated warehouse inspection regimes, thereby reducing fraud and increasing compliance. However, no major new indirect taxes were introduced, nor were existing ones substantially modified. This continuity in tax design reflected both political caution and administrative inertia. Income tax policy also remained largely unchanged, save for modest rate adjustments reflecting prevailing budgetary conditions. Although the income tax had been reduced to 2d in the pound in 1874, successive years saw minor fluctuations. In 1875, it was maintained at the same level, then slightly increased in 1876 in response to growing expenditures related to foreign policy entanglements and colonial administration. However, the idea of using income tax as a flexible instrument for managing cyclical pressures had not yet taken firm root. Instead, changes to the rate were driven primarily by the Treasury's conservative revenue projections and the government's ideological stance on fiscal minimalism. Despite its relative stability, the income tax continued to generate political debate. Conservatives remained wary of its redistributive implications, while some liberal backbenchers and radical allies argued for its expansion and progressive refinement. One proposed reform involved the differentiation of earned and unearned income, a concept which would gain more traction in later decades. For the time being, the tax remained levied uniformly across income sources, with allowances and exemptions for lower-income earners gradually adjusted in line with inflation and public pressure. The administration of the tax system became increasingly systematic and centralized. The Inland Revenue, now an established and professionalized bureaucracy, implemented reforms in tax assessment and collection. The use of printed forms, numerical identifiers for taxpayers, and centralized processing centers reduced delays and minimized local discretion. This bureaucratic modernization was accompanied by expanded use of statistical data in fiscal planning. Annual reports from the Inland Revenue and Customs departments included tables, charts, and commentary, allowing Parliament and the public to monitor revenue trends with greater accuracy. One significant administrative reform during this time was the improvement of communication and coordination between the Inland Revenue and local rating authorities. While property taxes remained under the purview of local government, closer cooperation between central and local fiscal bodies helped align valuation practices, synchronize enforcement efforts, and identify cases of underreporting or evasion. The Local Government Board, created in 1871, served as a key intermediary in coordinating these efforts. It also exercised oversight of local expenditure, particularly with regard to poor relief, public health, and infrastructure spending. The late 1870s witnessed growing concern over declining trade revenues and agricultural distress, particularly in rural England and Ireland. Falling grain prices, the result of increased imports from North America and elsewhere, placed pressure on landowners and farmers, who called for relief from property and income taxes. Though the government resisted demands for significant tax reductions or subsidies, it did authorize special inquiries into rural taxation and valuation practices. The findings of these commissions highlighted regional disparities in tax burdens and administrative capacity but led to few immediate changes. In Ireland, tax resistance persisted in various forms. Although legal enforcement mechanisms were in place, compliance was uneven, and collection costs remained high. Political agitation, particularly the land reform movements of the late 1870s and early 1880s, intersected with anti-tax sentiment. Local protests against rents, rates, and taxes frequently disrupted assessment procedures and necessitated protective measures for collectors. These conditions prompted renewed debates in Parliament regarding the viability of uniform tax policies across Britain and Ireland, though no formal differentiation was implemented. During Gladstone's return to power in 1880, his administration reasserted the principles of fiscal orthodoxy and administrative economy. The 1880 budget reflected Gladstone's long-standing preferences: balanced budgets, low tariffs, and minimal public debt. The income tax, which had risen to 5d in the pound under Disraeli's final budgets due to increased imperial expenditures, was reduced to 4d. Gladstone also reaffirmed the practice of presenting detailed annual accounts and estimates, emphasizing the moral duty of government to husband national resources with prudence and transparency. The key theme in Gladstone's fiscal program was the resistance to hypothecation, that is, the earmarking of specific taxes for particular expenditures. He argued that all revenue should be treated as part of a general fund, managed by the Treasury, and allocated according to parliamentary priorities. This principle was contested by advocates of dedicated funding for education, public health, or infrastructure. However, Gladstone maintained that hypothecation encouraged inefficiency and reduced fiscal flexibility. The debate over this issue, although largely theoretical during this period, would recur in subsequent decades as demands for social investment increased. Gladstone also engaged in a modest campaign to rationalize stamp duties and licensing fees. He ordered reviews of rates, classifications, and exemptions, and proposed minor legislative adjustments to improve clarity and reduce administrative burdens. These included consolidating certain types of licenses, adjusting stamp duty thresholds for property transfers, and eliminating redundant categories. Although the revenue implications of these reforms were minimal, they reflected the Treasury's ongoing effort to modernize the tax code without resorting to new impositions. Another important development was the increasing professionalization of the civil service, particularly within fiscal departments. The Northcote-Trevelyan Report of 1854, though published earlier, continued to shape recruitment, promotion, and training practices throughout the 1870s and 1880s. Positions in the Inland Revenue, Treasury, and related offices were increasingly filled through competitive examinations, and career advancement was based on merit rather than patronage. This process enhanced institutional memory, technical expertise, and bureaucratic continuity, key elements in sustaining complex fiscal operations. The use of statistics, forecasts, and comparative analysis in fiscal administration became more sophisticated. Treasury analysts developed models for predicting revenue from different tax sources under various economic scenarios. While rudimentary by modern standards, these techniques allowed for more precise budgeting and reduced the risk of large shortfalls or surpluses. Annual financial statements increasingly included historical comparisons, revenue elasticities, and spending projections, fostering a more analytical approach to public finance. Finally, public engagement with tax policy grew more nuanced. Newspapers, political pamphlets, and reform societies debated the virtues and vices of existing tax structures. Organizations such as the Financial Reform Association advocated for a shift away from indirect taxation toward a more progressive and transparent system. Meanwhile, conservative commentators warned of the social risks of overtaxation and the erosion of thrift. These debates, while not leading to immediate reform, cultivated a more informed public discourse around taxation and laid the groundwork for later transformations. The final decades of the 19th century in Britain marked a gradual but notable transition in fiscal policy from strict retrenchment toward cautious experimentation with progressive taxation and socially oriented expenditure. The period between 1885 and 1895 is characterized by incremental policy adjustments, parliamentary debates over equity in taxation, and the preliminary steps toward using fiscal mechanisms as instruments of social policy. While these developments were modest in scale and contested in principle, they signaled a shift in the intellectual and administrative foundations of British public finance. Central to this period were discussions concerning the distribution of tax burdens. The balance between central and local taxation, and the appropriate fiscal response to the growing demands of an industrial and urban society, the parliamentary instability of the mid-1880s, beginning with the fall of Gladstone's second ministry in 1885 and continuing with a series of short-lived administrations, limited the scope of fiscal innovation. Nevertheless, the budgetary process remained a central feature of legislative activity, with annual budgets attracting considerable attention from the press, interest groups, and the wider public. The chancellors of the period, Lord Randolph Churchill, George Goskin, and Sir William Harcourt, each contributed in differing ways to the emerging discourse on fiscal equity and the function of taxation in a modernizing state. Lord Randolph Churchill, who briefly held the office of Chancellor of the Exchequer in 1886, introduced the language of Tory democracy into fiscal debates. Though his tenure was brief and his proposals limited by internal party disputes, Churchill emphasized the need to connect conservative fiscal policy with the interests of the working classes. He advocated for reductions in regressive indirect taxes and greater attention to working-class living conditions. However, his concrete achievements were limited, and his resignation after only a few months curtailed his ability to implement more substantive reforms. His successor, George Goskin, served as Chancellor from 1887 to 1892 under the Conservative and Liberal Unionist coalition government led by Lord Salisbury. Goskin, a former Liberal, brought a technocratic approach to the Exchequer. His budgets prioritized fiscal stability, debt management, and administrative efficiency. He continued the use of the sinking fund to manage national debt repayments and sought to maintain a balance between indirect and direct taxation. However, under growing pressure to address concerns about tax fairness, Goskin began exploring reforms to the income tax structure, particularly regarding the treatment of earned versus unearned income. One significant aspect of Goskin's tenure was the introduction of graduated duties on estates. In 1888, he revised the system of probate duties, introducing a scale that increased rates on larger estates. This reform marked a modest but symbolically important move toward progressive taxation, acknowledging the principle that wealthier individuals should contribute proportionally more. Although the measure generated limited revenue relative to overall fiscal needs, it sparked extensive public debate and paved the way for future reforms targeting wealth transfers and capital accumulation. Another fiscal development of the late 1880s was the gradual increase in subventions from central government to local authorities. As municipal governments assumed greater responsibilities for public health, sanitation, education, and infrastructure, demands for financial support intensified. Goskin oversaw a series of grants to localities, funded in part by assigned revenues from duties on alcohol and tobacco. This system of hypothecated transfers, while contentious, provided municipalities with a more stable revenue stream and underscored the growing interdependence of central and local finance. Administrative reforms during this period also included improvements in tax collection and record keeping. The Inland Revenue and Customs departments continued to refine their procedures, adopting standardized forms, introducing more rigorous audit procedures, and expanding the use of printed notices and coded reference numbers. These measures reduced fraud, improved compliance, and enhanced the Treasury's ability to forecast revenue. Training programs for civil servants in the tax departments emphasized consistency, discretion, and adherence to statutory procedures. In 1892, the Liberals returned to office under Gladstone, who served his fourth and final term as Prime Minister. Sir William Harcourt was appointed Chancellor of the Exchequer and used the opportunity to articulate and implement a clearer vision of progressive taxation. Harcourt's 1894 budget, often considered the most significant fiscal statement of the decade, introduced a graduated death duty system that replaced the existing probate and legacy duties. The new death duties combined real and personal property under a unified schedule and applied a graduated scale ranging from 1% to 8%, depending on the size of the estate. This reform represented a decisive step toward the principle of ability to pay. By applying higher rates to larger estates, Harcourt's death duties challenged traditional assumptions about the sanctity of inherited wealth and the neutrality of tax policy. The measure was fiercely opposed by conservative peers and landed interests, who saw it as a threat to aristocratic fortunes and the landed estate system. Nevertheless, it passed with parliamentary support and marked a turning point in the evolution of wealth taxation in Britain. Harcourt's reform also had administrative implications. The Inland Revenue was tasked with assessing the total value of estates and collecting duties accordingly. This necessitated closer coordination with probate registries, improved valuation methods, and expanded bureaucratic capacity. New forms and schedules were introduced, and assessors were trained in property appraisal and legal classification. The system, while still susceptible to avoidance through trust arrangements and inter vivos transfers, laid the foundation for a more systematic approach to taxing capital at death. In parallel with these reforms, debates over income taxation continued. Harcourt retained the structure of the income tax as a flat rate with abatements for lower-income individuals but signaled his support for future reforms that might distinguish between earned and unearned income. Though no such differentiation was enacted during his term, the concept gained intellectual and political currency, particularly among radical liberals and Fabian socialists. They argued that unearned income from investments, rents, and inherited wealth ought to be taxed at higher rates than income derived from labor or enterprise. The question of indirect taxation also resurfaced during this period. Duties on alcohol and tobacco remained significant sources of revenue, but their regressive effects increasingly drew criticism. Working-class consumers bore a disproportionate burden of these taxes, which, although politically convenient and administratively simple, perpetuated inequality. Some reformers proposed shifting the tax burden toward luxuries and away from necessities, but these proposals met resistance from those who feared revenue losses or disruptions to established trade relationships. At the local level, the financing of services became an increasingly contentious issue. The rating system, based on property value, was criticized for its limited progressivity and for the uneven distribution of fiscal capacity among localities. Urban boroughs with large populations but modest property values struggled to raise sufficient funds, while rural areas with fewer demands often retained surplus capacity. Several commissions examined the problem, and proposals were made to revise rating assessments, broaden the base, or increase central grants. However, substantive reform of local finance remained elusive. The overlap between national and local tax systems generated administrative challenges. Property valuations conducted for rating purposes often diverged from those used in estate or income tax assessments, leading to inconsistencies and disputes. The need for a unified valuation system became increasingly apparent, but interdepartmental rivalries and jurisdictional boundaries hindered coordination. Some experimental projects attempted to align property roles and share data, but full integration was deferred to later decades. Another area of growing concern was tax avoidance. The use of legal devices to minimize tax liabilities, particularly in relation to estate duties and income categorization, attracted attention from officials and lawmakers. While not illegal, these strategies undermined the equity and effectiveness of the tax system. In response, Harcourt and his successors began to examine the legal framework underpinning tax obligations, laying the groundwork for anti-avoidance measures and judicial interpretations of fiscal intent. The final years of the decade witnessed increased politicization of tax policy. The death duties remained a point of ideological contention, with conservative critics warning of their impact on landed wealth and family succession, while liberal supporters hailed them as a step toward distributive justice. Campaigns for a graduated income tax intensified, and public discourse increasingly framed taxation in terms of social equity rather than mere revenue collection. These developments marked a shift in the public's understanding of tax policy as a tool for shaping economic outcomes, rather than simply balancing budgets. Administrative capacity continued to expand in response to these demands. The Exchequer and Audit Department, the Treasury, and the Inland Revenue all enhanced their internal structures, adopted new bookkeeping standards, and began producing more detailed statistical appendices. The classification of revenue sources, expenditure types, and tax compliance metrics enabled a more sophisticated dialogue between policymakers and administrators. These technical improvements, while often overlooked in political debate, were crucial to sustaining the growing complexity of fiscal policy. The role of professional economists and statisticians in fiscal debates also increased. Thinkers such as Alfred Marshall and J. Shield Nicholson contributed to the theoretical underpinnings of progressive taxation, and their writings informed both parliamentary speeches and Treasury memoranda. The influence of academic ideas on fiscal policy remained indirect but growing, especially as the state expanded its information-gathering capacities and sought to evaluate the social effects of taxation. During this period, the idea of social expenditure began to gain traction, although its actual implementation remained limited. Modest expansions of education funding, public health grants, and housing initiatives were financed through general revenue. These programs, although small in scale, indicated a willingness to consider government spending not merely as consumption but as investment in human capital and social infrastructure. The notion that tax revenue could serve broader developmental purposes thus began to take root, setting the stage for more ambitious reforms in the early 20th century. The decade spanning from 1895 to 1905 constituted a formative period in the development of British fiscal policy, wherein ideas associated with fiscal progressivism began to take on clearer institutional form, while outright structural reforms remained cautious and incremental. The prevailing political and economic context fostered a climate in which taxation policy was increasingly debated not merely on the grounds of revenue necessity, but also according to its distributive consequences. Central government expenditures grew steadily, while mechanisms for redistributing wealth through the tax system began to evolve in both principle and practice. The era also marked the continuation and further refinement of administrative apparatuses underpinning both direct and indirect tax collection. The Conservative government under Lord Salisbury returned to office in 1895, following the collapse of the short-lived Liberal administration under Lord Rosebery. Sir Michael Hicks Beach was appointed Chancellor of the Exchequer and held the post from 1895 to 1902. His tenure was marked by adherence to fiscal orthodoxy, with an emphasis on balanced budgets, debt repayment, and the minimization of new taxation where possible. However, events soon compelled departures from this approach, particularly the demands imposed by the Second Boer War from 1899 to 1902. In the early part of his term, Hicks Beach continued the practice of avoiding excessive increases in direct taxation. He maintained the income tax rate at a relatively modest level and relied heavily upon indirect taxes for revenue stability. These included duties on alcoholic beverages, tobacco, and sugar, products that formed substantial components of the working-class consumption basket. Critics of this approach argued that it perpetuated regressive fiscal burdens and contradicted the emerging ethos of progressivism. Nevertheless, in the absence of war or economic crisis, fiscal conservatism remained the guiding principle. By the turn of the century, however, circumstances changed. The outbreak of the Boer War in 1899 led to substantial increases in government expenditure, particularly in military logistics, supplies, and troop deployments. Total public expenditure increased sharply, necessitating corresponding increases in taxation. Hicks Beach's wartime budgets introduced temporary income tax rate hikes, and he raised duties on tea, sugar, and alcoholic beverages. He also introduced a new tax on coal exports in 1901, motivated in part by the growing profitability of the coal industry and calls for the wealthy industrial classes to bear a greater share of the fiscal burden. The coal duty generated considerable controversy. Exporters and shipping interests decried it as a threat to British competitiveness, while defenders viewed it as a necessary corrective to an otherwise imbalanced fiscal structure. Though its total revenue yield was limited relative to other taxes, the coal duty served as a symbolic assertion of the state's willingness to tax industrial capital in the national interest. The measure also illustrated the growing importance of the politics of taxation, with competing interests mobilizing against one another in parliamentary committees and the popular press. The income tax during this period was maintained as a flat rate, though the exemption and abatement thresholds were adjusted to reduce liability for lower-income earners. The structure remained otherwise uniform, but debates concerning differentiation between earned and unearned income intensified. Reformers advocated for preferential treatment of income from labor, while conservative voices insisted on the principle of neutrality. Though no such differentiation was implemented during Hicks Beach's tenure, the discussion foreshadowed future reforms that would institutionalize this concept. The estate duty system, introduced by Harcourt in 1894, continued to evolve. The administrative infrastructure supporting the valuation and collection of duties expanded, with new protocols for assessing real and personal property. Inland revenue officers underwent specialized training in property valuation, inheritance law, and fiduciary accounting. The increasing complexity of estates, particularly those involving business assets, overseas holdings, and trust arrangements, required ongoing adjustments to procedures. Officials published explanatory guides, issued circulars to solicitors, and revised reporting forms to enhance compliance and transparency. The introduction of the Finance Act 1899 further refined the structure of estate duties by addressing issues of avoidance and introducing aggregation rules for closely connected transfers. The Act clarified definitions concerning settled property and adjusted the marginal rate schedule for high-value estates. These measures signaled the government's growing commitment to the principle of progressivity, as well as its recognition of the technical challenges involved in enforcing such policies. Parliamentary debates accompanying the legislation emphasized both fiscal equity and administrative feasibility. In the post-war context, the national debt increased, though at a less alarming pace than in previous conflicts. The Treasury resumed regular payments into the sinking fund, and efforts were made to curtail expenditures once military operations ceased. Nevertheless, the increased tax rates and the newly introduced duties remained in place for several years, reflecting the inertia inherent in wartime fiscal adjustments. The experience of the Boer War, though relatively limited in scale compared to later conflicts, contributed to a broader rethinking of the fiscal powers and responsibilities of the central government. Following Hicks Beach's resignation in 1902, Charles Thomson Ritchie assumed the role of Chancellor under the new Conservative Prime Minister, Arthur Balfour. Ritchie inherited a fiscal structure shaped by wartime necessity and faced pressure to rationalize tax policy while addressing growing public concerns regarding social investment and tax equity. One of his most notable acts was the abolition of the coal duty in 1903, a move that was met with both praise and criticism. Export interests applauded the repeal, while reformers lamented the loss of a symbolically progressive measure. Ritchie also faced the challenge of responding to Joseph Chamberlain's campaign for tariff reform, which advocated for imperial preference and the reintroduction of protective duties. This initiative provoked intense debate, as it represented a significant departure from the free trade consensus that had guided British fiscal policy since the mid-19th century. Ritchie opposed tariff reform on both economic and administrative grounds, arguing that it would raise prices for consumers, complicate revenue collection, and undermine the legitimacy of existing tax structures. His resistance contributed to internal divisions within the Conservative Party and ultimately to his resignation in 1903. The growing influence of social reform movements during this period brought new pressures to bear upon fiscal policy. Advocates for old age pensions, unemployment relief, and improved housing conditions called for increased public spending and corresponding adjustments in the tax system. The Fabian Society and other progressive organizations produced pamphlets, studies, and manifestos outlining proposals for redistributive taxation, national insurance schemes, and the fiscal mobilization of economic surplus for social ends. While these proposals remained largely aspirational, they shaped public discourse and informed the intellectual context of fiscal policymaking, administratively. The Treasury and Inland Revenue continued to modernize. Detailed statistical reporting became more standardized, and fiscal tables included more granular data on revenue by tax type, geographical distribution, and taxpayer categories. The Exchequer and Audit Department developed more rigorous procedures for verifying departmental expenditures, and coordination between revenue and expenditure arms of government improved. The Civil Service Commission expanded its training and recruitment practices, leading to a modest professionalization of the financial bureaucracy. In Parliament, fiscal debates became increasingly technical, with members of Parliament drawing upon published budget statements, actuarial tables, and economic theories in their interventions. The practice of budget secrecy prior to formal presentation remained intact, but more information was disseminated post hoc for analysis and critique. Press coverage of budgets grew in sophistication, with newspapers publishing detailed breakdowns and editorials evaluating the implications of proposed changes. The figure of the Chancellor became more publicly visible, with speeches and interviews forming part of the broader political narrative. The broader economic context also influenced fiscal debates. Britain's relative economic position was increasingly challenged by the growth of the United States and Germany. Concerns about productivity, industrial competitiveness, and national efficiency intersected with fiscal policy, as commentators questioned whether the tax system supported or hindered national development. The cost of imperial defense, the maintenance of overseas possessions, and the growing administrative apparatus of the colonial state all required financial support, further complicating the calculus of domestic tax policy. The interplay between domestic and imperial fiscal needs generated debates over revenue allocation. Critics argued that colonies did not contribute equitably to imperial defense costs, while others emphasized the need for metropolitan tax policies to prioritize domestic social needs. Some reformers proposed separate accounts for imperial and domestic expenditures, while others called for a unified but more progressive system capable of addressing both sets of demands. Though no major structural reforms emerged from these debates during this period, the groundwork was laid for future reevaluations. By the end of the decade, British fiscal policy had become more visibly aligned with principles of progressivity, even if the institutional mechanisms remained limited in scope. The experiences of wartime finance, the expansion of estate duties, the debate over indirect taxes, and the growing public engagement with fiscal issues contributed to a more complex and contested tax state. Political parties increasingly incorporated tax policy into their platforms, and fiscal choices became central to broader ideological divisions. The period from 1905 to 1910 represents a critical juncture in the evolution of British fiscal policy, characterized by the decisive shift toward progressivism. The emergence of redistributive taxation as a central feature of state finance, and the first concrete steps toward the modern welfare state. The Liberal government that assumed power in December 1905, led initially by Sir Henry Campbell Bannerman and then by H. Asquith, inaugurated a sequence of fiscal reforms that culminated in the watershed People's Budget of 1909 to 1910. These years witnessed a significant realignment of fiscal philosophy, legislative innovation, and administrative complexity. Upon entering office, the Liberals faced the challenge of reconciling their commitment to free trade with increasing demands for public spending on social reform. The Liberal Party's platform, while still anchored in classical economic liberalism, had begun to incorporate elements of the new liberalism, a political philosophy that emphasized the role of the state in ensuring minimum standards of welfare, promoting equality of opportunity, and redressing imbalances produced by unregulated capitalism. These principles found expression in emerging fiscal policy. As Chancellor of the Exchequer, Asquith introduced budgets in 1906 and 1907 that preserved fiscal orthodoxy while laying groundwork for future reforms. His budgets maintained moderate income tax rates, avoided significant new levies, and emphasized revenue stability. At the same time, however, he expanded funding for key liberal priorities, including education, public health, and old-age pensions. The 1907 Finance Act introduced modest technical reforms, including the simplification of certain excise procedures and clarifications concerning estate duty valuation practices. The Old Age Pensions Act 1908, championed by David Lloyd George as President of the Board of Trade and later as Chancellor, marked a watershed in British social policy. It provided for the payment of non-contributory pensions to persons over 70, funded entirely from general taxation. Though means-tested and limited in scope, the pension scheme represented a new fiscal responsibility for the state and required a stable and expanding revenue base. Lloyd George's appointment as Chancellor in 1908 thus placed him in the position of balancing progressive social commitments with the realities of revenue generation. Lloyd George's 1909 budget, later known as the People's Budget, represented a transformative moment in British fiscal history. The budget proposed a range of new taxes and revisions to existing structures, all explicitly justified on grounds of social justice, economic equity, and the need to fund welfare expansion. Its proposals were informed by the growing influence of Fabian socialism, land reform movements, and progressive economic theory, which viewed taxation not only as a means of revenue generation but as a tool for achieving redistribution. Among the most controversial elements of the budget was the introduction of a new land tax, based on the concept of the unearned increment, that is, the increase in land value not attributable to the efforts of the landowner but to public investment and societal development. The budget proposed a 20% tax on the unearned increment realized upon the sale of land, as well as an annual duty on land value to be assessed through a comprehensive national land valuation. This valuation was to be conducted by the newly established Valuation Office, a specialized arm of the Inland Revenue tasked with surveying and recording land ownership, use, and market value across the country. The creation of this office necessitated significant administrative expansion, including the hiring and training of valuers, clerks, and surveyors, as well as the development of standard valuation criteria and appeal mechanisms. In addition to the land tax, the budget proposed increases to the existing income tax structure. The basic rate was raised from 1 shilling to 1 shilling and 2 pence in the pound, and a new super tax was introduced on incomes exceeding £5,000 per year. The super tax, imposed at a rate of 6 pence in the pound on income above the threshold, marked the formal beginning of graduated taxation in the UK and was a clear embodiment of the progressive principle. Estate duties were also revised, with higher marginal rates for large estates and new provisions to address avoidance strategies. The treatment of settled property was further clarified, and the aggregation principle was reinforced to ensure comprehensive valuation of multi-part estates. Stamp duties were expanded modestly, and liquor licenses were subjected to increased duties, justified on both fiscal and moral grounds. The budget anticipated increased revenue not only to fund pensions but to support military expenditures as well. Lloyd George explicitly linked social reform to national strength, arguing that a healthier, better educated, and economically secure population would contribute to imperial resilience. The emphasis on social investment as a component of national strategy represented a new rhetorical and policy departure. The People's Budget provoked immediate and sustained opposition from the House of Lords, dominated by the conservative-leaning aristocracy whose economic interests were directly threatened by land taxes and estate duty reforms. In December 1909, the Lords rejected the budget, precipitating a constitutional crisis. This event marked a fundamental breach of convention, as the Lords had traditionally refrained from vetoing finance bills. The rejection of the budget led to a general election in January 1910, in which the Liberals campaigned on the principle of asserting the supremacy of the elected Commons in matters of finance. Though the election produced a hung parliament, the Liberals retained power with the support of the Irish Parliamentary Party and the Labour Party. The budget was reintroduced and, under pressure, eventually passed in April 1910 after a protracted political struggle. The crisis surrounding the budget led directly to proposals for constitutional reform, culminating in the Parliament Act of 1911, which removed the Lords' ability to reject money bills and limited their delaying power on other legislation. Though this legislative development fell outside the budget period per se, it was intimately connected to fiscal reform and demonstrated the central role of taxation in broader questions of governance. In administrative terms, the passage of the budget triggered extensive efforts to implement the new taxes. The Valuation Office undertook the mammoth task of surveying the entirety of England, Wales, and Scotland, generating a new set of land registers. Inland revenue officials received training in the application of the super tax, and new protocols were developed to verify declarations of high-income earners. Penalties for underreporting and evasion were codified, and the department was granted enhanced investigatory powers. Public discourse during this period became intensely focused on taxation. Newspapers published detailed analyses of the budget's provisions, cartoons lampooned both supporters and opponents, and public meetings were convened across the country. The debates highlighted growing awareness of fiscal policy among the electorate and revealed deep divisions concerning the role of the state, the nature of property rights, and the obligations of wealth. The budget also had implications for local government finance. The Land Valuation Project generated new data that could, in theory, support reforms in rating systems and inform local taxation policy. Though the immediate impact was limited, reformers saw in the valuation exercise a foundation for eventual alignment between national and local fiscal regimes. The ideological underpinnings of the People's Budget drew upon a synthesis of classical liberalism, Fabian socialism, and emerging welfare theory. Writers such as John A. Hobson and L. T. Hobhouse provided intellectual justification for redistributive taxation, arguing that the concentration of wealth produced inefficiencies, social harm, and democratic imbalance. Their writings informed the broader intellectual climate in which fiscal debates occurred. By 1910, the British fiscal state had acquired new powers, responsibilities, and institutional features. Taxation had become not merely a technical matter of raising revenue but a central arena of political contestation. The tax system now contained explicit progressive elements, and the administrative apparatus to enforce them had expanded. Political parties were increasingly defined by their fiscal philosophies, and the electorate engaged more directly with questions of taxation and spending. The period from 1905 to 1910 thus marks the transition from a minimalist fiscal state to a more interventionist one. While the full architecture of the modern welfare state had not yet been constructed, the foundations, both fiscal and ideological, had been laid. The people's budget, though controversial, served as the symbolic and institutional turning point. Following the passage of the People's Budget in 1910 and the concurrent constitutional crisis, the British fiscal landscape entered a phase of cautious consolidation, retrenchment, and incremental adjustment. Although the liberal and progressive foundations laid in the preceding years remained largely intact, the period from 1910 to 1914 witnessed a shift in emphasis from radical innovation to the implementation, refinement, and containment of the new tax regime. This phase was marked by political uncertainty, economic fluctuation, and the rising shadow of continental tension that would soon erupt into global conflict. Upon the death of King Edward VII in May 1910, and amid renewed debates over the House of Lords' authority, the government's attention was divided between fiscal governance and constitutional reform. The Parliament Act 1911 curtailed the Lords' power to reject or delay financial legislation beyond 1 month, establishing the formal supremacy of the House of Commons in all matters of taxation. This act, though primarily constitutional in nature, had profound fiscal implications, ensuring that future tax measures could be enacted without interference from the unelected chamber. Chancellor David Lloyd George remained in office throughout this period, directing the Treasury with a blend of rhetorical flair and administrative rigor. He remained committed to the principles of progressive taxation and welfare provision, but the political environment, characterized by a minority Liberal government dependent on Labour and Irish support, constrained his ability to pursue new fiscal reforms on the scale of the 1909 budget. In practice, fiscal policy during these years revolved around 3 interrelated themes: the maintenance of revenue yields, the stabilization of administrative mechanisms, and the preparation for possible military exigencies. The income tax structure established in 1909 to 10 was retained, with minor adjustments. The standard rate remained at 1 shilling and 2 pence in the pound, while the supertax continued to apply to incomes over £5. 000. Revenue from income tax rose steadily due to natural economic growth and improvements in compliance. Inland revenue officials worked to institutionalize processes for income declaration, assessment, and appeals. Employers were increasingly integrated into the administrative framework, particularly through expanded use of deduction at source and the issuance of tax certificates. Estate duties remained an important source of revenue. The progressive rate structure introduced in 1907 and reinforced in 1909 continued to yield high receipts, particularly from large landed estates and urban commercial wealth. Tax avoidance strategies, including the use of trusts and settlements, persisted, prompting administrative reforms aimed at improving transparency in asset declarations. The Inland Revenue published increasingly detailed guidance to executors and solicitors, standardizing reporting requirements and reducing the discretion previously afforded in valuations. The Land Valuation Initiative launched under the Finance, 1909-10, Act continued, albeit with logistical delays and political controversy. The Valuation Office produced a series of doomsday books, recording land ownership, use, and assessed values. These documents, while originally intended to serve as the basis for land taxation, also provided ancillary benefits to local authorities, researchers, and policymakers. However, implementation challenges, including disputes over valuation methodology, appeals from landowners, and inconsistent survey coverage limited the full realization of the original redistributive goals. Lloyd George's budgets from 1911 to 1914 largely avoided introducing major new taxes, focusing instead on refining existing instruments. The 1911 budget expanded the super tax schedule marginally by reducing exemptions and increasing administrative scrutiny of deductions. It also imposed a modest increase in tobacco duties and clarified licensing requirements for bookmakers and betting establishments. These changes aimed to improve revenue without provoking significant political opposition. The 1912 budget introduced new excise measures affecting motor vehicles, including a license duty based on horsepower. This marked one of the first substantial applications of taxation to the emerging automobile sector and reflected broader trends in the taxation of consumption and luxury. The motor vehicle duty was administered through county councils under Treasury guidance and required the creation of registration systems, enforcement protocols, and inspection regimes. Throughout this period, customs and excise duties continued to constitute a significant portion of state revenue. Duties on alcohol, tobacco, tea, sugar, and coffee were maintained at stable rates, with only minor technical modifications. The customs authorities undertook initiatives to modernize port inspection systems, enhance revenue tracking, and improve enforcement against smuggling, particularly along the South Coast and Irish Sea. The National Insurance Act 1911 introduced a new dimension to state finance. Although technically outside the conventional tax system, the Act established contributory insurance schemes for health and unemployment, funded jointly by employees, employers, and the state. The Treasury assumed responsibility for the state's contributions and for overseeing the financial integrity of the system. This necessitated the creation of new departments, actuarial oversight structures, and payment mechanisms. The Act represented a significant expansion of fiscal responsibility and administrative capacity. The actuarial work underlying the national insurance scheme required detailed demographic and labor market data, leading to increased collaboration between the Treasury, the Board of Trade, and the newly established Government Actuaries Department. Financial forecasts, cash flow models, and reserve estimates were produced to assess the long-term viability of the scheme. While these developments did not immediately alter the core tax regime, they represented a notable evolution in the state's fiscal infrastructure. Public debt management remained relatively stable during this period. The debt had declined slightly as a proportion of GDP due to economic growth and conservative borrowing practices. The Treasury focused on maintaining investor confidence, promoting the sale of consols and other gilt-edged securities, and managing redemptions in a predictable manner. The Bank of England continued to play a central role in these operations, acting as fiscal agent and advisor. Monetary conditions were generally favorable, with modest inflation and a steady gold reserve. The gold standard was maintained, and the Treasury's gold holdings were supplemented through colonial remittances and favorable trade balances. International capital markets remained open to British government borrowing, should it become necessary, although Lloyd George avoided new loans during peacetime. By 1913, fiscal discussions began to include military preparedness. The growing naval rivalry with Germany, combined with instability in the Balkans and increasing defense commitments in the empire, prompted discussions within the cabinet about the potential need for increased military expenditure. Although no major defense tax was introduced, Treasury officials began modeling scenarios for war finance, including contingency plans for rapid borrowing, emergency taxation, and resource allocation. The Inland Revenue and Customs Departments also began preliminary assessments of how wartime conditions might affect revenue streams. Internal memoranda discussed the likely decline in customs receipts in the event of naval blockades, the need for flexible collection mechanisms, and the desirability of tax instruments that could be rapidly scaled. These discussions foreshadowed the fiscal transformations that would occur after 1914 but remained confidential and speculative at the time. The politics of taxation remained contentious. The conservative opposition criticized the liberal reliance on progressive taxes and warned of capital flight, declining investment, and economic inefficiency. The liberal leadership defended their policies as necessary for social cohesion and equitable development. Labor members pressed for further redistribution, especially through graduated income taxes and increased estate duties. Irish nationalists remained focused on securing home rule and showed limited interest in tax reform per se, taxpayer resistance, while not organized into a national movement, manifested through increased legal appeals, lobbying by professional associations, and challenges to land valuation processes. The Law Society, Chambers of Commerce, and landowners' associations submitted regular petitions and briefings to the Treasury. These communications contributed to technical amendments, clarifying definitions, adjusting thresholds, and refining assessment procedures. Professionalization of tax administration accelerated. The Inland Revenue expanded training programs, issued revised instruction manuals, and developed specialized units for complex cases, including international income, trusts, and multinational estates. Legal expertise was increasingly required, and the Treasury cooperated with the legal profession to develop standardized tax opinions and case law interpretations. Public engagement with fiscal matters grew. Newspapers published tax guides, analyzed budget speeches, and debated the fairness of various levies. Political cartoons depicted the Chancellor as both Robin Hood and highwayman. Taxation became a fixture of electoral campaigns, parliamentary debate, and popular discourse. This democratization of fiscal consciousness underscored the new political salience of the tax system. By mid-1914, the British fiscal state was characterized by a blend of progressive ideology, administrative modernization, and cautious pragmatism. The groundwork laid by the people's budget had been stabilized, if not dramatically expanded. The income tax system included graduated elements. Estate duties were well established, land valuation continued slowly, and contributory welfare schemes had begun, yet the system remained vulnerable to external shocks. The reliance on customs and excise made revenues sensitive to trade disruptions. The limited experience with mass borrowing constrained financial flexibility. The absence of wartime tax protocols meant that rapid mobilization of resources would require extraordinary measures. In July 1914, as tensions on the continent escalated into war, the British fiscal system stood at the threshold of its most dramatic transformation. The years of liberal reform had reshaped the foundations, but the edifice of wartime finance had yet to be constructed. At the outbreak of the First World War in August 1914, the British fiscal system, though modernized and progressively structured, was not immediately configured for the scale and complexity of the financial demands imposed by total war. The onset of hostilities necessitated an unprecedented expansion in public expenditure, accompanied by fundamental shifts in taxation, borrowing, and economic management. The period from 1914 to 1918 represents a watershed in the history of British public finance, during which the fiscal state was transformed in both structure and function. The initial government response to the declaration of war focused on the maintenance of financial stability. Chancellor of the Exchequer David Lloyd George, supported by officials at the Treasury and the Bank of England, sought to preserve public confidence in the pound and ensure liquidity within the banking system. Emergency legislation was passed under the Currency and Bank Notes Act 1914, authorizing the issue of Treasury notes and suspending the gold standard. These £1 and 10 shilling notes, colloquially known as Bradburys after Sir John Bradbury, permanent secretary to the Treasury, served as fiat currency and alleviated pressure on gold reserves, the War Loans Act 1914 authorized the government to raise money through the issuance of debt instruments. The Treasury launched a series of war loan campaigns, offering fixed-interest securities to both institutional and retail investors. The first war loan, issued in November 1914, offered an interest rate of 3.5%, repayable in 1925 or later. It was followed by further issues in 1915, 1916, and 1917, each offering progressively higher yields and longer maturities. These campaigns were supported by extensive advertising, patriotic appeals, and the mobilization of financial institutions to promote subscription. Despite the growing reliance on borrowing, the government recognized the necessity of increasing tax revenues to meet wartime expenditure. The 1914-15 budget, presented in November 1914, introduced only modest changes, including an increase in the standard income tax rate from 1 shilling and 2 pence to 1 shilling and 6 pence in the pound. However, subsequent budgets, particularly those presented by Reginald McKenna, 1915-16, and later by Bonner Law, 1916-18, significantly expanded the scope and intensity of wartime taxation. Income tax rates rose sharply. By 1918, the standard rate had increased to 6 shillings in the pound, equivalent to 30%. The super tax, originally levied on incomes over £5,000, was extended and graduated in multiple tiers, with marginal rates reaching 60% on very high incomes. These increases marked the establishment of a fully graduated income tax system and introduced the principle of fiscal sacrifice proportionate to ability to pay. The base of the income tax was broadened to include a greater proportion of the working and lower middle classes. Exemption thresholds were lowered, and earned income reliefs were reduced. Employers were required to deduct tax at source from wages above the exemption level, accelerating the development of the pay-as-you-earn (PAYE) model. Inland Revenue expanded its workforce to administer the increased caseload. Relying on standardized forms, mechanized processing, and decentralized collection offices. Excess profits duty was introduced in 1915 as a temporary measure to capture war-related gains by businesses. Initially levied at 50% of profits exceeding a pre-war standard, the rate was later raised to 80%. The measure applied to corporations and partnerships, with adjustments for capital employed, depreciation, and reinvestment. While criticized for distorting business incentives and encouraging accounting manipulation, the duty generated substantial revenue and reinforced the narrative of shared wartime responsibility. Indirect taxation also expanded. Customs and excise duties were raised repeatedly on a wide array of goods. Duties on alcohol, tobacco, tea, sugar, petrol, matches, and other consumables were increased, often by multiple increments within a single year. These measures, though regressive in incidence, were justified on the basis of necessity and administrative expediency. The Customs and Excise Departments introduced simplified tariff schedules and deployed additional inspectors to enforce compliance. New taxes were introduced to supplement the fiscal arsenal. A duty on entertainments, including cinema admissions and sporting events, was imposed in 1916. A tax on motor cars based on horsepower was expanded. Stamp duties were raised on legal and financial documents. The government also imposed a tax on railway tickets and expanded licensing fees for firearms and dogs. These taxes, while modest in yield individually, collectively contributed to the widening of the tax base. Public debt rose to unprecedented levels. From a pre-war national debt of approximately £700 million in 1914, the figure rose to over £7.4 billion by 1919. War loan campaigns accounted for the majority of this increase, with over 15 million British subjects subscribing to some form of war bond. Interest payments consumed an increasing share of annual expenditure, requiring ongoing borrowing to service prior obligations. The Treasury instituted sinking funds to provide for eventual redemption, but these were largely suspended during wartime. The financing of the war also included significant monetary expansion. Treasury bills were issued in increasing volume, providing short-term finance to bridge gaps between revenue and expenditure. The Bank of England discounted large volumes of these instruments, effectively monetizing the deficit. Inflationary pressures mounted gradually, with the cost of living index rising by over 100% between 1914 and 1918. Wages rose in response, but often lagged behind price increases, resulting in real income compression and heightened industrial unrest. The structure of fiscal administration adapted to wartime exigencies. The Treasury expanded its personnel, created new divisions, and coordinated closely with military departments, the Ministry of Munitions, and the newly established Ministry of Food. Budget planning became more complex, with multiple supplementary estimates submitted throughout each fiscal year. Treasury control over departmental spending tightened, but the scale and urgency of wartime operations often required ex-post regularization of expenditures. The war also affected local government finance. Grants from central government increased to support housing, health, and education services strained by wartime conditions. Local rates remained the principal source of municipal revenue, but ratepayer resistance and the demands of air raid precautions, food control, and wartime relief required greater fiscal coordination between local and central authorities. Public attitudes toward taxation evolved. While initial patriotic enthusiasm underpinned broad support for fiscal measures, discontent grew as the burden intensified. Newspapers debated the fairness of war profits taxes, the impact of inflation on savings, and the equity of income tax thresholds. Taxpayer associations proliferated, offering advice and legal assistance. Nevertheless, widespread evasion or resistance was limited, and compliance remained generally high, reflecting the perceived legitimacy of wartime sacrifice. Tax law and jurisprudence expanded. Wartime budgets required annual finance acts of increasing complexity, with extensive schedules detailing rates, exemptions, reliefs, and administrative provisions. Legal challenges to assessments rose, leading to new case law on the interpretation of taxable income, the calculation of excess profits, and the legitimacy of administrative discretion. Tax accountants, barristers, and judges played a growing role in shaping the fiscal regime. Education and propaganda supported fiscal mobilization. Schools and civic associations promoted war savings campaigns. Posters and pamphlets exhorted citizens to contribute through taxes, bonds, and thrift. The government enlisted celebrities, religious leaders, and military heroes to endorse financial participation. The notion of the fiscal citizen emerged, linking monetary contributions to national identity and democratic responsibility. International comparisons influenced policy. British officials studied the tax systems of France, Germany, and the United States, borrowing elements deemed effective or administratively feasible. The American introduction of the federal income tax in 1913, and its subsequent expansion during wartime, provided a transatlantic benchmark. Allied cooperation in customs duties, financial intelligence, and debt management further internationalized fiscal policy. As the war neared its conclusion in late 1918, the British fiscal state had undergone a transformation in scale, scope, and structure. Annual expenditure had increased from under £200 million in 1913 to over £2.3 billion in 1918. Tax revenues, while rising sharply, still covered less than half of total spending, leaving the remainder to be financed through borrowing and monetary expansion. The income tax had evolved into a mass tax with progressive features. Business taxation had intensified. Indirect taxes had multiplied. The machinery of fiscal administration had expanded and professionalized, yet this transformation was accompanied by long-term implications. The increased national debt would require servicing for decades to come. Inflation had eroded savings and distorted relative prices. Class tensions over the burden of taxation persisted. The principle of fiscal fairness remained contested. Nonetheless, the war had established the legitimacy of large-scale state intervention in finance, and the centrality of taxation to national policy. The post-war period would confront the challenge of fiscal demobilization, debt stabilization, and reconstruction. The legacy of wartime finance would inform debates over equity, efficiency, and economic recovery in the years to follow. In the immediate aftermath of the First World War, the British government confronted a complex and multifaceted fiscal landscape. Wartime expenditures had produced a massive increase in national debt, a greatly expanded tax base, significant inflation, and institutional transformations across the public finance system. The transition from war to peace entailed efforts to restore fiscal order, reduce deficits, and return to traditional economic orthodoxy. The period between 1919 and 1925 was characterized by austerity, retrenchment, and a concerted attempt to normalize the structure of taxation and public spending within a framework shaped by both pre-war ideals and wartime legacies. The conclusion of hostilities in November 1918 did not immediately bring a reduction in government spending. On the contrary, the post-war years saw continued high levels of expenditure owing to demobilization costs, war pensions, debt interest payments, unemployment support, and commitments to housing and social services. The 1919 to 1920 fiscal year recorded government spending in excess of £1.2 billion, approximately 6 times the level of expenditure in 1913 to 14. The burden of debt servicing remained significant. By 1920, interest payments on the national debt consumed nearly 40% of all government outlays. The bulk of this debt took the form of long-term war loans issued at fixed rates, typically between 4 and 5%. Efforts to refinance these obligations were constrained by market conditions and investor expectations, limiting the Treasury's capacity to reduce debt service costs in the short term. Income tax remained the central pillar of post-war revenue. The standard rate remained high, reaching 6 shillings in the pound in 1919 to 20. Although this was gradually reduced in subsequent years, it remained well above pre-war levels throughout the period. The super tax, introduced before the war and expanded during it, remained in place, with thresholds and marginal rates adjusted to reflect inflation and political pressures. The persistence of elevated income tax rates signaled the entrenchment of progressive taxation as a norm of fiscal policy. Excess profits duty, initially introduced as a wartime measure, was retained until 1921. While it had yielded substantial revenue during the war, it became increasingly unpopular among business interests and was seen as a disincentive to investment and expansion in the post-war context. Its eventual abolition reflected a broader desire to encourage economic recovery and reduce administrative burdens. Indirect taxation remained significant. Duties on alcohol, tobacco, sugar, tea, and other commodities were retained at high levels, contributing to both revenue and inflationary pressures. Customs and excise authorities continued to play a vital role in revenue collection, and their administrative apparatus remained enlarged relative to pre-war norms. The entertainment's duty, vehicle licensing fees, and stamp duties also persisted. Reinforcing the diverse and multi-channeled nature of the tax system, to consolidate fiscal authority, the government enacted the Finance Act of 1920, which codified various wartime measures into peacetime law. This included adjustments to income tax thresholds, refinements to super tax assessments, and changes to the treatment of capital allowances. The Act also extended the administrative reach of the inland revenue and improved procedures for appeals and enforcement. Public pressure for tax relief grew throughout the early 1920s. The combination of high taxation, inflation, and economic stagnation led to calls for fiscal retrenchment. The Chamberlain Committee on Taxation, appointed in 1920, undertook a comprehensive review of the tax system. Its report, issued in 1922, recommended simplification, the abolition of the excess profits duty, and cautious movement toward lower income tax rates. The recommendations were partially implemented over subsequent budgets. One of the most significant fiscal episodes of the period was the introduction of the so-called Geddes Acts. In 1921, the government, facing a persistent budget deficit and rising public concern over wasteful expenditure, appointed a committee on national expenditure chaired by Sir Eric Geddes. The committee was tasked with identifying areas for significant spending reductions. Its report, submitted in 1922, recommended cuts of £87 million, targeting education, housing, health services, and defense. The Geddes Acts became synonymous with the post-war austerity drive. The recommendations were adopted with varying degrees of enthusiasm, leading to reductions in civil service employment, local government grants, and departmental budgets. These measures marked a shift away from the more interventionist fiscal approaches seen during the war and in its immediate aftermath. The principle of balanced budgets, minimal state interference, and financial prudence was reasserted as the guiding ethos of British fiscal management. The decision to return to the gold standard at the pre-war parity of $4.86 per pound, implemented in 1925 under Chancellor Winston Churchill, was a further manifestation of the drive toward economic orthodoxy. Although outside the strict bounds of taxation policy, the return to gold had profound fiscal implications. It required deflationary policies, including spending restraint and high interest rates, which in turn influenced the scope of tax policy and public finance more generally. During this period, the structure of fiscal administration continued to evolve. The Inland Revenue and Customs and Excise maintained their wartime expansions in personnel and capacity, though staffing levels were gradually reduced in response to cost pressures. Taxpayer registration systems were improved, assessment processes were refined, and appeals mechanisms were standardized. These developments contributed to the emergence of a more professional and institutionalized fiscal bureaucracy. Efforts to improve compliance and reduce evasion were also a priority. The Inland Revenue expanded audit functions, issued new guidance on allowable expenses, and introduced standardized accounting expectations for businesses and professionals. Legal cases clarified the boundaries of tax avoidance and shaped emerging doctrines around the substance over form principle and the legitimacy of artificial arrangements. The period also witnessed the growing importance of statistical data in fiscal policy. The Treasury and Inland Revenue invested in more comprehensive data collection, enabling better estimation of tax yields, expenditure forecasts, and macroeconomic indicators. The publication of the annual financial statement and the estimates became more detailed, reflecting the increasing complexity of government finance. Public attitudes toward taxation remained ambivalent. While there was widespread recognition of the need to service the national debt and fund essential services, resistance to high rates of direct taxation grew, particularly among the middle classes. The notion of tax equity was hotly debated in newspapers, parliamentary debates, and civic organizations. Taxpayer leagues lobbied for reform, and the idea of a fair return on earnings became a central theme in public discourse. Local government finance during this period remained constrained. The wartime expansion of central grants to local authorities was gradually reversed under the Geddes Acts, compelling councils to rely more heavily on local rates. This generated tensions between local and national fiscal priorities, and laid the groundwork for future debates on the financing of municipal services. The structure of taxes during this period reflected a compromise between inherited wartime measures and a desire for peacetime normality. The income tax, while reduced from its wartime peak, remained central. Indirect taxes were retained for their administrative convenience and broad base. Business taxation shifted toward more conventional profit assessments. The administrative system, while streamlined, continued to reflect the exigencies of the wartime expansion. Inflationary pressures gradually eased following the post-war boom and bust cycle. The sharp recession of 1920–21 helped curb inflation, but it also led to rising unemployment and fiscal pressures. The Exchequer implemented modest counter-cyclical relief measures, though these were limited by prevailing orthodoxy favoring balanced budgets and monetary stability. Throughout this period, debates persisted over the appropriate size and role of the state in economic life. The war had expanded expectations of government provision, particularly in housing, health, and education. However, fiscal constraints limited the extent to which these expectations could be met. The concept of retrenchment became the dominant theme in fiscal politics, accompanied by a rhetoric of sacrifice, discipline, and national recovery. The use of fiscal instruments to pursue economic and social goals remained limited. Although taxes were used to raise revenue, their use as tools of redistribution or macroeconomic management was circumscribed by ideological and institutional constraints. The legacy of the war, however, ensured that taxation would remain central to political debate and economic governance. By 1925, the structure of British public finance had settled into a new equilibrium. The wartime innovations had not been fully reversed, but they had been modified and integrated into a peacetime framework. The fiscal state retained its enlarged capacity, but its ambitions were scaled back. The income tax had become a permanent and central feature of the system. Public debt remained high, but manageable. The principle of fiscal orthodoxy had been re-established, though not without controversy, across the centuries, from the fragmented tributes of the Anglo-Saxon shires to the modern bureaucratic apparatus of the early 20th century. The evolution of British taxation reveals a long and uneven process of institutional consolidation, fiscal experimentation, and political negotiation. The legacy of this extensive trajectory was not merely a body of laws or a sequence of levies, but a complex architecture of administrative capability, legal precedent, economic doctrine, and societal expectation. At its core, the British tax system developed in response to the perennial fiscal demands of the state, first for sustenance, later for war, and eventually for the maintenance of peace, social order, and infrastructure. From the Danegeld to the income tax, from medieval tallage to Victorian excises, each levy bore the imprint of its political, economic, and technological context. The medieval origins of the system were deeply intertwined with the feudal order. The early exactions of land-based tribute were anchored in personal obligation and customary service. The king's right to demand resources from his tenants-in-chief formed the foundation for later innovations in scutage, aids, and the more sophisticated clerical and lay subsidies. These feudal levies, while irregular and often contested, established a precedent for centralized revenue extraction and rudimentary record-keeping. With the growth of parliamentary authority in the 13th and 14th centuries, taxation became increasingly subject to negotiation. The Crown's reliance on parliamentary grants, particularly for extraordinary needs such as war, facilitated the gradual expansion of parliamentary oversight over royal finance. This culminated in the late medieval practice of granting subsidies and customs duties in return for specific political concessions or affirmations of grievance. The fiscal apparatus of the Tudor and early Stuart periods further refined this institutional relationship. The spread of lay subsidies, the increasing formalization of customs and excise collection, and the emergence of specialized fiscal courts reflected an incremental move toward administrative regularity. At the same time, efforts to sidestep parliamentary consent, through impositions, monopolies, and forced loans, highlighted the persistent tension between fiscal necessity and constitutional propriety. The upheavals of the 17th century, Civil War, Commonwealth, and Restoration, gave rise to fundamental reconfigurations. The Glorious Revolution of 1688, and the subsequent Bill of Rights and Act of Settlement, enshrined parliamentary control over taxation and expenditure. The establishment of the Bank of England in 1694, and the concurrent development of funded debt instruments, laid the groundwork for the fiscal military state that would dominate the 18th century. During this period, the British government became increasingly adept at mobilizing resources on an unprecedented scale. Land taxes, excises, customs, and duties on commodities like salt, beer, and windows formed a dense and interlocking system of revenue. The 18th century saw the maturation of fiscal capacity, with institutions such as the Treasury, the Exchequer, the Commissioners of Customs, and the Excise Office becoming more professional and centralized. By the dawn of the 19th century, Britain's tax system had become both an engine of state power and a subject of growing public discontent. The Industrial Revolution brought new wealth, but also new inequities. War with Napoleonic France necessitated the introduction of the income tax, a radical departure from precedent and a harbinger of modern direct taxation. Though temporarily repealed, its reintroduction in 1842 marked a decisive shift in fiscal philosophy. The Victorian period witnessed the consolidation of administrative structures, the rationalization of tax codes, and the reduction of many indirect taxes. Chancellors like Gladstone sought to promote equity, efficiency, and simplicity, although these ideals were constrained by political realities and economic limitations. The growth of mass suffrage and democratic representation further complicated the politics of taxation, as elected governments balanced fiscal responsibility with popular expectations. The early 20th century brought both continuity and rupture. The social reforms of the Liberal government, the People's Budget of 1909-10, and the First World War radically expanded the state's role in economic and social life. Taxation, especially the income tax and its graduated supplement, the supertax, became the primary means by which the state funded both warfare and welfare. The war transformed the fiscal system not only in scale but in character. The number of taxpayers increased, the apparatus of assessment and collection grew more complex, and the very concept of the fiscal state evolved to encompass broader goals of redistribution, economic management, and national solidarity. Wartime exigency entrenched the legitimacy of the state as a revenue collector on a vast scale, a legitimacy that persisted into the peacetime years. By 1925, Britain's tax system reflected centuries of accumulation, adaptation, and contestation. It was no longer a fragmented patchwork of ad hoc levies and localized impositions, but a unified, if still imperfect, structure capable of supporting a modern industrial society. The state had acquired not only the means to tax, but the institutions, data, personnel, and political culture to do so systematically, yet the legacies of the past remain visible. The structure of income tax still bore traces of its 19th century origins. The administration of customs and excise still reflected 18th century protocols. The persistence of property taxation, rates, and certain stamp duties echoed long-standing fiscal traditions. Even the ideological debates, over equity versus efficiency, direct versus indirect taxation, centralization versus local autonomy, retained their historical lineage. The experience of war had accelerated institutional change, but it had also revealed the limits of existing frameworks. The demands of total war had outstripped the capacities of traditional bureaucracies, leading to ad hoc innovations that would gradually be formalized. The tension between revenue generation and economic growth, between administrative simplicity and fairness, remained unresolved. In broader historical perspective, the British tax system had evolved from a tool of royal prerogative into an instrument of democratic governance. It had been used to fund armies, suppress dissent, build navies, finance empires, provide poor relief, and subsidize education. It had been shaped by rebellions, revolutions, financial crises, and legislative compromise. It had become both a symbol and a mechanism of state power. As Britain stood at the midpoint of the 20th century's third decade, it did so with a tax system that was deeply embedded in the fabric of governance. The transition from pre-modern to modern taxation was not marked by a single moment, but by a series of overlapping and cumulative developments. The Anglo-Saxon tribute, the medieval subsidy, the Tudor excise, the Napoleonic income tax, the Victorian reforms, and the wartime levies all contributed to the structure that emerged by 1925. In the decades to follow, the British fiscal state would continue to evolve. It would grapple with depression, war, welfare expansion, and decolonization. It would confront new economic theories, global integration, and social transformation. But the foundations laid over centuries, of institutional coherence, legal authority, administrative capacity, and public accountability, would remain integral to its operation. Thus, the legacy of pre-modern British taxation was not simply historical, it was structural, cultural, and institutional. It formed the substratum upon which the modern fiscal state would be built, and it continued to shape the contours of policy, debate, and governance long after the last scutage had been paid, the last window bricked up, and the last war loan redeemed.